Over the past decade, China has gone from a Silicon Valley copycat to a top contender in technology on the world stage.
Its ascent is peaking at a time when geopolitical tensions with the US and Europe are intensifying, and the rise of artificial intelligence has sparked a new arms race.
The US is rushing to curb China's influence in AI while balancing the need to regulate the powerful technology within its own borders.
How America manages these competing priorities will have implications for where the balance of power in tech will shift to next.
On this episode of AI IRL, we'll explore how China's playbook went from imitation to innovation and discuss what's at stake in the competition between these two superpowers.
Mustafa Suleiman, thanks so much for coming in. Now, you are the co-founder and CEO of Inflection AI and a venture partner at Greylock. Some people will know you as one of the co-founders of DeepMind, now owned by Google. Tell us, what made you want to start fresh with Inflection?
Well, now is really the moment. I mean, it was very clear to me during 2020, 2021 at Google when I was working on Lambda, the conversational AI that now powers Bard, that these large language models were truly going to be the future. And I wanted to start a company to build personal AIs, an intelligence that is completely aligned to your interests on your team and really functions as a personal assistant or a chief of staff, one that knows you intimately and over time can actually help you with practical tasks like scheduling, prioritizing, planning, and those kinds of things.
And that's what you're working with Pi.
Exactly, yeah. Pi stands for personal intelligence, and we see it as your personal assistant, essentially.
How do you feel about the concentration of power in technology right now among the big companies coming out with their own AI models? Microsoft, Google, Meta.
Well, I mean, I think you're right to point out that the big companies have the resources and the people and the compute infrastructure to be able to adapt and compete faster than ever, right? And that is a very impressive, reality of how technology works these days. It requires a huge amount of compute. And at my own company, Inflection, we've managed to raise a lot of money and build one of the largest supercomputers in the world. But on the flip side, the other trend that's taking place is that the open source movement is now almost at cutting edge. I mean, it's probably about 12 months behind the very largest models built at the big tech companies. And so that's kind of a contradictory trend. Like the big companies are getting bigger and better faster, but also everybody is now going to be able to get access to these same capabilities in open source.
Let's fast forward a little bit into the present day where the world order has changed since you first entered the tech industry. How did China go from being a copycat culture to a contender when it comes to digital innovation and specifically AI?
Yeah, I mean, China is more than a contender. I think in many respects, it's one of the leading players now. I mean, they've always been incredibly creative. And I think that we may have, sort of overstated the extent to which they were simply copying, what we were doing. And I think it's important to remain humble about the fact that, these ideas are going to be widely available to millions and millions of people. And, in many respects, all of our cultures are equally creative, and they've been able to take, tools and ideas that are available both in open source, in the academic literature, and move them forward, innovate at the cutting edge. They've produced a lot of very good papers, contributions to the academic conferences that have been peer reviewed. So, I just think overall it's better to take an approach of humility, acknowledging that, they're also going to be a really significant player in this field over the next few decades.
How would you rank the United States in terms of technological prowess in that world order?
Well, I mean, there's no question that we, in the US and in the West more generally, are currently in the lead. I mean, we have the very best, most innovative technology companies and technology hubs. Without doubt, Silicon Valley is leading the pack. And I think we'll continue to. I think we worry too much that we're going to sort of be dislodged from our podium position.
For how long do you think?
Well, I think the question is, what does it look like to be dislodged? And is that really the right framing in the first place? Like, what is the difference between first and third? And, people talk about there being a race for AI, and it's very unclear what that looks like to come second or third in that race. I think it's sort of the wrong metaphor.
We're talking about superpowers, Clash of the Titans sort of stuff. It reminds me of back when the previous US administration banned companies from doing a lot of business with Huawei, and Huawei ended up basically having to get a lot better very quickly at making its own chip designs and all that kind of stuff. And it feels like it backfired a little bit.
Yeah, you've also advocated for the US restricting sales of some NVIDIA chips, which are crucial in training AI systems, to buyers who don't agree or who refuse to use them ethically and safely. So what do you think is the best way the US can actually flex its power? Is it through the technological innovation, or by stifling effectively some of its adversaries through regulation?
The first thing I should say about that is I don't think now is the time to do that. I mean, I think in theory, when the time comes, if the time comes for us to adopt a kind of global anti-proliferation strategy, we're worried about technologies being so powerful that we have to stop their spread. If that moment arises, and I think we're quite a long way from experiencing that, then technically that would be an appropriate containment strategy. Because much as this technology is manifested in software, it lives on the internet, it still sits on chips, whether you're training a model or serving a model. So in order to ask a model a query, you have to have access to one of those NVIDIA GPUs. And, for what it's worth, there are really only like one major company in the world that produces those high-end GPUs, NVIDIA, and they manufacture the vast majority of their chips at TSMC in Taiwan that use one single company, ASML, a Dutch company that manufactures the core chip that produces the chips, and they sit in the Netherlands. So it's actually a very narrow supply chain. And so I think the point I was sort of trying to make is that if you wanted to adopt a containment strategy, there is a supply chain where you can impose chokeholds on it.
And in 10 years from now, which country do you think will be leading the world in AI? Is it going to be the US? Will it be China? Will it be Europe?
It's going to be the US, I'm pretty sure of that. I mean, the fundamentals in the US innovation ecosystem are unquestionably the best in the world. I mean,
what could flip that balance of power?
Well, I mean, I think it's hard to say. I mean, I really do think that the US is in the strongest possible position. At the end of the day, it's talent that drives, this innovation. And talent still concentrates around a small number of physical places. Despite everything that we've experienced in the pandemic and people wanting to work remotely, it's still really important to be physically proximate to other people who, are working with you in the office. I mean, I think that trend isn't going to change. I do think China is going to catch up. I think they're going to develop their own AI chips, their own fabrication facilities. But that is going to take 5 years or so. The export controls that the US has implemented, are real, and they really will prevent China from getting access to the next frontier of models, so the GPT-5 onwards. Right now, I don't really see how China could train those kinds of models.
Is there any downside, any unintended consequences that could come from this containment strategy the US is employing?
Yes, I think it is a very aggressive strategy. The counterattacks have already started, right? China restricted gallium, which is a raw material used in chip manufacturing. And I expect them to have their own reactions in time. We're very dependent on their supply chain. And so the idea that we could completely decouple, I think, is misguided.
I'm going to just put you on the spot really briefly and wonder, can you tell, because we're all friends here.
Sure, go for it.
Do you have a major regret about your work in AI? And do you also have a major single goal?
Yeah, my major single goal is to show that it is possible to create safe and ethical artificial intelligences which are accountable to humans. There is a possible trajectory where some groups may recklessly experiment with algorithms that can self-improve. And if in 10 to 15 or 20 years' time, those kinds of AIs are set loose on the open web in a reckless way, then I can imagine that possibly causing serious harm. And so for as long as I can remember, almost 15 years that I've been involved in AI, I've been trying to raise awareness and concern about the possible ways in which it can go wrong. And part of doing that is to show a bunch of practical ways that it can go right, both with writing my book and laying out a series of containment strategies and things that we have to do in politics to improve our governance and regulation, but also in actually building and making Pi, which I think is hopefully going to continue to remain a very safe and controllable personal AI that can work for you.
Mustafa, thanks so much for coming in. Been a pleasure.
Thanks very much for having me. It's been great.
Toner, thank you so much for joining us. You're a director at Georgetown Center for Security and Emerging Technology, and you're also an OpenAI board member. Dan Wang, thank you so much for joining us. You're a visiting scholar at the Tsai China Center at Yale Law School, and you've been studying technology and China for many years now.
And we've just heard from Mustafa Suleyman, and he thinks that China's emerged as one of the biggest contenders in AI. So Helen, I'm just curious to start with, do you think we're overestimating China's capabilities?
It's certainly true that they're a big player. And it's also true that we shouldn't underestimate them and that we have a bit of a history of underestimating China's ability to innovate. I mean, I think 10, 15 years ago, the story, at least in Washington, D.C., where I'm based, was, yeah, China can't innovate. If they're producing things that look like new technology, it's because they've stolen them. I think that's clearly no longer true. At the same time, I think it's also very possible to overestimate them. And sometimes I think I see that as well. So are they a serious competitor? Yes. Are they eating our lunch? No.
So that copycat culture, it's fair to say that most people are thinking, we're past that stage. Dan, what do you think of that?
Well, I think it's certainly the case that China focuses on different things. So President Xi Jinping is, I think, a little bit less enamored with the internet platforms, with a lot of the cryptocurrencies, with a lot of the AI businesses that Silicon Valley specializes. He's also a little bit less enamored of Wall Street and financialization and hedge funds. And if I had to think about what Xi's broad views are, it would be much closer to being something like capitalism with German characteristics, which is much more about building cars, building hydraulic pumps, building heavy machinery, the heavier the better, about all sorts of these major industrial projects. And I think China is very much a leader in things that include electric vehicle batteries now, solar photovoltaics. It is making a lot of electronics products, and it is innovating on a huge sort of a lot of the automotive supply chain. But I think they have a little bit less of a focus on AI, and therefore there is not so much political direction anymore to really push forward these consumer applications.
I think it's fair, though, that some of those areas, the US is also innovating very, very strongly. So are there any areas where China is innovating significantly better than the US?
Well, I would say something like electric vehicle batteries, where China has something like the 70% of all global expansion, all global capacity of electric vehicle batteries is now mostly in China. When it comes to the clean technology supply chain, again, these very industrial projects, these pieces of heavy machinery, that is a little bit more the focus. I think the U.S. is really strong in things that include semiconductors, artificial intelligence, biotechnology. These are things, the smaller things, where China is not so good, but there are big areas in which China is way outbuilding the U.S.
I mean, the semiconductors is getting significantly better in China. I mean, partly maybe as a result of the Huawei issue. Helen, what's your view on the semiconductor side of this?
So China's definitely been investing for decades in trying to have their own independent semiconductor supply chain, and they've been making some progress. The thing to know about semiconductors is there's a huge range of sophistication, from the really basic semiconductors, computer chips that go in basic devices, your smart fridge, your car, up to the kind of more advanced chips that might go in a brand new iPhone, up to very advanced chips that go in kind of the data centers, gigantic warehouses full of computing, which is what you're training advanced AI systems on. So China has made a lot of progress on the more basic end of the semiconductor sort of scale, and is still really struggling to hit the most advanced end. And that's where, it's not even, you can't even say the US is, alone able to create those advanced semiconductors, but what you have is an incredibly advanced global supply chain.
Many describe artificial intelligence and its development across these two superpowers as an arms race. Is that framework misguided, do you think?
I think it's a bit misguided. I think you really want to look at what kind of AI are we talking about, and in what way might it be a race. I think the place where it's clearest that it makes sense to think in a competitive framework is in kind of military domains. So, it's just true that the US military really wants to make sure that it is keeping pace with, and ideally a little ahead of, the Chinese, or a lot ahead of the Chinese military in terms of what technology they have.
Dan, Washington has taken some steps to curtail some of China's ability to get their hands on the cutting edge chips that really power these AI platforms. What's your take on that? Is that an effective strategy, or will China just find a way to build their own?
I think that China is going to try to figure out a lot of the way to build their own. A lot of the chip makers now have been under very significant stress from U.S. sanctions dating back to about a year ago now, released by the Biden administration, that is really stopping their ability to access not just the high-end chips, but also the semiconductor production equipment as well.
And I think in general, it's really difficult to distinguish between what kinds of technologies should the U.S. really not want China to be able to develop, and where is it fine. So, you mentioned, clean technologies before, where China, if you're looking at, manufacturing solar panels, as you mentioned, EV batteries, a lot of other areas, China is doing amazingly at that. And what you're starting to hear in some, U.S. policymaking circles is that maybe that's a bad thing, that China is making a lot of kind of clean technology stuff. And I find that a little sort of tricky to reckon with, is at what point do we want to really shut them out or prevent them from being, able to manufacture anything if it's something good, useful that we can use. Of course, if it's technologies that we think have really significant military value, I understand, but then it starts, the lines between those categories start to get very, very blurred.
It seems like these tensions are just ratcheting it up even higher as time goes on. With each administration, they're intensifying. So to your point, if we do need these other technologies, solar technology for this transition into a greener future, what kind of happens next? How much do we place on kind of the AI arms race that could then potentially work against us in climate change? Is that a concern, or is that too far in the future still?
Well, a few months ago, Beijing did announce some export controls on certain solar technologies involved in making production wafers.
So it's already happening.
It is already happening, that there are some threats out there that, relatively speaking, Beijing has been pretty restrained against retaliating against American companies of the likes of Intel, of the likes of Tesla so far, but these things could escalate more.
how does the relationship between, the ruling party in China play out against the kind of the development of companies?
I think the Chinese system is definitely more top-down when it comes to AI development. You see less kind of individual tech companies like OpenAI or Google taking the lead, and more these kind of multi-institution partnerships, or maybe you have a university and a tech company and a government, department all collaborating on big AI projects. That's much more common in China. At the same time, China is a huge country, so there's a limit to how much the government can achieve from the top. So a lot of what you see is sort of Beijing providing direction, providing ideas, providing sort of signaling of this is what we in the central government would be excited about.
Dan, how would you compare how the Chinese government is handling AI with its people versus how they handled social media?
Well, I think President Xi Jinping doesn't necessarily view AI right now, a lot of these ChatGPT-like applications, as some of the most economically productive things that are coming into our society. So I think that President Xi looks much more at AI like he would at Facebook or Twitter, now known as X or whatever it is. These are platforms like TikTok that, if you're asking me, is something like TikTok or Facebook really increasing my personal productivity? Well, I would say actually it is really horribly detracting from my productivity. And so I think that a lot of these AI platforms right now create speech issues. When an ordinary Chinese person sitting in Beijing or Shanghai asks AI, well, what happened in 1989? Well, what do you think of socialism? What do you think of President Xi's performance? These AI tools are having a lot of challenges actually answering socialist correct values that are in line with the government's ideas. And so these are major speech platforms, first and foremost, and perhaps not really the economically miraculous thing that raises our productivity growth at the very moment. Now, it might happen later on. Right now, I think the party views it as somewhere between economically not that useful and potentially very socially destabilizing.
So from a consumer standpoint, AI is almost, it can potentially create more problems for the Chinese Communist Party. But then if you look at it from like a surveillance standpoint or military type of AI applications, that's kind of in a different camp. Is that right?
Yeah, that's right. And I think they're definitely, one area where China is, I would say, leading in AI is on surveillance. They really have leaned hard into facial recognition, voice recognition, even gait recognition. So how you walk in a crowd, can they pick you out by that? I think in the West, there's been some development of these technologies, but with a lot of criticism from civil society, a lot of hesitation, sort of, I would say, like very yellow light. And in China, it's been blaring green light.
On the topic of WeChat, when we spoke ahead of this, I think we touched on the fact that there are some generalized misunderstandings about China's approach to social media and data and AI. AI relying on huge amounts of data, and the perception is that because of things like WeChat and similar things in China, that there's this huge pool of data that the population in China is very happy giving over and is used to giving over, and therefore is just sitting around waiting to be exploited by AI. And I remember that you made a pretty significant point. It's like, that's probably not really the case. And people think that's the case, but it isn't. So I wonder if you could touch on that.
Yeah, I think people have this perception that because the Chinese government is very controlling and has a lot of access to what's going on in Chinese citizens' private lives, that means that there's these beautifully curated, extremely complete, large databases of information that can be used to train AI systems or to do other things. But for anyone who's ever worked with data, you know that cleaning data, structuring data, making sure that the right information is flowing in the right places is incredibly challenging. So it's both true that the Chinese government can get very detailed information on the private lives of its citizens if it chooses to, and also true that it's incredibly messy the way that works, and incredibly difficult for any given actor to get access to something. So, for instance, a company trying to train some AI model using data is actually subject to a pretty significant data governance setup in China, data governance regulations that make it really challenging to use customers' data for things it wasn't already designed for, or that you didn't already get consent for.
Which we learned from Cambridge Analytica scandal just as one case, and there are many others. That is not the case in the US. It's
That's
not
right.
the case in Europe. There's a lot going on. The EU's AI Act is pretty widely praised by some people, not everybody, but it's quite broad and far-reaching. But that's not the case in China. in terms of what you're saying?
So China's setup is now more similar to the GDPR that exists in Europe. So around kind of protecting consumer data and giving people the right to, opt in to different uses. Of course, in China, there's always the exception, unless the security services, think that you might be a dissident, and then they're going to get whatever they want on you. But in terms of kind of companies, they're certainly relatively restricted in what they can do.
Switching gears a little bit, Dan, I'm curious about how China's sluggish economic growth recently weighs into the government's calculus and how they're thinking about AI's potential to spark social unrest.
I think that the Communist Party is very much involved in trying to think about, how to control possible social unrest. I was in Shanghai in November 2022 when there were protests in the streets denouncing zero COVID, denouncing the Communist Party by name, that these were things that were erupting. And so I very much sign on to Helen's description of AI, that China is leading in the AI of censorship. It is leading in the AI of facial recognition. That right now it looks very much like the US is a place where ordinary consumers can tinker with and play around on a lot of these AI tools, whereas in China is mostly reserving these very powerful tools for its own use, potentially to control society. That right now China is in a moment of economic weakness. This might deteriorate further, this might get a little bit better, but there is always this presence hovering over there that the state security might ramp up its technology really to make sure that there are no socially destabilizing incidents.
Well, Helen, Dan, thank you so much for being here. It's been great to learn from the both of you.
Thanks so much.
Thank you very much.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Markets regain footing. Stocks stabilize after the AI-led tech sell-off. Chip stocks edge higher as investors weigh AI spending against valuation concerns. Jobs slow down. Softer U.S. hiring eases rate hike fears, lifting the Dow to a record while short-term treasuries end the week with lower yields. And President Trump doubling down on efforts to fire Fed Governor Lisa Cook and make way for his own pick. Sources say former chair Jay Powell also remains a White House target. It's just gone 8 a.m. across the Emirates. I'm Abir Abu Omar in Dubai. Happy Friday and a happy day indeed for stocks this morning. We got green across the screen. Now, worthy to note that it is a public holiday ahead of the 4th of July weekend in the United States. But U.S. futures are tilting higher this morning, 0.3% higher. That follows a completely flat close in the S&P 500 yesterday. The payroll data, the jobs data came in lower than expected yesterday. But that news that spread positivity in U.S. stocks was offset by the tech rout that was continuing to happen. We're looking at individual names, namely Tesla, which had a sales beat when it came to its vehicle sales yesterday, though investors didn't seem very happy about that news, especially with no clear guidance for its AI and robotics business. We're also taking a look at Asian equities, 1.4% higher, reversing an earlier loss in the morning. The Kospi in South Korea is gaining. Samsung, the biggest constituent there, is also gaining on this tie-up on a custom AI chip with Anthropic. So we're seeing sentiment returning after the tech rout across global equities. And Brent crude prices also gaining slightly this morning, $72 a barrel. We continue to obviously monitor the movement of ships and tankers in the Strait of Hormuz, but also those that are stuck in the Strait of Hormuz with no one to buy. We'll talk a little bit more about that story in just a few minutes. And cash trading on U.S. Treasuries is closed today for the public holiday, but we're taking a look at other commodities, namely gold, which is above the $4,000 an ounce mark. It's gaining today. This is the third straight gain in 3 straight days. But for some of the movements we're seeing in Asian equities this morning, we've got Avril Hong in Singapore for us. Avril, what do you have for us?
Yeah, Bia, it's been a really choppy day for Asia stocks. Started on the back foot somewhat. Nikkei, Kospi between swings and losses, gains and losses, I should say. But you're seeing a bit more green coming through and tracking, I guess, the S&P 500 futures, a bit of a brighter mood. And you're seeing the likes of Samsung leading the pack on the back of reporting on the information that Anthropic is looking at them for its own AI chips. But you are also still, I guess, in the midst of this debate among investors. How much AI build-out is really necessary? And are we reaching the sort of peaks in the memory cycle? So that's the undercurrent. And even though you are seeing that bit of a bounce in Samsung, note this is after 2 days of heavy selling. You're seeing the TAIEX also still weak. Now, tracking as well what we're seeing on dollar-yen, we did see that pullback and the greenback. So that's a bit of a boost there. And in the sense of Katayama talking dollar-yen below the 161 handle very briefly, I think what investors might want to see more of is follow through when it comes to the Japanese currency going forward.
All right, Avril, thank you for those details. Now, wider stocks are on the rebound along with gold and U.S. and Europe futures following a volatile start of trade in Asia. That is after U.S. hiring slowed sharply in June, prompting traders to trim bets on Fed rate hikes. Here's what our guests on Bloomberg TV thought of the print.
It tells you the labor market is fine. There's no real concern, certainly no urgency for the Fed to be hiking, and that buys them time.
I think this is a great report for Kevin Warsh. I think it's a good report for the bond market.
Today's report is going to keep their focus squarely on inflation.
The labor market has proved to all of us in the last 6 months that it is more resilient, even with today's numbers.
You've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay.
This is a very fragile labor market. We have very low hiring, but low firing.
Now, to discuss this further, joining us now is Rajiv Sabal, Morgan Stanley Senior Global Economist. Rajiv, good to have you on again ahead of your holiday. It's summertime. Let's talk about the print we saw yesterday from the U.S., it kind of discounted the prospects of a rate hike, at least in July. But how do you think the Fed now gets to achieve its dual mandate, especially with sticky inflation?
So the print yesterday was very much in line with our expectations. We saw not only the low print versus consensus and actually closer to the Morgan Stanley forecast yesterday, but the revisions backwards. And the 3-month moving average is just above 100,000. The 6-month moving average is just below 100,000. And in that environment, it's very much in line with a kind of gradually recovering labor market, which has been our forecast for 2026. And so we think, given the stability in the labor market, the real focus needs to be on inflation. And this is where I think our view is a little bit different to the market. The market is still pricing a rate hike in December. We think it comes next year. A rate cut. The market is pricing a rate hike in December. We think a rate cut is coming next year. And the reason is that we think inflation is moving in the right direction, and it will be more clear by the fourth quarter. And so we need to see the inflation prints come through. So I think the labor market data allows us to really focus on inflation.
Rajiv, President Trump was talking to CNBC earlier, and I just got to quote him here. He said that there is this horrible derangement syndrome about inflation. We also spoke to National Economic Council Director Kevin Hassett yesterday, and he told us that the Fed still has those people that decided to cut rates ahead of President Trump's election or ahead of his presidency this time around. Just have a listen to what he had to say.
We think that the previous version of the Fed had made a bunch of moves that looked to us to be partisan. And a lot of the people who decided to cut rates right ahead of the last election, to raise rates the minute that Donald Trump was inaugurated, a lot of those people are still around.
So he was talking about essentially how the people, including Jerome Powell, are still part of the Federal Reserve, and those are the people that went against what President Trump had essentially wanted them to do. My question to you is that when it comes to Kevin Warsh and what he decides to do going forward, do you think that, we heard in the beginning, or we heard his first meeting as Fed chair was kind of in line with markets during Centra this week. He was giving a little comfort signals to the market. Do you think we're going to start seeing a more dovish Kevin Warsh going forward?
I think Kevin Warsh is going to follow the data, and we are very much of the view that Kevin alone cannot change the policy. You have to have the committee. You have to have the committee votes. And so what we've seen over the past few weeks is, past few meetings, is a few dissents, and then those dissents went away in the last meeting when there was cohesion on the board. And we think that cohesion remains as long as we follow the data. And that's why I, was so focused on the inflation data over the next few months, is that we do see a disinflation path forward, and that would, in our forecast, allow the Fed to cut rates. And so we do think the market needs to pay attention to the data. I think there's going to be a lot of volatility in these next few meetings, just because the style of communication has changed. This is pretty normal when we have a new Fed chair. But we don't look much beyond that. And Kevin Warsh's comments at Sintra yesterday gave us some confidence in our forecast. He highlighted how break-evens had moved lower after kind of the dissipation of the oil crisis. And that should help support the lower inflation, which could allow a path for rate cuts later this year or early next year.
Okay. And just speaking of the volatility, what we've been seeing in global equities, but certainly in the United States, do you think what we're seeing is a healthy correction, or is this the start of something a little bit more sinister?
So, I think the volatility in the rates market is, like I said, part of the new Fed chair. I think the data has been very strong in terms of payrolls and in terms of inflation. The market rightfully is challenging whether or not the path is the way that Morgan Stanley is forecasting, which is a little bit softer in the second half of the year. We need to see the data prints come through. So that volatility is probably going to remain for a few more prints, and at least through the summer. I'm focused on Jackson Hole to see a catalyst in terms of reshaping some of the narrative. Because after Jackson Hole, you're past a lot of the catalysts that we have over the summer, whether it's tariffs, passing through oil, and AI coming into the inflation picture. So all of these will become clear over the data that we get in the next couple months, I think.
Okay, and away from Jackson Hole and the United States, we've been watching the yen. I'm just saying, you look at the levels now, actually at 161 against the dollar. Do you think there's a risk of another intervention, and would it be meaningful if it happens?
So I think the ministry is talking about intervening, and I think the Bank of Japan is actually holding firm and focusing on the data. Our view is that the Bank of Japan will have a live meeting in October, or maybe later in the year, that they'll be on hold for a couple more meetings, and that puts the ministry in the predicament where they have to decide. But the Fed data, the non-farm data, the Fed inflation path, if that releases, I think it helps release some of the pressure on the yen. And that's what we need to be focused on, I think, over the next few weeks.
All right. So we're keeping an eye on that and the impact on the yen then. Rajiv, thank you as always for your time. Rajiv Sabal, Morgan Stanley Senior Global Economist, with all the details on markets. Now, coming up, Iran struggles to find a buyer for its oil before the expiry of a 60-day window granted by the United States. We'll have more on that story next. This is Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome back to Horizons Middle East and Africa. Iran has accumulated tens of millions of barrels of oil on ships at sea as it struggles to find buyers. More than 20 million barrels of Iranian crude have been idling in Asian waters for at least 7 days. Joining us now to discuss those stuck barrels is Rongwei Neo, Bloomberg's Asia oil trading reporter. Rongwei, thank you for being with us this morning. Why is Iran essentially struggling to find buyers for its oil?
Essentially, it's kind of like a double whammy for Iran sellers. Now, first things first, ahead of this U.S. waiver, of course, Iranian oil company has went out to try to procure buyers beyond just China, which is like the typical key customer group. So Iran has actually reached out to other Asian refiners in hopes that they'll be able to market their Iranian oil out to these major oil importers beyond just China here in Asia. But that hasn't seemed to have paid off so far. A lot of these Asian refiners outside of China are saying that the 60-day window is far too short, and there are a lot more complications than it seems. For instance, some of the state-owned companies in China and in India have been saying that their local banks are not financing such trades because it's unclear what would happen to these transactions after the 60-day window. And of course, many other buyers are also worried about things such as payment terms, and there's a lot of wide cascading compliance things, or rather challenges that could prop up beyond the 60-day window. And of course, if we look at China, which is Iran's key customer group. Ever since the war, demand has slumped in the country, even though it is the world's largest oil importer. So private refiners in China, which is Iran's key customers, all their refineries have been running slow because of poor domestic demand. And ahead of this war, or after this war, a lot of this lost domestic demand could never come back, as a lot of these Chinese consumers shift towards electrification in lieu of higher transport fuel prices in the country during this war.
Yeah. And Rongwei, just another exporter, Saudi Arabia, their crude oil exports through Hormuz have surged. What can you tell us about that?
Right, so we have determined that Saudi Arabia's oil exports is pretty much close to 90% of its pre-war levels. And of course, that's testament to the fact how fast the Gulf producers have been recovering since this interim peace deal has been agreed on by US and Iran. But of course, Saudi Arabia is one of the rare exceptions. During the war, they have solid workarounds, such as a pipeline leading to an alternative port outside of the Strait of Hormuz called Yanbu, where they have been actively exporting crude, even though the volumes are far fewer than what they typically export from inside the Gulf. But with traffic resuming through the Strait of Hormuz inside the Persian Gulf, and with that workaround outside of the Persian Gulf, all in all, Saudi Arabia's exports have hit close to 90% of its pre-war levels. Of course, its other Gulf neighbors are looking to catch up as well, and that will be an exciting topic that the OPEC producers should and hopefully tackle in the OPEC meeting this weekend.
Yeah, something they should also tackle or talk about tackling is this oversupply. We've heard major banks over the past week or so talk about an oversupply glut in the market by the end of this year. Do you think that that is too soon of an argument, that we have yet to permanently end this war between the U.S. and Iran, especially that we have yet to end this war between the U.S. and Iran?
So there are two sides of a coin to this oversupply that we're looking. One is, of course, the short-term supply, as the traffic through the Strait of Hormuz has gradually resumed since the interim peace deal. A lot of these stuck Middle Eastern oil cargoes that were booked before the war and were stuck in the Strait of Hormuz, they are all gushing out of the straits. So all of a sudden, Asian buyers here are inundated with a slew of backlog cargoes. And of course, that is just one side of the equation. Just on the spot market, it's evident we are seeing offers of Middle Eastern oil grades at prices that are perhaps more attractive than your typical heavily discounted Iranian crude to the Chinese buyers, for instance. Now, of course, that is just a short-term oversupply that we are seeing. Of course, maybe this oversupply may clear up in the months to come as Asian refiners ramp up their operations. But if we take the time, if we wind the clock back to the end of last year, before everything that has happened in the Middle East, generally global oil markets are on track for a general oversupply in the next few years because of overproduction from OPEC, as well as other producers that have been rising, such as in Latin America, the US itself, coupled with slowing demand. Yeah. So if you think about it, the Iran war perhaps just put a pause button on this oversupply complex. And now that this war is potentially out of the way, global oil markets is set to hit an oversupplied state in the next few years. But of course, everything would have to rest on the outcome of this US-Iran deal, whether we are seeing that this short-term glut is perhaps a preamble to the wider oversupply that we're seeing in global markets in the years to come, or if this peace deal takes a turn, perhaps this timeline would be extended.
All right. Perhaps a return to fundamentals there then. Rongwei Neo, Bloomberg's Asia oil trading reporter, thank you for your time. Now, Bloomberg has learned some leading European powers now accept that ships transiting through the Strait of Hormuz will have to pay fees to Iran and Oman. That is despite the United States and Gulf Arab countries insisting the nations cannot impose charges. For more on that story, we're now bringing in Patrick Sykes, Bloomberg's breaking news Middle East editor. Patrick, thank you for coming on this morning. What more do we know about this story and this acceptance that is happening behind the scenes about the tolls in the Strait of Hormuz?
Morning. Yeah, it really marks a shift from the, I think, assumption that ultimately navigation would go back to a free status of the kind we saw before the war, and that this demand from Iran that some kind of oversight, sovereignty over the strait and how it's managed was a negotiating position. Shifting from that to an acceptance, in principle at least, that there will have to be some kind of toll, fee, be it for navigation, for security, for safety, whatever it may be, and still at a level to be determined. Importantly, the report talks about this happening at the level of several European governments, but also within some Gulf states as well, that there's a growing consensus there as well that this would have to come in place.
And Patrick, this weekend we'll see the funeral of the former Supreme Leader Ali Khamenei. What can we expect out of that? Who's going? When does it commence?
Yeah, we're already expecting dignitaries from China and Russia, of course, key partners of Iran, both in the war and beyond, from areas from energy to defense. As for the organization, we know that the public element begins tomorrow with a kind of laying in state ceremony open to the public in the capital, Tehran. That'll continue for 2 days, and then we'll begin several multi-stage processions in Tehran, in the seminary city of Qom, in Iraq as well, in the neighboring holy cities of Najaf and Karbala. And finally, he'll be buried around the middle to the end of next week in his hometown of Mashhad. Iran is saying that there could be as many as 20 million mourners attending. That would, of course, be a huge number, but it's worth remembering the only other time that Iran has buried a supreme leader back in 1989. It, at the time, set a world record for the number of people attending. That, too, was in the millions. So I think expect Iran to do everything it can to draw out maximum crowds, and in turn to use that as a kind of show of strength for its status, for its place, the place of the Islamic Republic in the country following the war.
All right, Patrick Sykes, Bloomberg's breaking news Middle East editor, keeping an eye on those details and the funeral this weekend. Now, still ahead, JP Morgan is helping arrange debt financing to aid Syria's reconstruction. We'll bring you that story later. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's
a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Two private credit funds managed by Blue Owl Capital have again capped investor withdrawals after facing heavy redemption requests. Investors sought to withdraw nearly 19% of one fund and more than 38% of another during the second quarter. Blue Owl says most requests came from existing investors who had previously sought to redeem, adding that it has ample liquidity and does not need to sell loans to meet withdrawals. Anthropic is reportedly in talks with Samsung to make a custom AI chip. The information cites an unnamed source saying the AI startup is still determining the scale and scope of the processor and how it would fit into a server. Anthropic told the outlet its partnerships with Amazon, Google, and NVIDIA will remain central to its computing strategy. And SoftBank and its telecom unit will start renting AI computing resources in the U.S. using a growing pipeline of data centers to compete with the likes of CoreWeave and Nibius. SoftBank says the so-called NeoCloud venture plans to supply data center capacity for large-scale AI model training and interference. Now, coming up, we'll talk about the tech crowd in the market over the past couple of days. Stick around with us.
We are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel and energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with the debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Markets regain footing. Stocks stabilize after the AI-led tech sell-off. Chip stocks edge higher as investors weigh AI spending against valuation concerns. Jobs slow down. Softer U.S. hiring eases rate hike fears, lifting the Dow to a record while short-term treasuries end the week with lower yields. And President Trump doubling down on efforts to fire Fed Governor Lisa Cook and make way for his own pick. Sources say former Chair Jay Powell also remains a White House target. It's just gone 8:30 across the Emirates. I'm Abir Abu Omar in Dubai. We're still taking a look at where those equity markets are this morning and other commodities as well. U.S. futures continue to edge higher, 0.4% higher, rebound from the movement that we've been seeing across U.S. equities over the past week or so, although it is worthy to note that it's a public holiday in the United States today ahead of the 4th of July tomorrow. But what we're seeing today is, again, a rebound from movements we've seen over the past week, although the S&P 500 did close completely flat yesterday. The payroll data that came spread some positive sentiment, but it was completely offset by the continuation in the tech route. We continue to look at individual names in the Mac 7, Microsoft, but yesterday Tesla provided a beat sale, or a sale beat, when it came to its vehicle sales during the quarter. Though people were not excited about that, the stock did tumble in the aftermath, with Tesla not providing AI and robotics strategy looking forward. And so that happened yesterday. We continue to monitor the movement in Asian equities, 1.7% higher, led by the Kospi in South Korea. Again, individual stories there. The biggest constituent, Samsung, was gaining early in the session after the stocks about a tie-up with Anthropic to manufacture a custom AI chip. We're seeing in the MSCI Asia Pacific 2 shares rising for every 1 share declining this morning. Again, a reversal from earlier in the session. We obviously are in the Middle East and continue to monitor those oil prices. We spoke earlier in the show about those oil barrels from Iran stuck in Hormuz with no one to buy them. But the movement in the Strait of Hormuz still continues, about 15 million barrels or so making their way in total, not just through the Strait of Hormuz, but through other shipping routes. And cash trading on U.S. Treasuries is closed today, so we're keeping an eye on other commodities, namely gold, which is above $4,000 an ounce. Today it was edging below that level over the past week, but we're seeing a third straight session of gains for spot gold today. Now, for some of the movements that we're seeing in Asian equities this morning, we've got Avril Hong again in Singapore for us. Avril?
Yeah, we're looking at the session progressing and how, stocks are pulling ahead now, which is very interesting because things look more tentative in the early goings. And I think, to your point about those individual stories and Samsung in the green, that's helping to boost the Kospi. You also have the likes of Kioxia, right? Another memory maker that went from losses to gains on the back of news that it was shipping its next-gen chip samples. I think this speaks to, yes, we have this week those doubts about the AI build-out and the trade overall, but it's becoming more important to sift through the individual stories. You can't just look at AI as a, cohesive, broad trade for the moment. Look at the idiosyncratic plays and be more selective in that regard. That being said, keep in mind that this price action for the Kospi is coming after 2 sessions of decline, so maybe some bottom fishing is also underway, and investors overall maybe are feeling a bit more comfortable with taking the glass half full approach when it comes to the US jobs report, right? So that is also in focus as we look at dollar yen, of course, that has been on a bit of a ride. We are bracing potentially for some of these wild swings on the back of potential weekend or holiday intervention. Abir?
Avril, thank you for that detail. And now, speaking of that job report, a weaker than expected U.S. jobs report is shaping expectations for the Federal Reserve, easing concerns that policymakers will need to raise interest rates again this year. Joining me now to discuss those movements is Paul Dobson, Bloomberg Asia Markets Executive Editor. Paul, good to have you on. What's your read on the jobs data we got out of the United States yesterday?
Yeah, good morning, Abir. It's all working out beautifully for Fed Chair Kevin Warsh. You know, when he came to the Fed, he managed to convince the market very easily or with some authority that the Fed's intention was to get inflation back down to target, and the market responded in kind by bringing down long-term yields. The threat being that the Fed would raise interest rates if needed in order to control those inflation expectations. But what's actually happened now is we have this payrolls data, which is quite low, and that's eased off the pressure on the Fed to raise interest rates. So we saw a drop in short-term yields as a response to that. Market only pricing now a 20% chance of a hike this month. Some of those bets ebbing off again a little bit. And so that mechanically has weakened the dollar as well as a result. And it played relatively favorably to the equities market, especially for the sort of older world stocks, if you like, the Dow Jones being the gauge that performed the strongest in the US session.
And Paul, ahead of this data, there was a lot of talk about how it would have an impact on the Japanese currency. The yen, I'm taking a look at where it is now, 161.2 against the dollar. So the level has actually alleviated over the past day or so. What is the read there, and what is the read on an intervention, and if it will actually be helpful if it happens again?
Oh, okay. Lots of questions. That's good. So, you know, as I was saying, I said it worked out beautifully for Warsh. It worked out okay for the Japanese Ministry of Finance as well, because the need for them to intervene in order to control the losses on the yen is a little bit less pronounced today, given the fact that that payrolls data allowed the dollar to weaken, so it allowed the yen to push up off the lows. There is still the risk hanging over markets that the Japanese authorities may choose to give it an extra shunt to really push their message home, particularly during the US day when FX trading is going to be extremely light. You would get more bang for your buck doing that, but then again, maybe the market comes back quite aggressively in the aftermath of that as well. One way or the other, if we do have a trend starting to establish for a weaker dollar, then that would certainly help the Japanese authorities, because what we've seen in the past is when they have done those interventions, you know, it's bought them a little bit of time, but because of the longer and established trends that we have in FX, it has eroded again the value of the yen over time. I think the last thing to note is really what they need is for the Bank of Japan to start raising interest rates a little bit more aggressively, or some other measures that they can come up with to convince the market that they're serious about putting an end to the weakness in the currency.
And Paul, the Korean won starts 24-hour trading next week, I believe. What is the thinking from Korea there?
Yeah, so the market is quite excited about this because Korea hasn't done a full round-the-clock trading before. And part of the reason for that is when its FX markets were more open decades ago, it was struck by the Asia financial crisis, and that really wreaked a lot of havoc for the economy, and particularly because it stemmed from the currency market. There's been a lot of reluctance to really open that up again. So we've been taking baby steps towards this move for some time now. The concern is that in the night hours, liquidity will be quite low, and therefore there could be much more fluctuations within the won. But I think that there's confidence now building in Korean markets and in international involvement in Korean markets, and also now Korean companies planning to list overseas that will keep that two-way flow a little bit more dynamic, but also a little bit less likely to be moving up and down in kind of air pockets. So Korea's ultimate aim is to become recognized as a developed market. This would be one big step on the way if they can pull it off successfully.
All right. Bloomberg's Paul Dobson with all those market details. Now, semiconductor stocks are starting the third quarter with their worst two-day sell-off in nearly a month. The Philadelphia Stock Exchange Semiconductor Index, which is coming off its best quarter ever with an 88% advance, fell as much as 6% on Thursday. For more on that story, we're now joined by Richard Windsor, founder of Radio Free Mobile. Richard, thank you for your time this morning.
Good morning.
Over the past few days, the market has gone from rewarding AI spending to kind of punishing those big spending initiatives in those big names across hyperscalers and others as well. Are we seeing a valuation reset, do you think, or is this a start of something fundamentally different?
I think what's going on is you're seeing the stocks basically reacting to the potential for interest rate increases because, these are highly valued stocks. They've already run a long way. And so consequently, they're much, much more volatile than the average in the market. So when you see fluctuations in interest rate expectations, they're going to react more. Also, I think there's also a case to be made. There is a debate beginning to emerge in the industry about what is the real demand for AI infrastructure, which again, as one side of the debate wins or one side of the debate loses, you tend to see these wild swings. We're seeing a very good correction today, and I think again, as Mr. Dobson pointed out, I think it's it's about the interest rate expectations on highly volatile stocks more than any change in fundamentals that we've seen so far.
But recently, we've seen a sell-off in hyperscalers, semiconductor stocks, software. Previously in the year, you'd see one segment losing while other wins. Where do you think the market is pricing in where is the market making the biggest mistake in this sell-off, do you think?
Well, I think the mistake the market is making at the moment is to be worried about demand for AI compute. It is possible to interpret things like Meta's news about selling some of its capacity into the market as negative for demand. But then on the flip side of it is, if you look at the report that Micron put up, I think last week or the week before, if you look at the price that XAI is able to command for the compute that it has sold to both Anthropic and Google, these are not the actions or not the events that you would see where there is a market with excess supply. It's the actions where in a market where there is extreme a shortage of compute. And so from that side, I think I think at the moment, demand for compute, certainly for 2026, is going to be incredibly robust.
But then when it comes to those timelines, do you think there is a discrepancy between when the AI infrastructure versus AI profits will be delivered? Is that something that you think investors are starting to look at now and think maybe we're not going to see the same timelines we had expected earlier in the year?
They're certainly looking at it. And so, if you look at it from the point of view, this is why the semiconductor stocks have been so strong, is because you've seen the money move to the place where money is being made now, which is in the supply of capacity or components into the AI build-out. And I think that's one of the reasons why you've seen particularly the Mag 7 have struggled a little bit, is because most of these guys are the guys who are spending the money. So, while everyone else's cash flow on the semiconductor side is going up very strongly, their cash flow is going down very strongly because they're spending all the money. And that's why you've seen this sector rotation over the last 3 months or so.
And so, Richard, looking beyond the volatility we're seeing this week in particular, which part of the AI ecosystem do you think investors are materially underpricing or overpricing? Is it the chip makers? Is it the hyperscalers, the Max 7 you were talking about? Or is it the application layer? Or is it something completely different?
That is a very good question. And the answer is, I don't think any particular one sector is reflecting it more than any of the others. If you were going to call out one sector that is underpriced, it would have to be the software sector. The general view of the market is the software sector selling to the enterprise is dead because everyone's going to run AI and will no longer need to buy software. That's the view of the market, and the software sector has halved as a result of it. I think that's taking it too far. There are particular stocks within the software sector that I think will benefit from AI, and then consequently they're currently on sale at a great bargain. So if I was going to look for a sector that has unduly suffered because of the AI trade, that's where I would start.
Okay, so we keep an eye out on software then for the rest of the year. Richard Windsor, founder of Radio Free Mobile, thank you for your time this morning. Now, coming up, the UN says the Ebola outbreak could shave more than $1 billion from the Democratic Republic of Congo's economy. That is coming up next. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The UN says the Ebola outbreak could shave more than $1 billion from the Democratic Republic of Congo's economy and push almost 1 million more people into poverty. In a report published this week, the UN says the outbreak represents a complex development emergency that impacts livelihoods, education, food security, and trade. Our chief Africa correspondent, Jennifer Zapasaja, joins us now from Johannesburg. Jen, good to have you on. Can you fill us in on the details or the main takeaways from this assessment by the UN?
Yeah, of course, Abir. This was an assessment that we did get from the UNDP, as you were mentioning there. And specifically, we spoke to Ahuna Ezeakonwa, who dug in a bit deeper based on this assessment about what we're seeing right now. So you were talking a bit about some of those numbers there, which I think are worth pointing out. $1 billion is what some of these estimates are suggesting that it could cost the DRC, also potentially reducing economic output for the country by approximately 1.6%. The concern, though, isn't just confined to the DRC. It also could be regionally detrimental. Across many African countries, we could see between 2.37 billion and 3.6 billion losses, depending on more or any more supply chain or geopolitical shocks that we see. So that is sort of the financial costs. The concern, though, is that what does this look like moving forward? There could be job losses that could span as much as 55,000 in terms of jobs that are actually lost, 1 million more people pushed into poverty. And some of the real concern is how does this current outbreak and the fight against this current Ebola strain redirect resources away from what had previously been a focal point. And that, as the UN says, could potentially result in more than 2,000 additional infant-related deaths. So really quite a concern for not just the DRC, not just the region there, but really for the UN more broadly and some of the efforts that they've been making over the past few years to reduce some of these main issues for the continent and for humanity more broadly.
And so, Jen, when it comes to the Ebola outbreak, what is the latest on that in Africa?
Well, what we know at this point is this latest strain is still concentrated mainly in Ituri province in the DRC. We know that, it's still been a bit difficult to track exactly how far and wide-ranging these cases are. Right now, we know just about 440 people, though, are reported to have died between Congo and Uganda, though, as I mentioned, about 90% of confirmed cases are focused in Ituri province in the DRC. But a lot of the reports that we've been speaking about and been talking to people on the ground there, reports that health facilities are overcrowded. For example, we've heard about some reports that 60-bed treatment centers in places like Bunia are caring for people that are in upwards of 70 to 75 people. There's also concern that not all of these health officials actually have the PPE and what they need. And so there's still quite a bit of concern about what these officials are experiencing on the ground and how they're able to track and contain this outbreak.
All right. Jennifer Sapasadra, our Chief Africa correspondent in Johannesburg, on top of that story for us. Thank you. Now, coming up, JP Morgan is helping to arrange about $7 billion of debt financing to aid Syria's reconstruction. That story is coming up next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
JP Morgan is joining Gulf lenders to help arrange about $7 billion of debt financing for Qatari firms' projects in Syria. It marks one of the biggest foreign commitments to the country's reconstruction since dictator Bashar al-Assad was ousted by rebel forces. We're now joined by Bloomberg's Paul Wallace from Istanbul to talk to us more about the details there. Paul, good to have you on. Can you give us a little bit more clarity or details about this detail and how the reconstruction effort in Syria is progressing?
Hi, Abir. It is a pretty significant deal for Syria and its post-war reconstruction, and it's probably the biggest, single piece of FDI announced since former dictator Bashar al-Assad was ousted by rebel forces in late 2024. So Power International Holding, which is a Qatar-based entity run by billionaire brothers who originate from Syria, is taking on this loan of $7 billion, which at least in part will be used to help reconstruct the power sector in Syria, rebuild power plants and infrastructure all related to electricity, and also at least one airport. Now, the fact that the likes of JP Morgan is on this is also significant. And I think it speaks to the fact that Syria and its president, Ahmed al-Shara, has done a pretty good job of trying to sort of reintegrate with the West. Al-Shara himself has good relations with Donald Trump. And Trump would like to see American investment in Syria, as well as Gulf investment from the likes of the UAE and Qatar and Kuwait, and the Americans have removed a lot of the sanctions on Syria that existed under Assad. Syria is a country that was devastated by the war that ran from 2011 to when Assad was ousted in 2024, and its infrastructure is still in a dire state. So this kind of money, $7 billion, would should go a long way to helping fix that and getting the country back on sort of, let's say, the road to normality.
All right. Bloomberg's Paul Wallace keeping an eye out on all these stories in the region. Now, a quick look at where markets are. Equity futures in the United States still tilting higher, and oil prices also higher this morning as we continue to monitor the movement of ships in Hormuz. That's it for Horizons Middle East and Africa. I'm Abir Abu Omar in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Tom McKenzie with your top stories. Stocks bounce back after a tech-led sell-off as traders trim bets on Fed rate hikes after a frosty US jobs report. President Trump vows to push ahead with his bid to remove Fed Governor Lisa Cook. We reveal his allies are actively exploring ways to install Trump candidates in order to reshape the US central bank. And Bloomberg learns that some European countries have accepted that ships transiting the Strait of Hormuz will now have to pay fees to Iran and Oman. Let's get to the markets then. Quite the turnaround in the Asian session with the Kospi in focus. Very strong gains there. Across the benchmark in Asia, you're seeing upside right now of 1.8%. European futures pointing to gains of 0.4% after record highs on European stocks yesterday with gains of more than 1%. Nasdaq 100 futures pointing to upside of 0.9%. Of course, it's a holiday in the US today, but the futures picture for the reopen on Monday pointing to a solid session after the S&P ended flat with chip stocks again in the US under pressure. That narrative, though, seeming to shift in today's session. Let's flip the board and check in on some of the other asset classes with a focus, of course, continuing on the yen. Some relief then for the yen and for gold on the back of a weaker jobs number and a push out in trader expectations for the next Fed rate hike to October. Currently, Brent crude up 0.6%, $72 a barrel there. The Japanese yen currently largely unchanged. We've been hearing from the finance minister as well. 161 right now on a volatile week for the Japanese currency, but stability in the session today. Gold gaining then on expectations of less hiking from the Fed, 135, more than 1% gain right now for the yellow metal, above 4,000 and closing in on 4,200. Let's check in on the risk events for this Friday then. 7:45 a.m. UK time, we'll get French industrial production data, so giving some more details and more colour on the strength of the French economy. And from 8:15 a.m. UK time, we'll get European final June PMI data. 9:30 a.m. UK time, the BOE Decision Makers Panel Survey, as we think about next steps for the Bank of England as well. So happy Friday. Stocks in Asia are rebounding after a tech-led sell-off. Let's get an update with Avril Hong standing by in Singapore. Avril, what has happened? Where is your focus?
The focus is on this rebound that we're seeing intraday and on tech. I mean, it's quite remarkable. We went from losses to where we are now on the Kospi, and this is following on from 2 sessions of declines. I think maybe this speaks to there's some bottom fishing among Asia investors at a time where also maybe investors are taking this glass half full approach as they assess the US jobs report, because it's not just tech that is on the way up. You look at every sector on the MSCI Asia Pacific also in the green. Flip the board. Just raking through what we're seeing in some of the big movers today to give you a sense of the volatility as well. Samsung, SK Hynix, they were both at points in the session seeing red, and look at how things have popped. Almost 9% on these memory makers. It really speaks to, I think, also the volatility that's coming from these leveraged ETFs, and also on the likes of Kioxia, right? Declines earlier flipped to green now on the back of reporting that they have shipped their next-gen chips, samples at least, which gives you a sense also that as this AI debate rages on in the second half of the year, after what was a really good first half, traders maybe need to, work extra hard to keep on top of the incremental changes when it comes to the trade as it evolves. Now, flip the board again. As things are volatile, certainly we saw that also when it came to the Japanese yen. Some reprieve following on from the US jobs report, but we are also maybe bracing for some holiday intervention on a day where the Korea won is still on the back foot. And very interesting to keep track of this as well, because on Monday, the Korea won will start trading 24/7. So that's what we're seeing in the region today. Tom?
Okay, Amber Hong in Singapore, thank you very much indeed. Yeah, broader dollar weakness as well, a lift there for some of those EM and Asian currencies. As Amber was saying, Bloomberg Dollar Index right now down 0.1%. And tying that, of course, to what was happening on the jobs front, weaker than expected jobs data out of the US, then challenging expectations that the Fed will raise interest rates this year. Non-farm payrolls rose 57,000 last month, well below estimates. Kevin Hassett, director of the White House National Economic Council, says the picture is still positive.
I think this is a really strong, healthy job market, and that this was a little bit on the other side of expectation, but the trend over 3 or 4 months is consistent with our view that, again, that we were growing about 3% and that we're going to have a better second half of the year as those factories turn on the lights.
Let's bring in Paul Dobson, Bloomberg's executive editor for Asia markets. Paul, walk us through the market reaction to this data. Bad news, good news for the markets?
Yeah, good news for the market. Probably not as good as Kevin Hassett is expressing it in terms of the economy. And that's why the markets like it so much, because it takes that pressure off the Federal Reserve to raise interest rates anytime fast. Remember when Kevin Warsh came into his role as Fed chairman, he set out his stall very early. We want to get inflation back under control, bring it back down to target. The market already started to do the work for him, bringing down the inflation expectations in the market. Now this plays into his hands because it suggests that he won't actually need to go ahead raising interest rates, not with any urgency at the very least, in order to convince the market that inflation is coming back down. So what we saw is lower US yields, the pricing for a Fed hike this month down to 20%, the market not really expecting that to be a necessity anymore, and a weaker dollar. And that sort of followed through a little bit again into Asia's markets today too.
I wonder, Paul, to what extent that is the upside, that is the catalyst for the Asian gains that we're seeing. I mean, particularly in the Kospi, to what extent relief on rates out of the US is a catalyst for Asia?
It's definitely helpful, Tom. It certainly took a little bit of pressure off things, although, as April was explaining, when we started the day, it was certainly wobbly, so it wasn't clear-cut, okay, here we go again. The market's taken a little bit of time to find its confidence. It was a really ugly session for Asia yesterday. It was the worst day for SK Hynix since November 2008. Today, as you've seen, like a massive rebound again. So it's just extremely volatile when it comes to those technology companies, and particularly in South Korea. But I do think that the market will take heart from it, both on the stock side and also on the currency side. A little bit less pressure on the yen, a little bit less pressure on the won. For in terms of depreciation, with that dollar coming down, and that should be helpful for global risk appetite in general.
Paul Dobson, thank you very much indeed, Bloomberg's executive editor for Asia markets. Meanwhile, Bloomberg understands that US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. Top officials have been actively exploring ways to remove Fed governors to clear the way for the president's own picks. The Supreme Court blocking an attempt, of course, to fire Governor Lisa Cook, but she is still a target.
Get her off.
How would you do it at this point?
By winning the case. They sent it back, not based on the merits, they sent it back on process and procedure. So we'll start the process and we'll do perfect process and perfect procedure.
Let's bring in Bloomberg senior editor Balash Pensen with the details. Balash, what is driving Trump here? He's not giving up in his efforts to oust Cook then from the Fed.
Well, what's driving him, Tom, has been pretty clear since he came into office. He wants lower rates. And I think the biggest takeaway from this story, this excellent reporting from our colleagues in the U.S., is that if you thought that the political pressure on the Fed would abate with this Supreme Court decision and with the changeover in the leadership with Kevin Warsh coming in, think again, there will be more noise, more political pressure on the Fed. The White House, Trump and his allies are looking for ways they can influence the Fed. They can remold, change the leadership there. They will keep going after Lisa Cook. They will keep going after Jay Powell. They will try to install people who are more amenable to the way they see the economy and more likely to follow their policy preferences. So the biggest takeaway here is that there will be more pressure on the Fed from the White House.
Do we have any details in this reporting, any insights into who Trump's potential candidates are then for the future of this Fed?
We don't have names, but we have some ideas about the type of people they might target. So one area that they're looking at is these regional Feds, where they are looking for new candidates. The Atlanta Fed vacancy being the most imminent one. They're leaning on Secretary Bessent's network, and he's leading some of the search and tapping some of the people he has worked with to try to bring them into the fold. And we also heard that Kevin Warsh has a preference toward people coming from the world of business, some local leaders, some entrepreneurs who can help bring in perhaps a different perspective to the Fed. So as the search goes on, as the search expands, those are the types of people we are looking at here.
To what extent could this potentially, I mean, I guess we have to understand to what extent Fed Chair Kevin Warsh is on board with this. I mean, maybe Warsh just stays on the sidelines when it comes to this debate. Maybe he doesn't weigh in on this. But is there potential tension there?
Well, when Kevin Warsh was talking during the selection process, he sounded very much in lockstep with President Trump in terms of their preferences, in terms of his desire to bring rates lower. As we just heard, that might be becoming a little bit easier because of the way the U.S. economy is performing, or at least the risk of rate hikes has gone away. So as long as that's possible, I'm sure the two of them will get along just famously. But when it comes to central banks, it's often said that the institution itself shapes the leader as much as the other way around. And Fed chairmen do tend to be independent and do tend to be proud of the Fed's independence. So how much meddling, how much political influence he will be able to tolerate, that remains to be seen.
Balázs, thank you very much indeed. Balázs Pench with the details there on that continued pressure then on the Fed, in particular Lisa Cook and other governors, of course, from President Trump. Now, US futures are pointing higher, with the Nasdaq seen outperforming when markets return to trade on Monday. This after a Thursday session which saw chip stocks extend declines even as the Dow hit a fresh record. The SOX, the Philadelphia Semiconductors Index, down about 10%, a little over 10% in just 2 days. Obviously, the narrative has shifted somewhat in the Asian session, at least. Let's bring in Natalia Jefferich, Bloomberg US equities reporter, who I'm very pleased to say is joining us around the desk this morning. And Natalia, you look at the US equity space very closely. This is your forte. But there's some really interesting dynamics under the hood right now that we're seeing. Momentum has been so strong, but we've seen something of a rotation in the last few sessions in the US. Is that going to be sustained? What is driving that shift?
Yeah, so if we look at positioning, I think short term, especially when we look at tactical positioning across institutional investors, we see that exposure to momentum stocks have become so elevated and stretched. People are bullish on especially a long part of this basket, that when I spoke with sources, people keep telling me that people are just taking some profits ahead of July, August vacation time for many people. Hedge funds have posted really strong performance. So, for example, second quarter was the best quarter in history, according to Goldman Sachs Prime Brokerage data. Yes, they posted really huge returns, mainly global long-short hedge fund managers. Now, so we see this rotation. Momentum factor, if we look at FTW function on Bloomberg Terminal, which tracks all factors, momentum is the best performing factor. It's up by 28% year to date. Volatility factor is the worst performing. It's up by almost 6%. So yes, People are taking profits. And then the second part of that, when I look at data from hedge funds positioning, they started selling TMT stocks at a pretty, significant pace. I'm talking about June numbers, excuse me. So they sell TMT stocks and they rotate into cyclical stocks. So this is kind of, again, this rotation trade. And finally, of course, you guys, I'm sure, keep track of small caps. They really outperform the S&P 500. And this is AI infrastructure story, healthcare M&As. And investors were really short small cap stocks, so they covered positions.
Very interesting. And presumably a lower rates environment, or at least rates on hold, is good news for small caps. We'll see if that of course, continues. Some really interesting dynamics in terms of hyperscalers underperforming, for example, UK gilts as well. How does this all set us up then? The dynamics you're seeing, the shifts, at least the positioning from hedge funds for the second half?
Yeah, so it looks like maybe short term we may see some volatility as people rotate out of AI stocks, at least for maybe short term, but longer term, of course, everyone is bullish. Again, we'll look at earnings, BI stocks function on Bloomberg Terminal. We expect that for the second quarter, earnings for the S&P 500 will be at around 23%. It's, again, huge number. People are bullish, especially on technology stocks. And, of course, we keep an eye on retail traders because they are one of the biggest driving forces for the U.S. stock market. I don't track European retail traders, but in the U.S. they
Not as many of them.
Yeah, maybe everyone is buying U.S. stocks, but yes, households in the U.S. hold record cash balances. I'm citing data from Citadel Securities. Wow. So they still have money to deploy, and yes, they are really active. When I looked again at Citadel Securities data, May and June were record months for U.S. retail traders' activity. Volume in equity cash trading was about 65% higher versus 2025. So everyone is bullish. Again, they have more money to deploy.
Very interesting. Record cash on balance sheets for retail investors in the US. Really important insights. Natalia, thank you very much indeed. Of course, Bloomberg US equities reporter Natalia Kniechevich with the insights there. Still ahead, the pressure continues for private credit funds, meanwhile, as redemption requests pick up at some pace. We dig into that story with Aberdeen's Marianne Zangro. That is later, but first, the price of peace. Are fees to cross the Strait of Hormuz now inevitable? More on our scoop next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome back to Bloomberg Daybreak Europe. Now, Bloomberg has learned that some leading European powers now accept that ships transiting the Strait of Hormuz will have to pay fees to Iran and Oman. The US and Gulf Arab countries continue to insist that Iran and Oman cannot impose charges of any kind for the Hormuz Strait. Let's get more from Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar. Abir, why do some countries think that this is inevitable? We hear from the US consistently, particularly from the Secretary of State, Marco Rubio, there will be no fees imposed. So why European countries kind of resign to the idea that they will indeed have to face tolls and fees of some sort?
Good morning, Tom. Well, because Iran is adamant on that notion, despite the pushback that it's gotten from the United States, with, as you mentioned, Secretary of State Marco Rubio saying it is completely unacceptable that Iran would toll the Strait of Hormuz after the 60-day period. Well, now we're well into the negotiations, but once that is over in August. And the scoop that Bloomberg has, we reported yesterday that these EU nations and the Gulf Arab countries in the region seem to have succumbed to the fact that this might be just the new reality of how things are done once the MOU is signed and once, well, the MOU has been signed, once the permanent deal is reached between the United States and Iran. What we have heard from these EU officials is that they're asking Iran and Oman, which is the other partner in this mechanism, to just not discriminate against ships according to their nationalities. Gulf Arab countries are vehemently opposed to this notion of the Strait of Hormuz, where the majority of their shipments have been going through since over the past few decades. But behind closed doors, Tom, what we know is that they have even resigned to the fact that this might just be the new reality, because Iran, through multiple officials over the past few months, but certainly over the past few weeks, more adamantly has come across and said that it will toll the Strait of Hormuz, that there is just no question about whether it will do that or not, and that it will do it with or without the help of Oman. Now, Oman seems to be caught up in this because it controls the other side of the Strait of Hormuz. The Sultan of Oman had met with President Macron earlier in the week, and they both agreed that they should abide to maritime laws and that they should abide to the international waterway security. But then Iran seems to have suggested that it will do this again with or without the help of Oman. And so Oman is trying to be a mediator in all of this. But in a nutshell, these countries that have their shipments go through the Strait of Hormuz have just resigned themselves to the fact that we might be seeing a new paradigm of things being done in the Middle East and certainly in the waterway. And so they're studying how this could go forward going into the future, and essentially looking at other waterways that have these mechanisms playing in order.
Meanwhile, Abir, we're getting reports that Iran is struggling to find buyers for its oil after one of the biggest wins for Iran from the US, which is getting US permission, at least temporary, for a sanctions waiver to allow them to sell their oil on the international market. And yet they're struggling to find buyers. Why is that?
Yeah, so you saw a lot of Iranian officials coming across after this MOU signature and throughout the technical talks in Doha saying the oil sanctions have been lifted, the assets have been unblocked, and that was a win for Iran. But in reality, you're getting a lot of their oil barrels that have come across from the Kharg Island, the main export hub, stuck in the Strait of Hormuz. Multiple reasons for that. While the U.S. has removed those sanctions on Iran, a lot of countries, namely in the EU, still have their own existing sanctions. They can't buy Iranian oil. And then you have the story of the China demand on Iranian oil, and the fact that a lot of these countries that haven't had access to oil from the Strait of Hormuz over the past 2 months or so have to seek their own inventory and have to look at other sources of getting these oil barrels. And so you're seeing a lot of this movement in the Strait of Hormuz of these oil barrels, specifically from Iran, being stuck. But Tom, just something to bear in mind here. We have about 15 million barrels of oil making their way not only through the Strait of Hormuz, but through other shipping methods right now. And that compares to about 20 million barrels per day before the start of this war. So you're seeing the numbers really ticking up there to what we saw pre-war levels, bringing the average oil estimate for the remainder of the year to $60 to $65 a barrel, according to Citi. That is the latest estimate we had this morning.
Okay, Bloomberg's Abir Abu Omar in Dubai with that update for us. Abir, thank you. Coming up, we explore whether Cuba's economy, meanwhile, and its authoritarian government can survive the crippling US blockade that it currently faces. That is next. This is Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The US campaign against Cuba has been ramped up under President Trump. Bloomberg Originals explores what it means.
What's coming next for Cuba? Capture and kill is still an option?
I just can't tell you that. We've got options all over the map.
Perhaps no other nation epitomizes Cold War politics more than Cuba.
When you look for a country that's, let's say, punched above its weight on a global stage, Cuba should be on the list.
Cuba and the United States, by default of their geography, have always had some kind of economic relationship. When we had prohibition in the United States, Cuba became a haven for American tourists.
Cuba is just 90 miles south of Florida. It's in the heart of the Caribbean. It's been seen as kind of a strategic platform for U.S. rivals.
The U.S. has had a broad trade embargo on Cuba since shortly after the revolution in the 1960s.
Cuba is ruled by a single party, the Cuban Communist Party, and it controls the legislature, controls the military, controls all facets of society.
Socialismo o muerte. But the socialist idealism that birthed Cuba has ground to a halt, literally running out of gas.
There is a dire jet fuel shortage in Cuba as the U.S. is moving to cut off the country's oil supply.
Crippling blackouts and a teetering economy have sparked unrest on the island.
We have an unprecedented degree of suffering on the island.
The Trump administration has taken a hard line.
Cuba has always posed a national security threat.
Tonight, the Justice Department unsealing an indictment against former Cuban President Raul Castro.
Will Castro actually face this prosecution?
The message the indictment sends to the Cuban government is that the U.S. is serious.
Amid the upheaval, many are looking for change, and some see opportunity.
Realmente me gustaría que Cuba pudiera realizarse.
2 million plus Cubans that live abroad. They have a genuine desire to see their country prosper and the people prosper and move forward into a different direction.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Live from London, this is Bloomberg Daybreak Europe. Happy Friday, everyone. I'm Tom McKenzie with your top stories. Stocks bouncing back then after a tech-led sell-off as traders trim bets on Fed rate hikes after a frosty US jobs report. President Trump vows to push ahead with his bid to remove Fed Governor Lisa Cook. We reveal his allies are actively exploring ways to install Trump candidates in order to reshape the US central bank. And Bloomberg learns that some European countries have accepted that ships transiting the Strait of Hormuz will now have to pay fees to Iran and Oman. Let's get to the market action then, as we zero in on the upside coming through in Asia. Again, after the losses particularly focused on tech, semis and chips stateside, with the Nasdaq 100 closing lower. A big divergence, though, because the Dow Jones Index closed at record highs. The Nasdaq 100 closed lower by 1.6%. The S&P was essentially flat. Across Asia right now, a turnaround in sentiment. Gains of 1.8% across the benchmark. A lot of strength coming through for the Kospi this morning. European stocks futures then positioned to build on record highs of yesterday, pointing high by 0.3%. A strong session for European stocks on Thursday, and further upside flagged today in the futures story. Nasdaq 100 futures looking to add 0.9%. It is a US holiday, of course. Markets returning on Monday. Let's flip the board and check in on the currency space and oil. The Japanese yen has been in focus. We've been hearing from the finance ministry, of course, as well. And given it is a national holiday, there is speculation that maybe there is some intervention at play, though dollar weakness is supporting the yen right now and other Asian FX. 161 right now on the Japanese currency. Oil is up 0.6% at $72 a barrel on Brent. And gold is also getting a lift on expectations that maybe the Fed will be on hold for longer than had been expected. 1% higher, 1.4% higher right now, and closing in on 4,200 per troy ounce for the yellow metal. Time now for our front page news, starting with the Wall Street Journal, which says this year's job market is shaping up to be surprisingly stable. That's after non-farm payrolls, of course, came in weaker than expected. Nonetheless, the paper says the June data was underwhelming. Today's job market is much less concerning, it says, than it was 6 months ago. The FT, meanwhile, is leading on Andy Burnham, likely to be the next UK Prime Minister, of course, saying he will be disciplined with the country's public finances and will stick with Labour's manifesto promises on tax. And El País over in Spain saying that Spain has rediscovered its magic against Austria in the World Cup with a 3-0 and very convincing win to go through to the round of 16, where they will face neighbours Portugal. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go, DAYB Go on the terminal. Right, let's switch focus to what's happening more broadly in the markets, but also what's happening in private credit, because private credit managers are facing a relentless wave of redemption requests, with second quarter exit requests exceeding those of the prior quarter. With us this morning is Marianne Zengel, Aberdeen's Global Head of Multi-Asset and Alternative Investment Solutions. Marianne, we can ask you more broadly about what's happening in these markets, and we'll look ahead to the second half. But let's start on the private credit story, because Blue Owl and others, again, putting in place these blocks around redemption requests, very significant redemption requests. And so this story continues for private credit. Does this remain contained to the private credit space, or is there a broader risk from what we're seeing as investors try to pull funds from some of these vehicles?
It's great to be here and good to start with private credit, very topical. I think, what we've seen is a continuation of what we saw last quarter. You're seeing those redemption requests continue to remain high. But there's definitely a sense in the market that the gates are in place. They're being used. So this time around, we've seen everyone utilize those caps.
Which wasn't the case in the first quarter.
Which wasn't the case. So there was a little bit more uncertainty in that first quarter because some people did choose to pay above that 5%. This quarter, we haven't seen that.
And that's a healthy dynamic?
That is how these funds were intended to work and function, and that education around that functionality is playing out now. So whilst the redemptions still look high, and there are still issues around liquidity, I do think that this is a bit more of a normalization of what we're seeing now.
Okay, so normalization. Do you expect it to happen in Q3, Q4? Does it continue through to the end of the year? When does this start? When does this normalization get to a point where investors feel they've pulled enough, they've rebalanced enough?
Yeah.
I mean, there's lots of dynamics underplaying why you'd want to be moving funds out of some of these private credit vehicles, whether it's you're concerned about software or whether it's one of repositioning into other asset classes.
Yeah.
How do you see the story evolving? And do you, am I right in thinking you don't think this poses a broader risk to the broader markets?
No, definitely not a broader risk to the markets. I think, what you've seen, it's largely been a US-contained theme. We've seen a little bit of action in Europe, but not to the extent that we've seen in the US. And if you look at the Blue Owl figures, the biggest redemptions there are in their tech fund. And that is still a concern in the market, the softness around tech. And so you will continue to see pressures there. But a lot of the concerns around defaults, the loans that were written back in 2021, you've still got a little bit of time before they start to come up for maturity. So I do think that you'll continue to see redemption requests. But it will become a normal feature of that market, and my view is that we'll start to see it quieten down over the next few quarters.
Okay, so let's zoom out a little bit more to broadly what is happening in tech and how you think that story evolves in the second half, because we've seen hyperscalers underperforming and semiconductors perform very, very well, though even now the momentum trade around the chip stock story seems to be faltering. We've had a revival in the spirits today in South Korea, but after a pretty torrid session in the last 2 days in the US. How is this dynamic shifting? There's a broadening out, there's a rotation theme. Is the momentum trade ending as a factor for these markets? What is the dynamic that you think will be most prescient in the second half when it comes to tech?
So we think the rotation continues to happen. We think it's healthy. A little bit of correction in the market makes sense. The trades have become very concentrated. And we're seeing people pull out of the US and into Europe. We do think that will continue, but in the medium term, these stocks, the growth story behind that is solid and is supported. So whilst we'll see a bit more in the short term, in the longer term, that growth story holds up for us.
And the greater breadth benefits Europe. Europe is now, the Stoxx 600 is now just about year to date outperformed the S&P. Are we starting to see a revival of the optimism for European equities? Do European stocks provide some ballast in this rotation story?
Yes. It's interesting for Europe. We've had this conversation. It feels like, we had it just before the Iran war kicked off. There was that, rotation out of end of US exceptionalism. Is this the time? I mean, with the world, geopolitical story so uncertain, who knows what happens in a couple of weeks? But we do think that, this is a good time for European stocks.
How did you read the jobs data out of the US?
Look, I don't think it was as I can't remember the word you used earlier, but it wasn't as horrific.
Did I use the word horrific?
No,
but it was certainly weaker.
It was weaker.
Forecasts for about 110,000 thereabouts. We got 57,000. Yeah. But the unemployment rate's at 4.2, not 4.3.
Yes. So I think it's definitely a softer read through from that. Unemployment rate. We look through that given the fall in labour participation rate. We look at the 3-month rolling trend, and you saw that those numbers fell from 190 to 111,000. So, they're a big drop. But the jobs market is still adding jobs. So cooling, and does take the pressure off the Fed in terms of that rate rise that people were worried about and going into the second
How much
half.
does it take the pressure off the Fed? Does it mean they stay on hold through the rest of this year? Does it mean we can rule out a rate hike from the Fed this year?
So our view going into this, even ahead of this, was that inflation would cool and there wouldn't be a rate hike through the rest of the year. Nothing in this report obviously changes that view. The market obviously has taken a slightly different view, and there were rate hikes priced in for this year. But
well, it reinforces your view.
It absolutely reinforces our view that we won't see anything happen this year.
Do we get cuts in 2027 from the Fed?
We do think that we get cuts. 2027 is, 6 months out. So
6 months is a long time.
It's a long time exactly in the very geopolitical crazy world that we have right now.
Yeah. Okay. When it comes to the geopolitics and we think about what's happening in Iran, lower oil prices, I think this ties us back to the Europe story. Expectations from some houses that we're going to get a glut in terms of the oil story. Oil prices down, $72 a barrel or so on Brent. How much of that can we price into the kind of the earnings story for Europe as a benefit, or are we still facing the lagged effect of higher oil during the conflict and what that's going to do to European margins when it comes to earnings?
Yeah, look, I think this is going to be positive for earnings in Europe.
And that comes through in the next quarter, or do we have to wait for another quarter for that to come through, the positive impact of low oil?
I don't think we've yet seen that impact flow through to equities, and we've seen it very quickly happen in the oil price market. So we're still waiting for that to play out. What I think is an interesting theme, though, is with commodities softening, you've seen the price of industrial metals come down, and we think in terms of the longer structural growth trend in that market, this is a good time to be thinking about that space with electricity demand, with AI. The demand for metals such as copper will continue from here.
Okay.
So we're less focused on sort of the energy price and buying that, and more focused on buying metals at low and
interesting. So a window is open up for industrial
we think
metals.
So, yeah.
Okay, really interesting. Thanks so much for coming in bright and early this Friday. Really appreciate it with your take on these markets and private credit as well. Marianne Zangel, Global Head of Multi-Asset and Alternative Investment Solutions at Aberdeen. Now, some other corporate news for you today. QTS, the data center developer owned by Blackstone, is abandoning plans to build its portion of a huge data center in Virginia, handing victory to residents who have fought for years to topple the project. The planned site was on the edge of an historic Civil War battlefield, and sources say QTS executives decided that it wasn't worth pressing forward in court. President Trump says he believes Elon Musk will donate SpaceX stock to the Trump Accounts initiative for new investment accounts for children. Speaking in a CNBC interview, Trump said he congratulated Musk on the SpaceX IPO and that he has a good relationship with the tech trillionaire. And SoftBank and its telecom unit will start renting AI computing resources in the US using a growing pipeline of data centers to compete with the likes of CoreWeave and Nebius. SoftBank says the NeoCloud venture plans to supply data center capacity for large-scale AI model training and inference. It's joining a crowded field as concerns grow about potential overcapacity. Coming up fresh from Sintra, policymakers heads to a gathering that's been dubbed the French Davos with slightly different temperatures. We are live in Aix-en-Provence next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, the Aix-en-Provence Economic Conference kicks off today in France as central bankers and business leaders convene in the midst of a mixed outlook for Europe's economies. The forum comes straight after the ECB Sintra, of course, and the gathering there, and offers further opportunity to hear from Europe's monetary policymakers. Let's get more from Caroline Conat, who is in Aix-en-Provence for us, on the ground for us, Caroline. What can we expect to be discussed? What is top of mind for those gathering at the forum in Aix right now?
Tom, this is the last conference in Aix-en-Provence before the presidential elections that are going to happen in April and May of next year. And this conference is often dubbed the French Davos because you've got all these executives from the CAC 40, all these ministers gathering here discussing the outlook. And of course, what is on everybody's mind at the moment is France going to have a populist president next year? Is France going to have a far left or far right president in less than a year from now? The problem, of course, is that there is no clear successor at the moment to Emmanuel Macron, who cannot run again. And a few candidates who are officially declared already are actually here discussing in Aix-en-Provence today, such as Gabriel Attal and Edouard Philippe, both former prime ministers, both ambitioning to be this successor to Emmanuel Macron. And of course, another big issue here in Aix-en-Provence is the state of French public finances. We got the current Prime Minister, Sébastien Lecornu, who was doing the opening speech in Aix last night, and he warned again about the danger of not having a budget this fall for next year. And he warned again about the danger of not controlling the spiraling debt levels in France. In fact, debt has increased by more than 1.2 trillion euros under the decade of President Macron. Just for this year, if I give you one very striking example, the debt servicing costs of France are going to reach 75 billion euros. That's more than doubled what it was just 5 years ago. But of course, at the moment, none of the potential candidates, none of the potential successors to Emmanuel Macron want to put debt and deficits at the center of their campaign, given what happened to the two former prime ministers, Michel Barnier and François Bayrou, who were both ousted over the past couple of years over their plans to try and cut the deficits and control these debt levels.
Yeah, those debt servicing costs, stunning numbers, to your point, Caroline. What is the current state of the French economy? What is the outlook? I mean, particularly in light of and on the back of this Middle Eastern energy shock that we've seen?
Of course, the war in Iran has been also impacting the French economy. We got actually negative French growth in the first quarter, minus 0.1%. However, there was some kind of positive news this week with the French inflation, the latest CPI number for June actually at 2%, which is the ECB target, down from 2.8% in May. So perhaps this energy shock is currently being absorbed, but there is still a lot of sectors in the French economy that are rising prices, and that is impacting, of course, consumption and consumer confidence. These are some of the topics we're going to discuss here, of course, in Aix-en-Provence, as long as the performance and perhaps the volatility we're going to see over the next few months. We know that French stocks have been underperforming over the past couple of years since President Macron called snap elections back in 2024. And over the next few months, a lot of executives here do expect the volatility, especially on French bonds, to increase as we approach, of course, these French presidential elections next spring. These are some of the topics that are going to be discussed here in Aix. We expect Christine Lagarde, the ECB president, to speak today. We expect the Bank of England governor, Andrew Bailey, also here. And we're going to speak to one new central banker, Emmanuel Moulin, who took over as the Bank of France governor last month. And this is going to be his first exclusive interview on Bloomberg TV today. Tune in at 10:40 UK, that's 11:40 CET here in Aix-en-Provence.
Okay, excellent reporting for us. Caroline Cornell on the ground for us at Aix-en-Provence and that forum, of course. Coming up later from Aix, we have got that exclusive interview then with the new Bank of France Governor, Emmanuel Moulin, who joins Francine Lacqua for his first TV interview since taking office last month. That conversation at 10:20 a.m. UK time. Now, Japanese anime has become, it's quite the pivot, isn't it? Become a global entertainment powerhouse, attracting fans worldwide and billions of dollars in investment. Now, publishers are enlisting the country's trading houses to help tap an estimated $13 billion global market for licensed merchandise. Bloomberg's Sherry Ann reports.
Japanese anime's recent popularity has been off the charts. The sector has become a multi-billion-dollar global pillar, powered by hits such as Demon Slayer and One Piece. In fact, Netflix has invested hundreds of millions of dollars into licensing and producing anime for its streaming service, where more than half of its subscribers have tuned in. While the content has become easily accessible, there's a surprising gap: merchandise. It's left a high-margin market untapped by license holders. Growth has largely come from the U.S. market. It's expected to help anime-related goods generate $24 billion in sales by 2033. But retailers say Japanese companies are slow in launching products. Supply chain complexities, bureaucratic delays, content rights holders' complicated ownership structures are all partly to blame. But the mood is changing. As streaming giants like Netflix and Crunchyroll move to seize this untapped market, Japanese companies are also joining in. Trading house Marubeni is one of them, 10% owned by Berkshire Hathaway just in May. They have joined forces with major publisher Shogakukan.
Our strength at Marubeni is that we have had for years the infrastructure in place for distributing and selling goods abroad. On the other hand, Shogakukan has the IP content, and they keep creating them. So it's a win-win for both of us, and the reason for setting up this joint venture.
Founded in 2024, Magnet exports anime merchandise featuring titles such as Ranma 1/2 to Frieren Beyond Journey's End. It started shipments to the US in April. Marubeni is now setting its sights on the rest of the world.
We are aiming to expand this year to China, Taiwan, Hong Kong. We already have markets here, but we would like to expand further. After that, for this year, we have our aim set to Europe and the Middle East.
But it's not all smooth sailing. Evergreen titles such as Dragon Ball used to be enough to capture the zeitgeist, but now consumer tastes are growing increasingly niche. And with limited official licensed products, knockoffs remain popular.
Pirated goods are obviously a concern, especially with the increased use of AI. To fight the spread, we are trying to speed up the approval of official goods that will hopefully override the pirated ones.
Still, Marubeni is betting that demand for anime merchandise will continue to grow, and it's positioning itself to meet the hype. Sherry Ann, Bloomberg, Tokyo.
Well, for more on the trends, stories and people shaping Japan, look out for Sherry's new monthly newsletter, Tokyo Dispatch, which launches on Monday. Subscribers can sign up at bloomberg.com/newsletters. Plenty more coming up. Stay with us. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Let's run you through what we saw then on the jobs front yesterday with the non-farm payrolls, the jobs data out of the US coming in lower, far lower than the expectation. 57,000, the expectation, the forecast had been for around 100,000, 110,000 had been the numbers. We got 57,000 and we got revisions as well lower in the months prior, which suggests there is a bit of a cooling picture coming through for the labour market, and that saw traders pushing back expectations of a Fed hike. Talking of which, the expectations of a Fed hike in July are effectively dropping to zero. Markets and traders still pricing in about 30 basis points by the end of the year, but they are expecting not to come through until about October. And that provided some relief then to the equity markets, bonds and assets like gold. Let's flip the board and have a look at what's happening in tech, because the semi sold off again yesterday. Bit of revival in the Asian session, but the momentum trade is now in question. It's been so strong, starting to fade now. The opening trade is up next. This is Bloomberg.
Some people would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning, everybody. It is Friday the 3rd of July, to be specific, and this is what is on our agenda. Weak U.S. jobs data pushes out hike bets from the Fed, which most stocks seem to like. Trump's allies are doubling down on their efforts to reshape the Federal Reserve. And in the UK, Andy Burnham floats the idea of a warehouse tax, but still keeps quiet on key appointments.
Is a positive day for markets then, Anna? And maybe the Fed is part of that story and the weaker jobs number. Bad news on jobs, good news maybe in terms of your rate hike expectations being pushed out, as you said. The Kospi is rallying. It had been, and it's another volatile session for the Korean stocks story. It started off in negative territory, now with some really solid gains coming through for the South Korean index, up 5.5% after a challenging day again for a second straight day for the stocks story, the chip story, and the semi story, and the memory story in the US. European futures looking to add 0.4% after record highs for European stocks yesterday. The European benchmark, the Stoxx 600, is now outperforming year-to-date the S&P 500. Looking to add to that today, up 0.4. Nasdaq 100 futures, after losses of more than 1% yesterday, looking to rebound, pointing higher by 0.9% when US markets reopen, of course, on Monday. The countdown to the opening trade starts right now.
Welcome then to the programme. This is the opening trade. It's just gone 7 o'clock here in London. It is Friday, the 3rd of July. It is a public holiday in the United States. Happy quarter of a millennium to our viewers over in the US. Let's talk about these markets then, and then quite a fascinating day that we saw yesterday. No US trading today, Tom, so things are likely to be a little quieter. Who knows what happens in that context. But stocks seem to like what we got from non-farm payrolls. I say stocks, most stocks seem to like what we got from non-farm payrolls. The weakness, bad data being good for markets. This is not what the Fed wants to see, but that is what we seem to get. Then there's a conversation about whether this is a meaningful cooling in the labour market or just an economy that is not overheating, and the two could mean different things for stocks, of course. But then digging deeper, as you've just been pointing out, yes, the Dow was at a new high. Yeah. But does that matter when semiconductor stocks are suffering once again? And it's that rotation within stocks that is interesting.
That momentum, the momentum factor that's been so strong through this year, starting to fade. If you look at the Philadelphia stock index, the Philadelphia index of semiconductor stocks, down 2 straight days, losses of more than 10%. But again, the story around and the negativity around semis is certainly turning around in the session today in Korea. There were 2 key factors, it seems, for the markets yesterday. It was the Meta story around leasing out some of their data center capacity and maybe an overbuild. At least that was the concern. Factored in with the non-farm payrolls then coming in weaker than expected. Does this allow the Fed to stay on hold for longer than maybe some expected? And so you saw the small caps rallying on the back of that. You saw that record high for the Dow Jones Industrial Index. So to what extent, and again, just to underscore the fact that European stocks have now outperformed the S&P 500, record highs for European stocks, is that the place where investors want to be, in a place where breadth and rotation if that becomes sustained, does Europe benefit from
Yes, and Europe is benefiting from that rotation at the moment. Some of that outperformance, of course, comes from the beginning of the year before the war started. And so interesting to see what's been happening since the beginning of March as well, and whether we've closed that gap with the States since there. But it's interesting, you mentioned the Meta story. I wonder about this Anthropic story, the information reporting that they're talking to Samsung, and all of this fast-flowing news and fast reshaping of relationships between tech companies just reminds us how fast things are moving, how quickly the technology is changing, and therefore how difficult it is, I suppose, from a macro top-down level to get a sense of what is happening here in these markets.
It's more granular, it's more nuanced, and it's requiring a lot of research and a lot of deep diving coming through from analysts trying to understand the trends as the AI story really starts to evolve and mature, but becomes far more complicated across whether it's the semiconductor space, whether it's the data centers, or whether it's the hyperscalers. Let's talk then about the macro. So we talked about what's happening in terms of non-farm payrolls, and maybe that leads to the Fed staying on hold for longer. The Bloomberg reporting around, and we heard this from the president himself as well in the last 12 hours, 24 hours or so, that this is a Trump administration that remains determined to reshape the Federal Reserve essentially in Trump's image. That they're not going to let go of their attempts after the Supreme Court ruling put some kind of ring fence around the Federal Reserve and also allowed Lisa Cook to stay in her role, at least for now. This is not a Trump administration that's giving up either on their pursuit of pushing out Lisa Cook and Jay Powell, but also changing how and who is appointed as governors. And so this is a Trump administration that continues to want to reshape the Fed.
Yeah, absolutely. So some people are pointing to, yes, the Supreme Court ruling put that ring fence around the Fed, separated it out from other agencies, suggesting it has more independence. So you can point to that, reinforcing the independence view. But some are pointing to the fact that it was quite a narrow decision around Lisa Cook, and therefore does leave some wiggle room for the Trump administration to continue its efforts to reshape the Fed. And as you say, President Trump himself talking about, we're going to do this properly then, we're going to do this with process, but they're still pursuing that. And then on Powell, it had been more normal for Fed chairs to leave once their term as chair had ended, but Powell said he was staying because of the legal fight. It looks as if this month we're going to get another report on the exact status of the investigation that's been going on there, even though the DOJ has backed away somewhat. So maybe there's some room and we might get some news flow around that. But interesting, yes, the big picture is that the Trump administration is still trying to reshape things here, and the Atlanta Fed chair, that seat is still empty, and so they see that perhaps as an opportunity to reshape.
We started this week thinking about a reinforced Fed independence narrative. Kevin Walsh had come out and said, I'm committed to that 2% inflation target. Tick in the box for independence. And then you had the Supreme Court ruling. And now that agenda, or at least that narrative, has shifted.
Yes.
Is this still, and will this still, be a Fed that is truly independent? And what does that mean for US assets? And that draws that back into question.
And Kevin Walsh, in the middle of the week as well, reiterating the importance of Fed independence. But it is something that will no doubt be a conversation for, I predict, for many days of the Trump presidency. Let us talk about what's going on in the UK and UK politics, because, again, this is interesting. So Andy Burnham, who, of course, is not Prime Minister yet, but he is certainly the front runner to become the Prime Minister in the UK. He has been talking to radio in the UK and suggesting that there is some room for manoeuvre around taxation within the mandate that is given to the party by the most recent election. So specifically, increasing business rates on warehouse companies. So we'll watch some of those, because some of those are listed in the FTSE 100. He name-checked Amazon, but there are UK-based businesses that do this as well. And he wants to pivot then, so take some money off there and then give it to smaller businesses and support pubs and the like with lower business rates. So maybe it gives us a sense, even though we don't have key appointments from Andy Burnham, it does give us maybe some sense of where the business agenda is heading.
I mean, one way to read this is just what the limited room for manoeuvre is when you're talking about warehouse taxes and cuts to tax on the high street. Number two, another way to read it is the high street is a real issue for people, and the deterioration of high streets. And so the fact he's focusing on that does tap into something that is real. And number three, potentially, is, OK, if you're name-checking Amazon, this is already a Prime Minister in waiting, essentially, who the Trump administration, President Trump himself, has said is very left-wing. If you start slapping taxes, it looks like you're targeting big tech, then maybe it puts another target on your back as the incoming UK Prime Minister from the Trump administration's perspective.
You mentioned those things. There's another dimension. It also tells you just how long it takes to cushion an economy that is dealing with fast-changing technology. Because talking about helping the high street. I mean, we've had internet shopping in this country for a very, very, very long time. And these are businesses, not pubs, that's a different story. But some of these businesses are still having to reinvent themselves in that age of online competition. And this is how long it takes for governments, of course, to try and help them out here. But we still don't have any key appointments. And I think that is important, even though it seemed pretty unlikely that he would give any key appointments, because that would just leave room for others to stand up to him, which is not what he wants before he's actually confirmed.
No, maybe he's going to be in the pub at 1 a.m. on Monday.
Maybe.
Because the current Prime Minister...
I feel I need to know this for the purposes of Monday's show.
That continues to be a debate. But the current Prime Minister has said pubs can stay open for the World Cup game then.
Until 5 in the
England
morning.
against Mexico.
Can we take a moment to think about what I like that this is a fun story, and I don't want to sap the fun out of it. No doubt it'll be good for pubs, and that is part of the GDP story. But what kind of productivity will the nation have on a Monday when the pubs have been open?
We may have to rewire our economic models.
We might have to rewire the anchor team. That's what we might have.
It also depends on the result, doesn't it, as well?
That's also true. Very much. Let's talk about what's coming up on the programme then. We digress. Let's tell you what's coming up on today's show. We will be in the Aix-en-Provence at the Aix-en-Provence Economic Conference in France. It's dubbed the French Davos, of course, the event convening central bankers, policymakers, business leaders, economists, the whole gamut of expertise to talk about European growth, inflation, interest rates, all of that in the context of what we've heard from Sintra already and what the business community is looking for in the investment community. So we will be hearing from Stéphane Boujna, the Euronext CEO. The listing environment is really interesting in Europe right now. Ludovic Sue-Brown will also be with us, the Allianz CIO.
Let's look ahead to what else we are watching throughout the day. As Anna mentioned, we will be following the Aix-en-Provence Economic Forum. The BOE's Bailey as well and ECB's Lagarde will be speaking later today. It is, of course, US Independence Day holiday, marking 250 years, of course, of the US independence from the United Kingdom. At 9:30 a.m. UK time, it is the Decision Maker Panel Survey. Some more details coming through from the BOE's thinking the BOE survey, at least survey of CFOs that policymakers monitor closely to gauge risks around inflation persistence. And later, there will be an extended tender offer period for UniCredit and Commerzbank ending. That will end later today, of course, that attempt at a takeover by UniCredit of Commerzbank, and that period of time, at least, the clock is ticking down to that ending.
Semi-quincentennial, that's what you call 250 years.
Can you say that again?
Semi-quincentennial. I did have to write it down, though.
What a pro.
Because the chances of me remembering that are pretty small. Coming up on the programme, then, we'll also focus on private credit. Managers contend with a fresh wave of redemption requests from investors. We will discuss the risks ahead for that particular asset class. But plus, we will look at the stocks to watch, including Airbus, the European plane maker, delivering about 350 so far this year, despite supply chain challenges. And we will break down the US jobs data with Jordan Rochester, head of fixed strategy at Mizuho EMEA. What does that mean for the Fed? We will discuss that later. Later on this hour. Please do get in touch with us. Friday the 3rd of July, IB plus BBTV Go is the function to use on the Bloomberg terminal if you want to get in touch with the team that puts together this programme. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Welcome back to the programme. This is the opening trade, 15 minutes past 7 in London, and the European equity futures picture looks broadly positive. We're taking some of our lead out of the Asia playbook, where we see the MSCI Asia Pacific up by more than 2%. The daily shift in sentiment towards the technology space, as it comes to us from the Kospi, seems to be positive today. Then, so we're up by 6%. So we're feeling better about that, and that's in keeping with Nasdaq futures up 1%. No US trading today, but we will try and keep that in mind as we wind our way towards Monday.
Let's check in on what's happening, the sentiment on the ground, and see if that is reflected in Aix-en-Provence, where the economic conference convenes. Central bankers, policymakers, business leaders and economists, as the outlook for European growth, inflation and interest rates remains unsettled. Bloomberg's Caroline Cornat joins us from the event with a guest. Caroline.
And I'm here with one of the top executives here in Aix-en-Provence, the Euronext CEO, Stéphane Boujnah, in this very strange time when we were supposed to have this big IPO of KNDS, this defense company, and in the end, they're postponing it. So what does it mean? Is it impossible to IPO right now, Mr. Boujnah?
No, I mean, the aerospace and defense sector is booming. It's clear that the momentum towards more spending, more government spending more money for defense is there. It's not going to change. In this particular case, there was a sort of pause in the momentum of this particular sector with a comparable in Germany affected by a decision of the German government. That was a very moment thing. Clearly, KNDS is a great company. It makes a lot of sense for this Franco-German project to get listed. I would not say that in accordance to what the companies say, that it is postponed. There is just a pause to make sure that the markets adjust to what is happening to some comparables. But in reality, since the beginning of the year, when you look at the IPO on Euronext of Czechoslovak group, CSG, for more than 20 billion euro, the spin-off of Kongsberg Maritime, the project of Destinus to get listed in the Netherlands, Colt in the Czech Republic listing. I mean, there is a real momentum. Valuations are still high, and they are driven by the continuous spending and the continuous spending in Europe. Because what is really the defining factor is that European governments are buying Europeans, and European aerospace and defense players are exporting more than ever. So I have no doubt that it is going to remain a very dynamic sector.
A very dynamic sector, but still, when you're looking at IPOs at the moment, we're seeing in the US this big momentum for the tech sector, these mega IPOs coming up in the US. Does Europe have an execution problem when it comes to IPOs?
No, there is no execution problem in Europe. We have a good momentum of IPO. Mid-sized companies are listing. You should not consider that the mega tech IPOs that you are referring to, the SpaceX type of things, are the market. They are one-off type of events. They are very important to drive events type of investors. But the reality, the underlying fundamental substance of the economy is still extremely dynamic. And in Europe, we do have talents. Those talents do create very ambitious companies. Those ambitious companies scale up and go listing. So, I mean, you will be surprised by the momentum on tech IPOs in Europe in the coming months and years. I mean, we should not be blurred.
In Europe, who are you thinking of? Mistral,
well,
are they going to list this year?
I mean, I'm not the spokesperson of technology companies. You're asking me questions on the sector. I can tell you that there is no shortage of very ambitious companies that are raising, as we speak, private equity, and as we speak, are planning for exits in the markets to get to a much bigger scale. So Europe has talents, Europe has technology companies, Europe has a lot of savings. There's an increased participation of retail in tech IPOs in Europe. Things are changing, and let's not be blurred or misled by a few one-off events that are spectacular, but do not reflect what the market is doing.
Is that going to be boosted by the Capital Markets Union? Are we at a turning point there for the Capital Markets Union?
We are. I think one of the key events that are going to happen in the second part of the year is that for the first time for 10 years, there is a strong alignment between an ambitious European Commission under the leadership of Maria Luisa Albuquerque, the Portuguese Commission in charge of finance, the Parliament, which is super ambitious on delivering that saving and investment union under the leadership of Mr. Ferber from Germany and Aurore Laluc from France at the European Parliament Economic Committee, and what is unprecedented, what they call the E6 in the Council of the Member States, with the Minister of Economy of Spain, Italy, France, Poland, Netherlands, Germany, being totally aligned to deliver an ambitious program on single supervision in particular, but also on stronger retail participation in markets.
Let's go back quickly to the tech sector. Is there an AI bubble that is going to burst?
I don't know. There is an AI valuation. Now, it's up to investors to decide how they can close the loop between those high valuations, low cost of AI use for the moment, prospects for increasing prices. Is the market going to remain what it is if you want to get some return with so much investment? For sure, something is going to happen. Either the rest of the sectors of the brick and mortar economy is overvalued, or the AI sector is overvalued, but you can't have such huge investment without some form of adjustment somewhere. So whether it's a burst or not, I do not know.
You've acquired recently the Athens Stock Exchange. Obviously, you've been talking a lot about the necessity for consolidation of exchanges in Europe. What's next for Euronext?
The name of the game is liquidity, liquidity, and liquidity. We have created a market which has an aggregate market capitalization of 6.8, almost 7 trillion euro, which is more than twice the size of the London equity market, more than 3 times the size of the Frankfurt market. The average daily volumes on Euronext are, in the last few weeks, approximately 15 billion euro. It's about 3 times the size of the volumes traded in London on equity market. So we have created a pan-European integrated market. It is large. The company used to have, when I joined, a 1.5 billion market cap. It's now a 15 billion market cap and a CAC 40 company. So it's a significant progress, but it's still relatively small at global scale. So if we want to create a pan-European, strong, super liquid market, much more liquid than what we have today, we need to consolidate more liquidity. Now, how it will happen, I mean, it very much depends on partners. We are a willing consolidator, we are a willing buyer, we are a willing integrator. We need to find willing participants in this journey, and that's why discussions are happening all the time on those type of projects.
Last question. We're less than a year before the presidential elections here in France. This is obviously the main topic in Aix-en-Provence. What's the biggest risk? Do you expect more volatility on the markets over the next few months? And what do you think is the biggest risk for this election?
Well, the biggest risk is public finance. France has to adjust its public accounts and has to go anyway, whatever the outcome of the election, to some form of what in British English we would call fiscal consolidation, and that will happen. The question is whether it will happen in an orderly manner or in a disorganized manner. But I think France is much more than politics. The substance of the country, like in every country in the European Union, is about fundamental concentration of talents, fundamental concentration of investment, blue chip companies exporting a lot that are less exposed to the French political dynamic than you think. Most of the large caps in France have a very residual part of their business in the French market, just like in the rest of Europe. So I would not concentrate too much on the political risk. I would just concentrate on how the public fiscal consolidation, public accounts and fiscal consolidation is going to be addressed.
Fiscal consolidation is the top priority for the Euronext CEO Stéphane Boujnah here in Aix-en-Provence. And of course, as I was mentioning earlier, this is the top priorities for many of the executives we'll be speaking to here in Aix today.
Caroline Gunnar on the ground for us from the Aix-en-Provence Economic Conference. Great stuff, Caroline. Thank you. We're going to get back to the gathering later in the show with Ludovic Soubrain, Allianz's CIO. Anna.
Here are some of the other stories that we are watching this morning. Bloomberg understands that Airbus delivered about 350 jets to customers in the first half of the year. The manufacturer set an annual target of 870 deliveries, meaning it needs to hand over about 520 more planes by the end of the year. It comes as the European plane maker continues to ramp up output in the face of nagging supply chain challenges. ECB President Christine Lagarde says the central bank made the right call hiking rates last month. The ECB last month became the first in the group of 7 to raise rates following the outbreak of the Iran war. Lagarde told the French newspaper Les Echos supply shocks continue to spread through the economy, though second-round effects have not materialized. And over in private credit, managers are facing a relentless wave of redemption requests, with second quarter exit requests exceeding those of the prior quarter. According to Bloomberg estimates, more than $14.5 billion of investor capital is trapped at over a dozen funds, compared with $8.6 billion that shareholders were able to get back. So once again, in the second quarter, we're seeing the investors in these private credit funds wanting more money out of them than they are able to take, because the 5% caps are holding. And if anything, this trend is gaining momentum since the first quarter. So if we thought we'd seen the peak of it in the first quarter, maybe not. Maybe we were just distracted by the Iran war and everything else. It's interesting to think how long this takes to work through, because some people in our story are suggesting this could take 8 quarters to work through if the 5% limit on redemptions holds.
So there is a different dynamic as well in this current quarter, which is that the vast majority are sticking to those gating structures and those gating agreements, whereas in the first quarter there was a mixed response. Some did stick to the 5% level if that was the level. Others allowed higher redemptions. Now there is greater uniformity. We were speaking to Aberdeen about this in the previous hour. They said that's actually a healthy dynamic. And they agreed this will continue for quarters ahead. And they think it's not a systemic risk, but clearly the redemption requests, there's some catch up from the requests that weren't fulfilled in the first quarter, and that's partly what you're seeing. But they are significant in terms of the requests.
And it's a feature, not a bug, of the sector, it seems. That's where the conversation seems to be evolving to.
Coming up, we're going to break down the US jobs data with Jordan Rochester. We'll get a view on the FX space as well, of course, with a particular focus on the yen, maybe a touch on the won as well over in Korea. Head of FICC strategy, Amir at Mizuho. That conversation coming up. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. This is the opening trade. It's Friday morning, 30 minutes from the start of cash equity trading here in Europe. And the futures picture looks fairly buoyant, up by around 0.5% on Euro Stoxx 50 futures. The sentiment then, Tom, around tech stocks seems to have changed a little bit. Yesterday, stocks broadly in the States were doing OK on the back of the weaker payrolls number, pushing out expectations for when we get that hike from the Fed out to December. Chip stocks didn't play ball with that, but then into the Asia session, it seems that sentiment has improved in the round, and we have a Kospi that is up pretty strongly. So maybe tech sentiment has changed, and European futures are pointing.
Yeah, and Nasdaq futures pointing to gains of 1% when US markets reopen, of course, on Monday. Let's check in on the bonds as well. Sovereign bonds now opening, of course, across Europe, largely unchanged. You did see, of course, a weaker than expected non-farm payrolls print, so you saw some adjustment in terms of rate pricing in the US. The read across is not pronounced right now, at least in the sovereign debt markets of the Eurozone. Italian BTPs yielding 369. Over in Germany, the benchmark Bund, 10-year Bund is yielding 296. Yields up just 1 basis point. And OATs in France, 310 on the 5-year, 371 on the 10-year, also largely unchanged. Let's just check on the sovereign bond markets this Friday.
Let's talk about what we got from the US yesterday in terms of the data picture then, and non-farm payrolls. Weaker than expected was the number. That came out of the US, and it's challenged expectations that the Fed will raise interest rates this year, pushing out that expectation now to December. Non-farm payrolls rose just 57,000 last month. That was well below estimates.
It tells you the labor market is fine. There's no real concern, certainly no urgency for the Fed to be hiking. And that buys them time.
I think this is a great report for Kevin Warsh. I think it's a good report for the bond market.
Today's report is going to keep their focus squarely on inflation.
The labor market has proved to all of us in the last 6 months that it is more resilient, even with today's numbers.
You've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay.
This is a very fragile labor market. We have very low hiring, but low firing.
Some of our guests reacting to that lower than expected number then. A range of opinions there as to what it means. Jordan Rochester is with us, head of fixed strategy EMEA at Mizuho. Jordan, very nice to speak to you. Thanks for coming in. So in terms of what this does to your perspective around US assets, the fact that we got this much weaker than expected, it was weaker than the estimate, way weaker than the whisper number. And sentiment going into this had been quite bullish, really, about what this jobs story was going to tell us. And yet we didn't get that. So does this fundamentally change your view, or do you look through this number and say, actually, it doesn't really change things for us?
I don't think it changes things too dramatically for what I've previously thought, which is, I think the first meeting we had of Kevin Warsh is probably going to be one of the most hawkish meetings we get from him during the next few months at least. He's dealing with sort of backward-looking response function. That inflation was at 4.2 CPI headline year on year. It's going to come down. It's going to head towards the sort of 3s, and I think it could even get towards the 2s in the next year. And that means that for the Fed, they're going to be thinking about raising rates, but it's going to look a little bit more like the ECB cycle. We get maybe 1 or 2 hikes from the Fed, and then they're done. And we react to the next response, will probably be a slowdown.
Yeah.
But for assets, I think we're still in a lovely soft landing. So it's really difficult for risk sentiment to take a large hit due to the AI capex story, but also the one big beautiful bill, the fiscal stimulus in Germany, and maybe even extra stimulus in Japan. So I don't see where the recession risk comes from for asset prices to have to price.
Can I just, let me just nail you down on your expectations for Fed hikes. If they want, so do you assume they stay on hold in 2026 then? Is that your assumption? What does that do to the dollar?
So my assumption for trading it is that we're going to bounce around between 1 and 2 hikes. And for Mizuho's official
You
call,
still think we could get 2 hikes?
2 hikes this year. So September and December is where I think they could be penciled in. Now, the dots are telling you they're probably going to hike at least once. That's kind of where the shift of sentiment was. But right now, the bias is to receive US rates, probably, from my side.
I mean, yeah, you wonder what we do without the dots, Jordan. But anyway, today is obviously a US public holiday and celebrating 4th of July tomorrow. I was looking at a piece of research from Deutsche Bank that was attached to Independence Day, and they were talking about investment in AI and just underscoring the amount of investment that is happening in the United States right now around the AI theme. Obviously, China is doing some too through more public sector than private, maybe. But I wonder is this the seeds of the productivity boom of the future? Does this support the dollar? Is this really positive for the US economy, or is it not? Does it feature in your US dollar view and Treasury view?
I don't know how you paint it as a negative. It's definitely a positive, but I think the first round effects is inflationary because of all the capex taking up all the other investment from elsewhere. And it's leading to higher prices for RAM prices, leading to higher energy prices locally in certain areas. But in the long term, I think the effects of the productivity gains haven't been seen yet, but they will. So probably before the Iran war, the biggest conversation was AI. Now it's coming back into client conversations. In every client meeting, I'd always ask, do you use AI as an enterprise function? Has your company paid for you to have Copilot, Claude, OpenAI? You'll be surprised by how many people said no.
Right.
They used it on a personal basis.
So still to come.
But their companies hadn't yet brought it in. And the surveys show you that. You've got, roughly speaking, around 20 to 25% overall of US clients that hadn't got this in place.
John, we're seeing a little pop in the yen right now, 160.77. We saw a little pop yesterday as well, but a strength coming through for the Japanese currency yesterday before the non-farm payrolls. What is happening? Are we seeing intervention? Do you expect to see intervention? What are the levels you're targeting for dollar yen?
Well, from all of the frameworks, dollar yen should be lower. The classic frameworks, we should be talking 140, 150. If you use interest rate spreads as your guide, that's why a lot of guests would have come on your show and say the weakness in the yen is going to be short term. I think dollar yen heads lower into year end. But there's been a change in the flow behaviours of the Japanese space. It doesn't look like a G10 currency. It trades like an EM. In terms of its correlation to rates, it has flipped. It's got a negative correlation to rates right now. And this is something that we don't usually talk about, but we have spoken about for the UK over Brexit and all these other things.
And that was when everyone was worrying about the fiscal side in the UK. So is it the same concern over in the States, in Japan? Sorry.
There's definitely concerns. We're waiting to see what the consumption tax cut will be on food and what other ways they're going to fund that. They said they'll fund it from higher revenues, but the market thinks they're sniffing around, thinking there's going to be some extra deficit financing bonds. But the main point is Japan's not an EM. And actually, we've seen massive inflows in Japan, the biggest inflows, in fact, over the past year by foreign investors into both JGBs and equities. But those foreign investors, after Liberation Day, are massively hedging their exposure. So you've got that inflow into Japan, potentially crowding out Japanese investors who are also investing abroad, but they don't FX hedge the same way as foreign investors because they have to pay for that FX hedge, where Europeans and US get paid for it. So in answer to your question, we've had a big carry trade where a lot of hedge funds are short the yen, a lot of CTAs and trend-following accounts. Yesterday looked like something different. And we had that report, I think it was from Reuters or some other outfit, suggesting that the BOJ and the Ministry of Finance, to be more specific, is no longer going to tell us with final warnings like they did earlier this year. Ambush tactics is the word that they used. And suddenly you get a nearly 1% move lower in dollar yen off the back of that. Is that because of the report? Is that just people taking risk off? Potentially. but it could be something different.
We're always looking for this on US public holidays.
Yes, we stay on alert, as many traders, I'm sure, will be as well. Jordan Dorchester, thank you very much indeed. Head of FICC, FIC at Strategy at EMEA at Mizuho. Let's get back to Aix-en-Provence right now. Talking of the fiscal story in Japan, the fiscal story in France as well in focus. The economic conference taking place in Aix. Caroline standing by with another important guest. Caroline.
Tom, this was actually a little unexpected, but I'm very glad to tell you that I am with Roland Lescure, the French finance minister from Aix-en-Provence. Mr. Lescure, thank you so much for joining Bloomberg TV.
Thank you for inviting me.
This morning. We had the Prime Minister Sébastien Lecornu during the opening speech of Aix last night, warning again about France possibly not having a budget for next year. How important are we going to have a budget for next year?
We must have a budget, because the alternative is not really a go. If we don't have a budget, we have what we call a special law, which more or less freezes the budget compared with last year. That means that spontaneously the deficit is going to increase, and spontaneously we're not going to be able to put more things in action, more policies that are going to be pro-growth or pro-business. So, yeah, it's not an option. We have a hung parliament, as you know, 11 different political groups, so we have to convince a majority to vote it. I think that reason will prevail. I know that some of those guys see themselves as a president. I don't think they want to inherit a situation that would really lead them to waste their first year. They probably want to be efficient. They probably want to be able to correct the budget if they don't like it. So the most likely, I hope, scenario is we have a budget, it's not perfect, but we've managed to vote it, and then debate can happen for the big election.
But we've seen obviously what happened to the former Prime Minister the past couple of years, Michel Barnier, François Bayrou, both ousted because of the budget. Are we going to see a similar situation? Can you actually cut the deficit at the moment, given we still have a fragmented parliament?
Well, we did. We did last year. As you know, we were 5.8 in 24, 5.1 in 25. This year is more difficult because we've had a crisis. Hopefully it's over. But the Iran crisis had a big impact on growth, on inflation, and very likely on public finance. We're having a big meeting next Tuesday. We call it the Alert Committee, with all the stakeholders, so parliamentarians, trade unions, company representatives, also the representative from local authorities, to discuss this. We want to assess the state of the economy, assess the dynamic of public finance, and hopefully commit everyone to making the efforts we need to do to keep public finance under control.
So what's your target for deficit cuts next year? Because this year obviously targets 5%. Are we going to reach that? And next year, what is the target?
So we're going to do everything we can to reach, or to be as close as possible to 5%. We're still in the midst of assessing the impact of the crisis. There's lots of uncertainty. I think the third quarter is going to be key. As you know, inflation has receded in France and elsewhere in Europe. You know, this is the time for recovery. And I hope that households, companies, everyone's going to just get together to make sure we have growth. And if we do have growth, hopefully we'll have a better outcome on public finance. But it's still very uncertain. I want 5%, and I hope we will reach 5%.
For next year?
For this year. And I want to make sure that next year we have a budget that brings us below 5%. This is still in the air. We have to work on our budget. This is the work of this summer. We're going to present it by September. But this is what I like to have, and this is what I hope we're going to have.
But obviously, given what happened to the former two prime ministers, it's difficult to imagine that the candidates for next year's presidential elections are going to put that as a priority, because otherwise no one is going to be elected on that platform. Do you think?
So what's hard is to manage to decorrelate what's happening in Parliament to vote a budget from the big debates we need to have to prepare for the following 5 years. If the candidates think that they can prepare 27-32 by spoiling 27, one, I think it's a big mistake, and two, we're not going to make it. I am convinced that if they really think they can be elected, they should, in a way, let us do the dirty job. Let us do the cleaning. Let us make sure that the taking off slot that we are preparing for them is ready. And then they can have the proper debate about taxation, about public expenditure cuts, about pensions, which need to be had. But if we don't have a clean slot, then it's going to be harder for them to deliver what they've promised. So there's a win-win situation by which they allow us to pass a budget. That's going to be a compromise budget, and then they can move on. And there's a lose-lose situation in which, we don't manage to have a budget, and I think they have a very bad starting point. I hope reason will prevail again. We're going to have the win-win. Everything's possible. And that's why the Prime Minister was quite solemn yesterday about his call for reason, because it's a very important moment for France and for Europe, of course.
Do you expect volatility on the French bond market to increase over the next few months as we approach these elections?
Let's choose whether we're in a win-win situation, and I think bond market will like it. They liked it last fall. We had some discussions. There was some uncertainty, but at the end of the day, people felt that we were going to manage to land a deal. Lose-lose, yes, volatility and risk on the bond market. So far, my issuance are going very well. People want the French paper because they believe we have the right approach. I think we're doing the right job, making sure, again, that France lands to the right spot in order to prepare for the following 5 to 10 years. But, we need the parliamentarians to be on board, to have proper discussion, to be able to move forward towards a reasonable outcome that nobody's going to love, but that everybody's going to be happy, hopefully, that we will have reached it.
Who's the best position to do that? And in terms of candidates, Edouard Philippe, former Prime Minister, has a big meeting this Sunday in Paris, his first big rally. He seems to be the best position to beat either Marine Le Pen or Jordan Bardella. We'll probably know the candidate by next week. Do you think he's best placed? And he seems to be also the only one who talks deficits and debt.
Well, if you read Le Parisien this morning, you will see that Gabriel Attal has also got a plan on deficit. I think every candidate should have a plan on deficit, and we'll see. I'm a member of Gabriel Attal's party. I'm behind him so far, and I hope he can make it and win it. But one thing I'm convinced about is that for the spectrum I'm part of, which is basically center-right to center-left, pro-European, pro-market, pro an open world into which France can actually win the technological revolution conquest. We have an advantage on this. For all this spectrum, we need one candidate, we need the best one, and we all need to rally behind him or her. As you said, so far, Edouard Philippe seems to be on the lead. We'll see what happens in the next few weeks. By the time fall comes, we'll have to decide one person, and everybody's going to have to rally behind them.
What's the biggest risk then coming up for the French economy over the next few months? Is it to have a populist president at the helm of France? Is it the public finances, the debt servicing costs, for example, exploding? What is the one single biggest risk?
Well, the risk is a convergence of both risks. I think populism is bad for you, and we've seen it. We've seen it in the UK. Brexit is a disaster 10 years on. That was populism at its best, if I can say. So populism is bad for you. Populism is bad for public finance. Populism is bad for market perception and therefore for potential market tension. We're not going to win by devilizing them, if I can say it that way, but they are bad for you. But we need to have an alternative to propose, which is an alternative in which France grows, in which France puts their house together, in which young people of France can feel that they're going to live better than their parents. And at that moment, this perception has receded in the global world, and especially in the Western world. This is part of the reasons why the elections in the US ended up the way they were. That's certainly a big reason behind the Brexit. We need to give hope. And to give hope, we both need to be serious about public finance. We also need to have a project on how to grow the economy, on how to make people live better, not just older. We're living older. This is massive weight on the public finance. We need to live better, and we have to provide that.
Live older and live better. We'll see if that happens in France. We're here in Aix-en-Provence for this last-minute interview with the French Finance Minister, Roland Lescure. Thank you.
Excellent interview. Really, really interesting insights. Caroline Connard on the ground for us, reacting as swiftly as she always does, of course, in Aix-en-Provence. A lot more coming through from that forum and more coming through on the opening trade. Stay with us. We're 13 minutes away from the open this Friday. This is Bloomberg.
as an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Welcome back. This is the opening trade. We have 10 minutes to go until the start of cash equity trading in Europe. Let's take a step back, though, and talk about these markets, global markets, in 3 minutes on the opening trade with our Asia Markets Executive Editor, Paul Dobson. And, Paul, I wonder what you take away from this week in terms of the backdrop for risk assets, because Walsh was a little more dovish than expected. The payrolls number was weaker than expected, and we pushed out expectations for a Fed rate hike.
Yeah, so if you're Kevin Walsh, I think you're very happy with the way that things are going, Anna, this morning. You know, he came into the Fed as chairman setting out a stall that they wanted to bring down inflation. The market got a little bit worried that they were going to raise interest rates, but it did bring down the inflation expectations. It brought down yields at the back end of the yield curve. Now what we're seeing is this idea that with a softer jobs data and with inflation cooling because of the oil prices dropping again, the market is pricing out the need for the Fed to act with any urgency in terms of raising interest rates. I think for this month, we're now just priced at a 20% chance that the Fed will move. So that's kind of cooling down markets. And it's one of those moments where the reducing the bets on Fed hiking is being taken as a sort of risk-on signal for the rest of the markets. We've got a weak dollar, got stronger Asia FX, stronger commodities FX, and equities market is having a better time of it as well.
Paul, how are those factors tying into the Asian equity session today?
Yeah, so I think people taking it as a genuine positive. And so particularly if you look at the yen, which had been under quite a lot of pressure, as we know, all of a sudden we've got the dollar softening a little bit. It's allowing the yen to rally. Likewise, some of the other Asian currencies that have been under pressure, like the won. And then the tech has been all over the shop this week in Asia, but it's ending the week on a pretty positive note in South Korea in particular. We've got a rally going on. We've got talk of a deal between Anthropic and Samsung. That's helping things as well. SK Hynix had its worst day yesterday since November 2008. It's back up more than 10% today. So the market is certainly ending the week on a more positive vibe than it's had at various points during the last 5 days of trading.
And Paul, help us deep dive into what's going on in South Korea, because this is really interesting. The stock market has been something of a global story for a long time, but it's not taken the currency with it. The won has weakened, partly due to people not wanting too much exposure, I think, to South Korea overall. Now we're about to see a period where we get 24-hour trading in the won, and we're also going to see SK Hynix go to the US to try and raise some money. So talk us through the dynamics, how this is all playing out.
Yeah, there's a lot to unpack there, isn't there, Anna? So the big picture is that we're going to begin 24-hour trading from Monday. It's a big deal for Korea because over the history of time in the FX market, it got very badly burned and scarred by the Asia FX crisis, which meant that it kept trading under very close wraps for quite a long period of time. Now it's opening up because its markets are maturing, and also it wants to win this developed market status. And in order to do that, having around-the-clock FX trading is a big part of it. Talking about valuations and levels, yes, I think that you're right. International money has been coming out of South Korea just because the rally in the equities market has been so gigantic that people have been hitting the limits on how much they're able to hold. So they've had to take some money out. It doesn't reduce the sort of overall size of their holdings, but it does free up some cash for them. Boosting the won today, we've got news that maybe some funds are coming back from the SK Hynix fundraise in the US. So a bit of a rally for the end of the week.
OK, we'll see if that continues, the support for the won, which has been, of course, under pretty historic pressure. Paul Dobson, thank you very much indeed for that wrap. European futures pointing to gains. A decent session, another decent session, pointing high by 0.4% after record highs yesterday.
There could be a bit of focus on M&A within the defence space. We have an interesting move out of Renk over in Germany, so we'll certainly watch that. The warehouse stocks here in the UK as well, on the back of what Andy Burnham has been saying about taxation there. So we'll keep an eye on that. More broadly then, Tom, the European futures picture does look pretty positive. Maybe FTSE 100 futures underperform. The oil price is at 72.13 this Friday morning. We will bring you the market open next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's Friday. This is the opening trade. A few minutes to go until we get the opening trade for here in Europe. Now, we don't have the US trading today, of course, in lieu of Independence Day. But we do have the handover from the US yesterday. And we saw US equity markets trending downwards for much of the session. Concern about the AI trade. Are we spending too much on CapEx? Where are the profits from that trade actually going to accumulate? So we saw some selling of chip stocks. That seemed to continue, but then some rotation maybe kicking in for some of the other markets. Towards the end of the session in the US, we saw a bit of positivity. That might not really be what's driving the futures picture, though, here in Europe, because futures are stronger. But the stock market in Europe had a good day yesterday anyway, and the rotation story seems to be playing out pretty strongly for Europe. If your specialism is things that are not particularly tech-focused, then maybe you do pretty well out of that. That said, DAX futures are getting the best of the gains this morning, so maybe there is a tech angle in there as well, up by 0.7%. Euro Stoxx 50 futures then overall, Tom, up by 0.5% as we take the positivity in Asia and translate that into a European session without our friends in the States.
Some of the individual names we're looking at today. In the defence space, you've got Renk making a deal for an acquisition here in the UK, David Brown Defence. Valued at about 200 to 250 million US dollars. So we're going to watch Renk on the back of that deal making. Rheinmetall, meanwhile, is detailing the cost hit from the German cancellation of that naval contract, about 300 million euros. Morgan Stanley says it's actually reassuring. We'll see the reaction to that. And UK warehouse stocks in focus as well, with the expected incoming Prime Minister Andy Burnley suggesting he could raise taxes on some of those warehouse operators here in the UK. Anna.
Big picture, we've come through a few risk events this week, haven't we, Tom? We heard from Kevin Walsh in the middle of the week, and that was something the market was focused on because we simply haven't heard very much from him. A little more dovish than expected maybe there. Then we got the non-farm payrolls data, which was much more weaker than expected. Does all of that add up to a more positive backdrop for global stocks, for US stocks? That's only one of the questions that the market was asking itself yesterday as we pushed out those hike expectations. Where does that leave us for European stocks this Friday morning? Well, just a touch stronger at the moment, at least, up by 0.2% on the Stoxx 600. The FTSE 100 up by 0.3%. So eking out some gains on this Friday, the 3rd of July, Tom, looking for some of the movers that you mentioned to see whether we get any movement there. The DAX not yet open. We'll be looking to see whether that outperforms. The futures picture had suggested we might see outperformance on the German market. What are you seeing on the sectors?
On the sector breakdown, let's start with tech, because that took a hit yesterday in the session. It ended lower by about 2% in the European session as a sector. Right now, tech is amongst the best performers across the sectors, up 0.9%. Top of the list, though, is basic resources. We've seen higher prices for gold and silver, and that has been aided, of course, the upside coming through in terms of prices on a slightly weaker dollar and expectations of possibly fewer rate hikes from the Federal Reserve. So basic resources as a sector is rallying today, up close to 1%. Tech getting 0.8%. Utilities also up 0.7%. On the downside, consumer stocks taking a bit of a knock, down 0.4%. Healthcare, which was the best performing sector yesterday and by some margin, with gains of 3% yesterday as a sector, is currently down just 0.2%. So maybe a little bit of profit taking across healthcare. That is the picture right now. Most sectors in positive territory across the benchmark, gains of 0.3%.
OK, yeah, still waiting for that DAX to open. We will keep our eyes on that. US futures, as you've been mentioning, looking increasingly strong, ready for Monday, perhaps. Let us turn, though, in the meantime, to what's going on in the individual companies. Airbus is up by 2.4%. We had that story earlier on today around Airbus deliveries. ASML is also stronger, up by just over 2%. So that's an interesting one on the tech front. And to the downside, Novo Nordisk and some of the luxury names. We actually saw in the middle of the week some of those luxury names not doing too badly. And so maybe there's some rethinking there. LVMH down by 0.7%, but heavily weighted, of course, over on the French market. And speaking of France, let's return to Aix-en-Provence, the economic conference taking place in France. Central bankers are gathering, finance ministers, we just heard from the French finance minister, business leaders, economists, and investors, all thinking about the European growth outlook, thinking about inflation, interest rates. We're joined now by Ludovic Soubrand, who is the CIO and chief economist at Allianz. Ludovic, very nice to have you with us. Thank you for braving the heat of Aix-en-Provence this time of year to talk to us. So I wonder what you take away from this week as we go into the second half of the year, Ludovic. We've had the Sintra conference, we've had that weakness in the non-farm payrolls story out of the US, and a lot of quick rethinking about just how many rate hikes we're going to get here in Europe and in the United States. How does that position us then for the second half of this year?
I think it's quite an interesting situation. You mentioned central bank to start. I think the ECB was the only one really to deliver a hike. It was an insurance hike. But as we look into the numbers now, it looks like it's done. They cannot do much more. At the same time, the Fed is really on the opposite direction. The non-farm payroll was actually soft, but I still think inflation peaking above 3.7%, and there is still this AI, fiscal and energy-fueled economy. So I guess the Fed may have to hike in September. So that's really the divide, I would say, between Europe and the US. And of course, the good news is that the inflation is being repriced very fast in the market. So I guess Hormuz seems to be behind. So there is still a scarring effect. It takes time. The economy is still paying the price of the war, but it's looking much better today than it was a couple of weeks ago.
Do you think we're in a bubble in AI-related trades, Ludovic? Is that the thinking over at Allianz? And are you concerned that it bursts? Some people are worried about higher interest rates. You just referenced the Fed there. Some about regulation. I wonder what your thinking is around the AI story.
Look, my concern is mostly on the ancillary things happening on AI. I think there is a very strong, it's a renaissance-like moment for the economy. AI is really going to change the service economy. But I see things that are weird. First, of course, the debt expansion loop that is creating these monetized capex type of moments. We see actors that are very, some of them, Apple, Microsoft, not doing much, and others doing too much. We see a lot of psychology around this AI. We don't really know what is going to be the adoption and the impact on the real economy, but the market is already being very optimistic, especially on productivity gains, when it's going to be a bit of a hybrid situation. So for me, that's where I see the signs that there is a bit of exuberance. The good news, I would say, is that markets are seeing that. When you look at the corporate spreads in this sector, especially the hyperscalers, they tend to be a bit more cautious than before, and I think that's a good news. Will it be enough? We will see, because I still see the capex in the US, skyrocketing.
So you don't see complacency in the markets when it comes to the AI trade then, Ludovic?
I don't see complacency on the debt market. On the equity market, I think it's really strong. I for example, think that the emerging market equity stocks are looking much better because of the semiconductor, important chain, link in the supply chain. But in the US, I think the markets have been extremely strong. I don't know if it's a bubble territory. It's not enough to call it a bubble. It's really about the many factors. The investigation is more about what comes around that looks a bit strange, especially on data centers, for example, when you look at the risk of obsolescence of some of these data centers. When you look indeed into this monetizing of the capex type of move, if you issue debt to pay your shareholders, that doesn't look very good to me. So that's the type of signs we're looking at. Yeah. So on the bond side, I think there is still a lot of vigilantes. On the equity side, I still think it's, it seems like the sky is the limit, and of course that is something that is not the case, yeah?
Is this a better moment for European equities?
I think European equities clearly can do slightly better. I think they have stronger fundamentals, especially when it comes to the debt side, when it comes also to now the energy crisis being behind. The problem, as we know, is that everything is about the AI dividend. And so the European companies are left with adoption. I think what happened with AI, our AI, your problem, not to quote Jim Connolly in a bad way, our dollar, your problem. I think it was good news that Fable 5 and Mythos were now available again. Will it be enough? Can Europe really be the strongest adopter and differentiate itself? I doubt it. I think it's going to be a bit of a fragile, I would say, way for the equity markets in Europe and for companies that are listed in Europe to benefit from the AI dividend, but it's certainly going to be a tailwind.
You're in Aix-en-Provence, Ludovic. We've just been hearing from the finance minister over there, and we've been hearing about, we've been talking about the fiscal story, and I wonder whether that's going to take the agenda or lead the agenda for Europe in the second half of this year and into next year. How concerned are you about the recent widening in spreads that we've seen on France?
Look, I mean, the main job that this government has to do till the election is really to maintain this 5% upper ceiling for the deficit. That would be a way to reassure markets. And I think they've been doing a great job at it, including by doing under-indexation of some of the tax cuts on wages in spite of the inflation and so forth, right? The problem comes with the law of finance for 2027, because that's the one that's going to be the caretaker law before a new government comes to place in 2027. And so markets will be looking at this. But if you look at it, it's an election wall. Italy, Greece, Spain, France, everybody is into this election mode. And so everybody will be looking at what is the fiscal impetus and what is really the room to maneuver that those leaders have when markets have been looking at, the rates market especially has been looking at, do you invest, do you spend for investment, or do you spend for maintenance, which is mostly the social protection cost? And we've seen that has been a big differentiator across countries. Germany is running a 4% deficit this year, which is quite huge if you think about German standards. So of course everybody's looking at what the others are doing with their fiscal, especially Italy, especially France, and I would say also the UK.
Ludovic, so on the spreads, I mean, we've been looking at French 10-year over Germany at 79 basis points. As we approach an intense period for French politics, what's the kind of spread level that we should be looking out for? What would be a concern for you or get your attention over at Allianz?
I think there is depending on the candidates that really crystallize towards the end of the year, I think we're going to see a slight widening of the spreads to the Bund by another 10 to 20 bips. That's very possible. I think then, of course, the main question is whether there is, and this is what everybody has as a nightmare scenario, a bit the extreme right and the extreme left going to the second round. I don't think this is the most likely scenario, but in that case, two parties are very profligate, and we have been running, spread scenarios that could be widening by as much as 150 bips, 180 bips, mostly because there is this question from both parties on how they will behave when it comes to Europe. And the ECB will be there maybe to save the day, but not for political reasons. And so that's a bit where the spread scenario could really go haywire. That is clearly not the central case. The central case is a bit of skirmishes on what is really priced in and what can governments do in 2027. And we're talking maybe about a 20 bps widening, which is something that actually markets, especially bond investors, would like very much, because that would then give them an entry point for the OAT.
Do you think Andy Burnham has learnt the lessons of the UK's own fiscal challenges and the gilt sell-offs that we've seen under previous Prime Minister Truss? Do you think that lesson has been learnt?
I think everybody has learned this lesson, Tom. I can tell you there is not one conversation about the risk of a trust moment from the US to France to Germany even is talking about the trust moment. I think that was really interesting epidemic reactions of market. I think now the question is, can politicians overcome this fear to do something that is meaningful for their people, especially the centrist parties? Because the populist parties on both sides, they're over-promising and under-delivering, right? So the centrists need to find and walk this tight rope, and that's the main issue now with politics, especially in Europe, and I would say it would be the case with the US after President Trump. Yeah.
Yes, I mean, Andy Burnham argues that his advisors argue that if the bond markets become convinced that the growth story for the UK can really change, then maybe bond markets will put up with some, not higher borrowing, but at least taking that on. I mean, Ludovic, does that hold water to you? Do you think that bond markets are ready for a step change in growth to be the narrative?
I think quality growth has always been a bit the mystery of bond market, right? What is spent that is seen as something that is yielding to higher growth and hopefully not so much inflation, or at least good enough inflation that it crowds in capex, especially from firms and from families. I think this is the ultimate policy goal. I do believe that this is everybody's attention. So especially when it comes to investment in the production versus untargeted social assistance versus, this guns versus butter debate between defense and social protection. That's the type of things and trade-offs that most prime ministers, most leaders have to face to make sure that markets buy the story of a multiplier effect with a well-spent additional euro, additional pound. It's something that is hard to sell, but I think this is the way that they have to walk if they want to get something out of their time in office.
Yeah, something for the second half of the year. Thank you, Ludovic. Ludovic Soubrand, Chief Economist and CIO over at Allianz, joining us from Aix-en-Provence. And more coverage coming from Aix. Don't miss a conversation with the Banque de France Governor, Emmanuel Moulin. That's at 10:40 a.m. London time.
Let's get back to the markets now. The core six and see what the performance is like again on a generally decent day, relatively decent day for European stocks and record highs yesterday. ASML performing very well, so adding the points across the index, up 1.8%, the Dutch company. And Schneider Electric also gaining 1%. On the downside, you've got some losses coming through from Rheinmetall as it details the costs to that contract cancelled, of course, over in Germany. And Novo Nordisk down 1.5%. Let's get more on some of the individual stocks on the move and bring in Louise Moon. Louise.
Morning, Tom. So first up, we're turning to Stockholm. Absolutely soaring here, this stock, up over 15%. That's after they settled a lawsuit related to brain guards. That's really soaring into the green over in Stockholm. Sticking with the sector, we are looking at Reckitt back in London. Reckitt, let's take a look at their shares. Only up slightly into the green. Now, that's after they were cleared in the US. One of their lawsuits surrounding their unit, Mead Johnson, over their infant milk formula. So that's one of the lawsuits in a whole host of them. So it's cleared, positive, but a lot to get through, both for Reckitt and for one of their rival companies as well. So it's only slightly ticking into the green as a result of that. Now, next, we're looking at Rank Group over in Germany. Shares up over 2%. So into the green, another positive move for them. That's after they've just bought a UK defence firm called David Brown, giving them more access to the naval sector. Of course, this adds to the spending of defence, and Rank Group already, their shares have tripled since their IPO in 2024. So a bit of positive news for them. And then finally, ending on Craneware. Let's take a look and see how their shares are doing. Down, slumping over 21%. Previously halted this morning and now down over into the red. That's despite seeing, that is as they're seeing their full year earnings below expectations. So really weighing on that stock here in the UK.
Louise, thank you. Louise Moon with those stocks on the move. Coming up, private credit in focus. Managers are locking up investor cash as they face another wave of redemption requests. We'll have more next. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ula, Saudi Arabia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back. This is the opening trade. We've got some data out of Spain. Our first chance to look at the Spanish PMI numbers for the month of June, and they've come in really strong. So if you look at the composite number, 53.3, that's well into expansion territory. The services number, even more so, 54.2, and they're both well above the survey, which for both was around the 50 mark or 51 mark. So strength in Spain. Let's bring in Jana Randau, who reports on economics and the ECB from Frankfurt. She's back from Sintra. She's been all over the European growth story, the European monetary policy story. And so I'm interested how this Spanish PMI story fits into all of that then, Jana. I mean, Spain has not been the epicenter of concern around the European growth story with the war in the Middle East. So maybe that's also important context. But there's some strength coming through in at least one part of the Eurozone growth story.
Yeah, it's quite impressive, actually. I didn't expect that to happen this morning. Now, Spain, of course, is in a way the poster child of the Eurozone economy, has been for a very long time, recording solid growth, while Germany and France and the likes are really struggling. And we're seeing that at full force this morning with these PMI figures. Partially, of course, because Spain, has strong fundamentals, but also because of the changes we've seen in peace negotiations between Iran and the US. We've seen that in other data as well. A lot of hope, a lot of confidence that things are turning, things are improving. We saw some upward revisions to manufacturing figures in France and Germany earlier this week. Suggests that firms are, confident that the outlook is improving. We've seen IFO climbing. Of course, that's the main German business confidence indicator. So overall, and the ECB President Christine Lagarde said that as well in Sintra, since you mentioned it, that risks to growth, to inflation have become more balanced since policymakers last met to raise interest rates, as a matter of fact. So things are looking, in the right direction, even though of course, a lot remains in the unknown, and it's far from, story's far from over.
Yes, Jana, and as you talk about the ECB, which of course you know intimately, Christine Lagarde maybe uses this, maybe she leans on this data to reinforce the case that hike that they made earlier this year was the right decision. She's been driving home that message again, and maybe the data, arguably the data of today, supports that view.
Yeah, I mean, it's tough when you, as an ECB, raise interest rates and then data falls in the right direction and seems to suggest that inflation is coming down, growth is strengthening, and the scare may not have been so great, and they're cautioning against that, of course, saying yes, we are seeing positive signs. But equally, a lot of damage has been done, and it'll take time for businesses, for consumers to adjust to what happened, to digest what happened. And of course, we don't know if the truce holds, what happens if the Strait of Hormuz, key passageway for oil and gas shipments, if that stays open. So a lot of uncertainty still, despite all the positive signals. So yes, the rate hike in June was solid, was robust, as policymakers like to say. And I don't think they've all given up on further action. Also, July looks unlikely. That's only 3 weeks away now. But September is still very much in the cards. We spoke to a lot of policymakers in Sintra over the past days, and it seems they are far from sounding the all clear. They have their eyes on inflation. It's still above the 2% target. So for now, it looks like more will even come from the ECB later this year.
OK, September is still very much live then for the ECB. Jana Randau in Frankfurt with the reaction, the context around the data and how to think about what we've been hearing from Christine Lagarde. Jana, thank you. Meanwhile, private credit funds are facing a relentless wave of investor withdrawal requests, forcing managers to trap over $14.5 billion of capital to protect their portfolios. For more, let's bring in Bloomberg's senior reporter, Silas Brown, who covers this for us. So managers locking up more funds, redemption requests increasing. What is the state of play right now and how concerning is it for the private credit space?
Yeah, I mean, we're in the second wave of redemption requests. First started in the first quarter. And you're seeing, I think basically what you're seeing, my take of it is the funds that benefited most from the retail explosion over the past few years are the ones that are now suffering the most. And so the likes of Ares and Apollo and Blue Owl, who've really kind of pioneered retail, bringing retail investors into the private markets, are the ones that are now having to kind of shut the doors and institute caps. So it's kind of an interesting moment. I mean, I don't think this is going to end soon. I mean, I think we will see, I mean, certainly people think that they will see successive quarters as they just try to kind of calm the nerves of the judiciary retail investors.
And Silas, how do we judge success here for these credit funds? Is it just capping redemptions and holding the line, or is it not actually receiving that many redemptions, so you don't have to impose the cap, you don't have to reinforce the cap? What does success look like for these credit funds?
I think it's quite impressive when they don't have to do the cap. And there's been a few, I mean, so Goldman and Oaktree have been outliers in terms of actually saying their redemptions fall in this quarter. I think for the industry, as long as the performance remains relatively robust, which it has so far, I think this is more of a kind of technical issue with retail investing. If the performance starts to drag and you see more credit blow-ups and kind of more stress in the industry, that's when I think it becomes much more of an issue.
OK, so it's the quality of those underlying assets and whether or not that becomes an issue. You talked about the retail investor and how that different funds are affected differently because they've sold a lot of these projects to the retail investor and successfully. Do you think on the back of all of this, after these next few quarters that maybe we see more redemption requests, at the end of all of this, we get a rewired private credit space that has maybe less exposure to retail?
Yeah, because I think what I said at the start about the funds that benefited most from the retail boom are now the ones that are suffering. I think to dig into that, you know, people think of retail investors as just one sort of single composite thing. Yeah. And actually what we've noticed that there are some that are very flighty and some that have kind of stayed the distance. And I think as we analyse this, as the dust settles, we'll notice that, like, there's a kind of hot money area of retail that I think people pushed into through RIAs and through, you know, I mean... and
RIA being a...
I don't know the acronym, but they're these, like, registered investors that go out and kind of sell products to... Sell products to kind of high net worth and mass affluent people. And I think to the extent that was a kind of aggressive sales pitch over the last 3 or 4 years, that really helped grow the assets in the industry. And I think that's where the kind of pressure valve is.
Yeah, so that might be where, as you say, where the pressure builds. What about the pressure? You said it depends on the underlying assets. So what's the latest signal we're getting then, Silas, as to whether the underlying assets are doing OK? I mean, credit spreads for listed credit seem to be pretty tight still, and we had a moment of worrying about higher interest rates, but this week that's slightly being pushed out, slightly fading. What do the underlying assets then look like? Famously, there's a lot of software in these baskets.
Yeah, so in terms of like new deals, frustratingly for the industry, the leverage loan market and the high yield bond market, the institutional traded debt markets are very strong at the moment, very tight. So a lot of, if there's any M&A happening, a lot of it is flowing through to the kind of traditional forms of leveraged debt. So that's frustrating. Number two, yes, there is a kind of relatively high degree of concentration in software. And, you know, what's tricky, I think, for fund managers is the software industry remains relatively robust in terms of earnings growth, but there's just this nagging feeling, which I think is backed up by certain, certain evidence to suggest that there will be some value destruction there. But that takes quite a long time to play out.
It does take time, and it's a conversation, no doubt, that is still to be continued then. Silas, thank you very much. Bloomberg's Silas Brown with the latest on private credit markets. We will talk about this and other themes with Piers Hillier, Jupiter Asset Management CIO, joins us to discuss his outlook for markets in the second half of the year. We'll get to that next. This is Bloomberg.
wanted to say. Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in Season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch Season 2 on all these lovely channels.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is the opening trade, 30 minutes into Friday's session. We are without our friends in the United States as they celebrate 250 years. And so this is the European equity market picture. It doesn't look too bad, actually. The US session was kind of two different stories in one. Overall risk sentiment was buoyed by the weakness of the non-farm payrolls report and pushed out expectations of a Fed hike. But we still saw some concern around tech stocks and semiconductors in particular. Then into the Asia session, that kind of turned around. We saw some positivity around tech stocks. So all of that adding up to some positivity for European equity markets. And interesting to think where we've been this week, Tom. We started this week possibly more convinced we'd get imminent Fed rate hikes than we end the week. So maybe that is positive for risk assets.
That could be another catalyst as we look at European stocks. Building on the record gains of yesterday. Volumes are down, likely tied to that US holiday, of course, currently down at 25% versus the 20-day average. So that's the volumes picture. The breakdown then across the benchmark stock 600 is this. You are seeing the majority of members in positive territory so far in the Friday session. 419 gaining so far, 163 in negative territory. Let's flip the board and have a look at some of the leaders then. Interesting in the shipping space as we think about the trade dynamics that are coming through, but also the Strait of Hormuz. Maersk getting an upgrade from Goldman Sachs, and so that stock is posting a very strong session so far, up 3.5% from Moller Maersk. Abivax, this stock is up about 50%, this week. They came out with a new drug at the beginning of this week, and so that momentum, the optimism around that stock continues in the session today. Gains of almost 5%. Infineon linked to the revival, at least for now, in the tech trade, and you're seeing that strongly, of course, in the Asian session, or you have seen that strongly in the Asian session, adding to upside, up 1.2% for Infineon, the Germany listed company, of course. Let's flip the board and have a look at what's happening on the downside. You've got some defense names, you've got some software names, and you've got some caution around alternative asset managers. Craneware, software exposure to the US healthcare space, and that is being hammered, currently down more than 23%. That's on an earnings story. Rheinmetall detailing the hit coming through from the contract cancellation by the German government around that potential build-out of Navy ships. We know that's not happening anymore, and they've quantified the cost. That stock is down 1.7% on the back of that news. And then EQT with a warning around, and from one of the analysts around these alternative asset managers and downgrading their view on EQT. So that stock is currently down 1.3%, Anna.
Tom, let's get an update on some of the other stories we're covering this morning. Bloomberg understands that US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. Top officials have been actively exploring ways to remove Fed governors to clear the way for the president's own picks. The Supreme Court recently blocked an attempt to fire Governor Lisa Cook, of course, but she remains, according to our reporting, a target. Some leading European powers now accept that ships transiting the Strait of Hormuz will have to pay fees to Iran and Oman. According to Bloomberg reporting, the prospect of some sort of service fee is now, quote, a given. The US and Gulf Arab countries, meanwhile, continue to insist that Iran and Oman cannot impose charges of any kind for the use of the Strait of Hormuz. And Anthropic is reportedly in talks with Samsung to be a manufacturing partner for a custom artificial intelligence chip. According to reports in The Information, the company's plans are at an early stage. The news comes as AI companies aim to diversify their supplies of chips to meet surging demand for their services. Tom.
Well, we closed out the first half of the year this week, and despite the geopolitical pressures, equity markets around the world rocketed higher. We spoke to guests this week about where they see performance going from here.
Volatility is still there and uncertainty is still there. And in this environment, for me, it makes sense to be quite nimble and also not to take big bets either way. But when the market throws you opportunities.
As long as the earnings continue to be good and to broaden out, I think we'll get continued gains through the second half.
It's still good to be exposed to tech about at the market weight of tech, and to look maybe to give more emphasis to other sectors. We are looking for a little bit of a broadening here.
We can talk about the AI losers, but actually beyond that, there's lots and lots of sectors, whether it be things like healthcare, whether it be things like staples, which are trading at sort of valuations you haven't seen for a very long time. So, you know, at this point, if you get a little bit of that momentum coming out of those tech stocks, is there a lot of value elsewhere? And I think there probably is.
Even though valuations are stretched, even if you take kind of the worst case scenarios, this rally could still have another year to run before you then saw a turnover.
The second half of the year could mark a positive momentum for Europe. Now, I think we have to keep in mind, if we look a bit further down the line, that we're going to move into 2027, and at some point people will start worrying about French election and other political issues potentially in Europe. So I think it's going to be a short trading window for Europe.
Well, here to give us his perspective is Piers Hillier, CIO at Jupiter Asset Management. Piers, good morning. Happy Friday. Further upside for global stocks?
I think so, and I think the important thing, quite a few of those guests really commented on, is in some ways a rotation into some of the other sectors. So we've kind of been led in the first half of this year, partly sort of hyperscalers to start with, and then as the CapEx piece starts to get deployed, the beneficiaries of that CapEx effectively have rallied very sharply in Q2. I think, you know, in coming in to talk to you this morning, there was a degree of caution from our perspective in terms of running a sort of ahead of themselves. So the logic there, the earnings revisions and everything else justified that, and even you see a slight nominal derating. I think our perspective from here is actually, you know, we see the second order effect feeding through into markets. Valuations beyond that cluster actually still look relatively attractive, and particularly sort of outside of the US, global valuations remain attractive.
Because we've seen that rotation story kind of rear its head and then it gets pulled back in again. But you're convinced that that rotation theme continues and broadens out and gains more traction in the second half?
My observation really is ultimately markets will respond to earnings and earnings revisions. The resolution, whether we have a resolution in the Gulf or not, is an interesting topic. But you clearly see sectors responding to that, and what's happening in terms of trade is starting to improve. I think the interesting thing about your point on the levy there in the Gulf, if that actually does happen, to me, actually get a capex pull through. So most people didn't know anything about the East-West pipeline in Saudi Arabia until this happened, and then they suddenly realised, and it wasn't really being utilised because it made no sense to do that. You could ship it. It was much easier. If levies are going to start to happen, one, I think that's a real political loser for Trump, because what was the point of going to do this? The second thing is that actually are we going to see a growth in capex where people are going to try and mitigate that risk? You've got sort of indications of Canadian capex in terms of building an oil pipeline out to Vancouver to support China. You're going to see more use through Panama, Venezuela coming on board. So in some ways, I think the Iranians and the Omanis need to think quite carefully about how much of a levy do you want to apply. We know that tariffs essentially had a big knock-on effect when Trump announced them before, and my sense is that actually a degree of caution in terms of where that goes, because you know, economics 101, if the cost of supply over here is more expensive, I'll find supply over here. And demand is the key moderator.
OK, and that will be interesting if there is a sort of stickiness to prices for energy as a result of more tariffs or taxes or whatever they end up thinking about. That would be interesting for Europe, certainly.
Yep.
Thinking about the US and how the growth story plays out there, then, Piers, it's been interesting because, yes, it was the hyperscalers, then it was some of the semis, and that's a more global story, isn't it? The memory companies, more global than just a US story.
Yeah,
although the US set to benefit from the AI rollout, I guess. Where does all of that leave small caps? More pinned to the real US economy, I suppose.
Yeah, and I think it's a really good question because we've been so obsessed in some ways by that part, and markets always tend to respond to earnings. That's a critical driver. I always want to just make sure that cash flow is actually following earnings. That's a sort of the reality check. And that's certainly been true in small caps. And I think most people have missed, actually, small caps have been outperforming the larger parts of the market now for almost a year. And it's kind of gone unnoticed. You've very kindly built this chart for me this morning, but I thought it was just interesting to highlight. And what is this telling you? Essentially, small caps is a macro trade, and it's really a reflection of your expectations around interest rates. So it started underperforming in 2021 as interest rates started to go up globally, started to inflect as we felt we reached the peak in rates, had a few wobbles in Q1 with the Iran intervention, but actually the underlying fundamentals are there. And we have a really interesting global smaller companies ETF where we're excited about the opportunity set in that part of the market.
And does the AI story, when it starts to filter into those smaller companies, is that something to be excited about from a well, you say it's all about earnings, so from an earnings perspective?
Yeah, and I think that we talked about sort of Europe relative to the rest of the world. You saw a little bit of it in Q1, which is the second-order beneficiaries of that CapEx story starting to play through. Companies you wouldn't naturally thought of, like Prysmian, a sort of cable provider. A lot of the infrastructure supporters to the build-out of data centres. You saw a bid for Segro in the UK, with Prologis looking potentially to come in and try and deal with that marketplace. And I think I was interested talking to a sort of chemicals analyst in the benefit of the pull-through in terms of how do we see further innovation into the chip space. There are a lot of chemical leaders in Europe that are potentially beneficiaries of that as well.
I just want to be clear on the hyperscaler story then, because that underperformance has been there, at least in the last month or so, around that theme that they're spending and it's the picks and shovels that gain, and some of those other component makers that see the upside. Does that continue, or do hyperscalers look attractive to you right now? Because the drop has been there, and year to date for some of these names, and double digits for some of the big names in the hyperscaler space.
Yeah.
There comes a point, maybe, when that starts to look attractive for some.
That's the classic thing, isn't it? Is really just to understand what that order effect is. I suppose if I go back and everyone talks about bubbles, and ultimately you only know when you've had a bubble is when you passed it. Yes. So for me, what I really look at, what's changed in some ways, and we've been long-term actually investors into the hyperscalers as actually capital-light businesses, highly cash-generative and disciplined. The big delta really in the last 18 months has been that switch essentially from effectively cash-generative to cash-consumptive. So the first order effect effectively was raising debt. You're now starting to see them coming to raise equity. And if you remind yourself, that's kind of the profile we went through in 1999-2000 as the transition from cash generation to cash consumption. And at some point, the cost of capital starts to catch up. And I think for me, that's the one, if I put up sort of what's a warning light out for the second half of the year, is that if inflation remains high, and there's a real push and pull in that space at the moment. You've got PMI stronger in Europe today, but you had actually jobs weaker in the US. But there's a lot of refi risk to come through, starting really in the second half of this year, feeding over the next 2 to 3 years, as those who really refied back in 2021 and corporate IG and crossover tends to be 5 to 7 year in tenor, we're walking into that refi wall. So I sent you through a piece around the private credit side of things, and some of the companies in the US. Why are they underperforming? It's not just a software story. It's going to be a refi story in the second half of the year. So if rates start to come down, then actually some of that pressure comes off and you can see those bounce. But fundamentally for me, it's that transition from super low rates, which we hadn't seen transmit as much. You didn't see it in the US because essentially mortgage rates are fixed, the 30-year term structure, so there's no pressure there. But if you look at the shorter dated financing, so auto loans, credit cards, etc., student debt, they're all accelerating in terms of default risk now. So if rates come off in the second half of the year, and that's going to be really important to watch wash from here. If that doesn't happen, we do have that pressure that comes through. So you've got the chart up there, which highlights the underperformance of the likes of KKR, the likes of Apollo and Ares, who have been beneficiaries of that carry trade, and that's unwinding. It's not just a gating thing. That's really important too. But ultimately, the second half is really watch what happens with that refi risk.
So it's not just gating and the private credit, it's also wider. It's about refinancing risk, as you point out, as rates might or might not go higher. Let me ask you about UK assets. And are UK assets on alert? I mean, I suppose European assets might be on alert for politics in 2027. But the UK dimension to that, is it gilts that are on alert? Is it things that could be taxed that are on alert? We just heard last night from Andy Byrne talking about the possibility of taxing warehouse companies. What's in focus for you when it comes to UK assets?
Look, I mean, it's a fantastic question. So the gilt market really is trying to work out, and it depends on who becomes the next chancellor in terms of where we see the evolution from here. So you'll bid at the front end in some ways the gilt curve. There's a nice pull through there in terms of where we are, but the long end is totally unloved. DB pension schemes essentially are no longer really buyers of the long end. So
do you think rightly unloved?
Well, yeah, but the reality is, when you're uncertain, you think of some of the capex, or at least the investment decisions that are being made on behalf of us. The reality is that most of those are not converting into actual real growth or productivity. I think the market will wake up to that. So a real incentive to grow as part of a new industrial structure and a strategy really would actually, I think, help markets backdrop from here. But actually, I sort of, when I joked on the way in, a sort of a letter to Mr. Burnham, dear Mr. Burnham, actually you can help yourself. The UK, if you take this to G7, is the smallest investor in its own domestic market to any other of the G7 members by a huge distance. The US is over 60% of its assets in its domestic markets. Australia, almost 40%. We are less than 3%.
Well, and this is something that the Labour government has been trying to fix already, hasn't it?
Yeah. But the rest of the world thinks the UK is cheap, because you think about the number of bids we've had for UK companies. I mean, our market shrinks essentially because the rest of the world thinks we're great value. We talked about Segro earlier, Prologis bidding for that. You've had Tate & Lyle, Nuveen bought Schroders. I won't go on, but it just makes a point that actually the world thinks the UK market's cheap. Private markets think the public market of the UK is cheap. If the government puts some form of help, and it's incentives that markets respond to, not sticks. Telling us to invest in the UK is not the answer. Incentivise us to invest in the UK, and we will come.
OK, something tells me they might be listening, looking for ideas at least.
I hope so.
Piers, thank you very much. Piers Hillier, CIO of Jupiter Asset Management, with his letter to Mr. Burnham. Coming up on the programme, we'll stick with the UK theme, in fact. I wonder whether Mr. Burnham is going to be watching the football very late on Sunday, early Monday morning. Pubs will be able to stay open well into the early hours for England's World Cup match against Mexico. We will get more next. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. When you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome back to the opening trade. Happy Friday. We are 48 minutes into today's session. You're seeing some modest gains coming through for European stocks, up around 0.3%, but that is in the context of record highs for European stocks yesterday and outperforming the S&P 500 year to date right now. That is the picture across European stocks. The CAC current is currently flat. The DAX putting in a slightly better performance, up 0.4%. And here in the UK, the FTSE 100 at 10,673, adding 20 points.
Let's start on stocks then in our next conversation. Bloomberg Markets Live strategist Adam Linton joins us to think about where we are on these global investment themes then, Adam, as we go into this weekend. European stocks enjoying a moment in the sun, you say. This is rotation. Rotation means lots of different things to different people, doesn't it?
Yeah.
But does it mean everybody buying healthcare? And is that good for Europe?
Yes, I think kind of what we've seen is kind of seen a reversal of the Iran conflict pattern, whereby US was leading, you had Asia, that was positive, Europe negative, and then since early June we've seen a reversal of that. So Europe's now lead the way. We've got lower for US equities and Asian equities, and obviously bounce back from Europe. It was hit most by the conflict, but then also tech is a key differentiator here. So much lower gearing towards Europe in tech, and if you look at the rally under the hood for Europe, in the initial stages of this leg higher since about June 11th-ish, it was relatively narrow at the start. It was mainly just financials and industrials driving things. But now what we're kind of seeing is increased breadth. So we're seeing 8 of the 11 GIC sectors contributing. We're seeing a turnaround for consumer staples and healthcare. And, European stocks continue to punch out record highs. And what's going to be a really key month for tech going forward is a key differentiator for Europe.
OK. And the energy price story is a factor, as you say, and the rate story as well. I mean, Christine Lagarde saying that the decision to hike earlier this year was not a mistake. We were hearing from our colleagues in Frankfurt saying that the ECB it's probably could still be live for September. So I guess my question is, does the rate story continue to benefit European stocks, or if they hike again, is that a headwind, or do European equities look through that?
I think they'll probably look through it, because I think, my view on rates is we're probably in for a little spell of sideways trade at the moment. We've kind of seen, obviously, the ECB tighten policy, but what we've kind of seen from them as well is that they're leaving this one hike potentially on the table. I think the dovish remarks from Lagarde were her speaking off script a little bit, and the market's still clinging on to this belief we could see a hike at some point from the ECB and the BOE, rightly or wrongly, and I think that'll take probably quite a while to unwind. So, I think for European yields, if you look at the German 2-year yield, it's about 2.5%. We've probably got a bit of a floor under that now, unless anything big happens in the US. But at the same time, there doesn't really appear to be much of an upward bias unless anything dramatic happens between US and Iran. But I think the market's really discounting that at this point.
OK, Adam, thank you very much indeed. Adam Linton with a take there on how to think, of course, about the record rally for European stocks and the rates environment. Here's what else to think about for this weekend, though. Wimbledon continues, of course, so all the tennis action in southwest London. We keep across that, of course, or you should be keeping across that. The World Cup, of course, the knockout stages. We're building up here, at least with our bias, to England versus Mexico on Monday. But lots of great action, including from France over the weekend. It's the 4th of July, of course, in the US. Happy 205th. And this is one that no one wants to miss. Taylor Swift's wedding. Apparently it's going to cause some congestion in New York. So that's happening this weekend. I think Anna Edwards got a ticket.
Well, maybe. I mean, point of order, I should just say happy 250th, not 205th. You just knocked.
Did I say 205th?
You just knocked 45. Yeah, you knocked a good half century off their age.
Thank you.
Yes, I thought it was a public holiday for Taylor Swift's wedding. Apparently that's not the case. It's July 4th, but it isn't July 4th. That's tomorrow. It's actually Friday the 3rd of July. But there's a lot of football ahead, a lot of sports ahead, but a lot of football. Speaking of football, the UK Prime Minister Keir Starmer says that pubs will be able to stay open for the England World Cup match taking place at 1 a.m. at UK time on Monday. Yes, 1 a.m. He made this announcement in a post on X.
We're making sure that pubs can stay open on Monday morning, early on Monday morning, for the England game. So I know lots of people are making their plans. If you're planning to watch it in the pub, that is great, and it's really good for pubs as well. So come on, England.
His message for the nation. Sam Unstead is with us, co-editor of our Markets Today blog. He's trying to go out as Mr. Fun, it seems, isn't he? I mean, I do want... So this is going to be good news for pubs, I suppose, to take the Bloomberg good for business line. Which business is it good for? It's going to be good for pubs. Even on a Sunday night.
Yeah, it will be good for pubs. No question about that. You know, this is obviously not a time of day. They're not only allowed to sell, as you are quite literally extending their opening hours by 4 or 5 hours at least. So yes, it is good. We have, though, we went back as the World Cup was starting on the Markets Today blog into how much of a boost do pubs actually get from major tournaments, and obviously it's a bit dependent on the timing. In this case, as you mentioned, it's going to be 1 a.m. because it's being held in the Americas. When they're in Europe, there is more of a boost because the timings match up much more clearly. But actually, it tends to be very short term. It's a very quick boost. It also depends a little bit on whether England win and continue going on. The further they go, the better it is for pubs. But generally, this is a pretty fleeting boost for the pub sector. But even so, it's a pub sector that's been beaten down quite a bit, so it may well help.
Win or loss, Anna's concerned about productivity.
On Monday.
On Monday.
Yeah.
I mean, is that a real...
Yeah.
Is that a real concern?
No, it is. It is. You do see, again, like they're very fleeting, but you do see little patterns, in the economic data where you get a little bit of a loss of productivity either way, whether that, and it doesn't really matter what hours it's in either, because very, very often...
Are you going to get up at 1 a.m. to watch the game, Sam?
Well, look, Tom, I mean, I'm off next week, so I am considering the logistics of how I would do that.
Really.
That's it. Everyone is considering, aren't they? Let's see which side of this fence everyone falls down. I don't know where. Keir Starmer's excited about people going to the pubs. Don't know where Andy Burnham's going to be watching the game. But thinking about Andy Burnham and what he means for the UK economy, we haven't heard much about his key appointments, but we've heard a bit about where there might be some wiggle room on tax.
Yeah.
So, yeah, I'm here to take the fun out of this conversation, clearly, because I've been talking about productivity on Monday and now talking about this. But, I mean, is this a story that is attaching itself to UK assets just yet?
Well, to an extent. So Andy Burnham has floated this idea about around business rates. Now, business rates have been sort of pilloried by the bricks and mortar community here for 15 years.
And by every government. They talk about how they'll reform them.
Yep, and they did begin doing that in the 2024 budget. Nothing has really come of that as yet, and obviously now we have a change of government, so we'll see what happens there. But this is reforming business rates or cutting business rates for pubs and high street, and then taxing more on warehouses, so particularly sort of mentioning logistics warehouses. But it kind of illustrates the trade-off that has to happen here, because he's also, when you're talking about warehouses, logistics warehouses are not really the ones being built now, it's data centres. And so if that's going to happen, if there's going to be a change in the way that those are treated, beyond the business rates environment, it sort of raises this question of, the investability is when you've got this huge amount of AI money coming in. That's not, but it's worth mentioning, he's not the Prime Minister yet, and these things are all very much speculation. So at the moment, we don't quite know, but it does just illustrate how much you're going to have to take from one place
and
give
caveat
to another.
Sam Unstead, co-editor of our Markets Today blog.
On a Friday.
Honest. Enjoy your weekend and your week off as well. No doubt Taylor Swift's part of your weekend.
That's where he's going.
Plans. That's where he's off to secretly. He did get the invite.
Yeah.
We're heading into the weekend, of course. If you hadn't noticed, be sure to catch up on the Bloomberg Weekend newsletter. We bring you a collection of interviews, ideas, and stories that explore the fascinating places where finance, life, and culture meet.
The Taylor Swift wedding, perhaps. That is it for the opening trade. The Pulse is up next. I'll be here with the Pulse from London. Francine is in Aix-en-Provence, so she'll be bringing us some key interviews there as well. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative. Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after a weak U.S. jobs report. Bloomberg understands that President Trump and his allies are renewing a push to reshape the Federal Reserve, with the governor, Lisa Cook, still a target. Also coming up.
We're live at the Rencontre Économique of Aix-en-Provence in the south of France. We'll be speaking to policymakers and politicians to see the path ahead.
Let's have a look at where we are on these assets for you this morning. 9 o'clock then here in London, without the United States today because it is a holiday in lieu of July the 4th. But that said, Nasdaq futures are interesting. They are up by 1%, as you can see, even though they're not trading today. But we have European equity markets, we'll show you those in a moment, which are getting some modest gains. Dollar yen, interesting, really interesting. Yen weakness in the last couple of sessions, 160.81, partly data driven. Is it driven by intervention? Gold in focus, and Brent crude at 71.81, pretty flat. Actually, let's have a look at the European equity market map. The European map then showing you that we've got these modest gains across European stocks. The CAC 40 is pretty flat. The DAX is getting the best of the gains, up by 0.4%. So let's get things started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Anna Edwards in London. Francine Lacroix is with us in Aix-en-Provence, as we just saw. More from Francine on the ground in a moment. Let's get back to the big macro story of, well, the week, arguably. US hiring has slowed sharply in the month of June, even as the unemployment rate fell, curbing some of the momentum in the jobs growth this year. The Trump administration, however, is remaining positive about the overall performance of the US economy.
I think this is a really strong, healthy job market, and that this was a little bit on the other side of expectation, but the trend over 3 or 4 months is consistent with our view that, again, that we were growing about 3% and that we're going to have a better second half of the year as those factories turn on the lights.
Let's bring in Bloomberg Markets Today editor Morwenna Coniam to give us the market's perspective on this. Good morning to you, Morwenna. So we've got the positive sort of political spin, I suppose, from Kevin Hassett there. How are markets seeing these numbers? The big thing seemed to be a pushing out of expectations around the Fed, and it was positive for risk assets.
Absolutely. We saw a rally in treasuries with yields coming down, particularly at the shorter end of the curve, which is more sensitive to rate hikes. What we really saw was a paring back of bets on when a Fed rate hike would happen. There is still one expected this year, but that's now looking potentially not until December compared to October. And in terms of the actual next meeting, which is this month, we're only seeing about a 20% chance now, down from about a 30% chance of a hike. So there was quite a significant shift, and it was a shorter day for treasuries yesterday. So that does also potentially, skew, I think, the reaction. We saw the dollar weakening, and that's still the case today as well.
Yeah, and thinking about what it means to the Fed then, so there's that pushing out of expectations around a Fed hike. Is this a challenge for Kevin Warsh, or this is actually maybe what he wants to see? He doesn't want to see an overheating labour market. He doesn't want to see that pushing up inflation any further, perhaps.
No, it's definitely quite reassuring, because the concern had been that things were heating up too fast. I think oil prices also do play quite a significant part in this. They've really eased off and that's reduced the inflationary pressure. That makes it a lot easier to justify not hiking, which I think with all the political pressure on the Fed as well from Donald Trump at the moment, that is probably quite advantageous. I think it makes it easier to say that the economy is growing, but steadily. That there's nothing we need to do here, and I think that probably makes it easier for him. It was overall quite a good report for him, if not necessarily for the labour market, particularly younger people in certain pockets where we did see an actual slowdown.
Okay, Morwenna, thank you very much. Bloomberg Markets Today editor Morwenna Coniam on the data picture out of the US. Sticking with news flow stateside, Bloomberg understands that the US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. Top officials have been actively exploring ways to remove Fed governors to clear the way for the president's own picks. The Supreme Court recently blocked an attempt to fire Governor Lisa Cook, but she is still apparently a target.
Get her off.
How would you do it at this point?
By winning the case. They sent it back, not based on the merits, they sent it back on process and procedure. So we'll start the process, and we'll do perfect process and perfect procedure.
We're joined now by Bloomberg's chief Asia correspondent here in London, though, Ros Matheson, and keeping an eye across all of this global news flow. Ros, good morning to you. So what is driving President Trump's efforts here? He's wanted to reshape the Fed. He's got a new Fed chairman in the shape of Kevin Warsh, but he seems to think his job is not yet done, despite what we heard from the Supreme Court this week.
Well, that's right. And we also know that Donald Trump doesn't always like to let certain things go. And he's certainly got a particular view when it comes to Lisa Cook and also to Jerome Powell, who he believes should be vacating the Fed entirely. And he does still want to reshape the Fed further. He wants to look for further opportunities, further vacancies to potentially look to install or try and install people who he feel might be more amenable to his view about where interest rates need to be. And again, as we're just hearing, like he wants those lower, lower, lower all the time, despite whatever the economy or inflation is saying. So he still wants to find a way to try and get rid of Lisa Cook. He says he's going to look for different avenues to do that. The reality is whatever happens is still going to run into those legal challenges. It's going to get bound up in the courts again. But he's looking for any way to continue to build the Fed into what he wants it to be. And that's really about looking for ways to remove people he thinks might be roadblocks to that.
Yes, and putting his own people in. So do we have any understanding, Ros, yet of who the people are, the types of candidates who might be successful in getting these jobs at the Fed if and when they become available? I think I was reading the Treasury Secretary might be scouring for candidates.
Well, that's right. The opportunity here is at the Atlanta Fed, so one of the regional Fed jobs, and who's going to be installed there. Of course, in theory, the regional Fed presidents are appointed by their local board of directors with sign-off from the Fed board, so they're a bit removed from that centralised process. But obviously, we could see that the nominations for that, the candidates, were being interviewed at pace until about May, and then things slowed down. So now Kevin Warsh has come in, and it's going to restart. So perhaps with his careful eye on who they might be looking at. We know they've interviewed a ton of candidates for it. Rebecca Patterson from the Council of Foreign Relations, for example, Michael Summerlin, who was an advisor on the economy under the Bush administration. We know from our own reporting there's a sense they want someone with a corporate background, someone who comes from business. Perhaps they think they might have a more amenable view again about where interest rates need to be. But obviously what they've done is they've slowed it down to allow Kevin Walsh to come in. Now he's in, he's going to be keeping a particular eye on this, obviously, in terms of who might be suitable.
OK, Ros, thanks very much. Bloomberg's Rosalind Matheson with the latest on the reshaping of the Fed. Let's put all of this together and think about where we are on global stocks. Stocks rebounding after the sell-off this week. That's the story of the moment, the story of today. We're joined now by Koku Agbublua, who is the Global Head of Economics, Cross-Asset and Quant Research at SocGen CIB. Nice to speak to you, Koku. Very good to have you on the programme. So I wonder where this leaves us this week, what we've learned in terms of the stocks picture heading into the second half of the year. Do we feel a bit more positive about it after pushing out expectations of rate hikes, or is that not material to your view? What have you learned this week?
I think this week has shown how resilient the market has been. And if you look at the Kalecki equation, it says corporate profits is equal to budget deficit, business investment plus net export minus household savings. All of these are essentially pointing to the right direction in the U.S. You have the OBA, the One Big Beautiful Bill, etc., the CapEx investment on AI, etc. So they are pointing out to a pretty an interesting boom, not of prices, but of earnings and profit margins. And I think the market is simply catching up to this incredible alignment of stars in the U.S. equity market.
And you think that is still the story out of the U.S.? Because we've been watching how hyperscalers have underperformed other stocks. Certainly, it's become a more global narrative, hasn't it, where the gains of AI will be accumulated. You just have to look at the gains that we've seen on memory companies in South Korea to see that. But you still then are positive about the tech story in the US.
Absolutely. I think the AI theme is broadening. So if you think about the numbers, you have $800 billion being invested in CapEx to build data centers. But if you have to think in terms of the global TAM, so the total addressable market for AI. So some quick estimate, rule of thumb numbers, the global GDP is around $120 trillion. Total labor income share of GDP is roughly 50%. So that's $60 trillion. And if you think about jobs that AI can disrupt, so this is knowledge workers, is 30% of that $60 trillion. So $18 trillion. So let's assume AI has 10% market share. That would be $1.8 trillion to be compared with the $800 billion. So U.S. companies have had a long time where they were doing share buybacks and dividends, etc., not doing any capex. And now they're going through a process where the return on invested capital of this capex is higher than their cost of capital, and the market is assuming that will pay off in the next couple of years. And you can already see that. If you look at agentic AI being more token intensive, etc., etc.
Okay, so we can tell a positive story about how AI is going to boost productivity. Maybe it takes out some jobs, but if it takes out as many jobs as you just suggested, Koku, where does that leave an economy that is very consumer driven?
Yeah. So I think Paul Tudor Jones has made this point that I find pretty interesting, is that no man is better than a machine, but no machine is better than a man with a machine. So I think the opportunity for increasing productivity through reskilling people, and you see that with any sort of industrial revolution, the ability to do more, and also looking at other use cases, so robotics, autonomous vehicles, etc., etc. So I think I'm more optimistic on the ability of the labor force to reskill itself. And let's not forget one thing. There's a risk if you take the human out of the loop of compliance, legal, regulation elements, and ultimately having the human in the loop is something that will make sure AI is used productively at sort of societal level.
OK, I was devastated for a moment. I feel much better now. Koku, thank you very much for that. So let's go back to the broadening story. There are lots of ways you can think about broadening or rotation. You can think about the AI trade broadening and rotating into other parts of AI, or you can think about broadening market gains in completely different sectors. But still there might be an AI dimension, like healthcare, for example, areas where Europe can do pretty well. So how do you think about the broadening benefits beyond the sort of initial first mover gainers?
I think the broadening benefit is essentially being expanded industrials, the material sectors, energy, for example. The renewable angle is also something that is booming in the sense after what we've gone through with the Strait of Hormuz. I sort of think that this is, if you look at small caps outperforming large caps, you see that phenomenon. Europe is also a great opportunity given all the need to invest in its autonomy. If you look at the Letta and the Draghi report, these are mega trends that are not going to stop in the short term. So, I mean, to sort of conclude, you could think of the quote by the great philosopher Rocky Balboa, who said, it's not about how hard you hit, it's about how hard you can get hit, but keep moving forward. And this pretty much is the lesson of risk assets over the past sort of 2 years, from the tariff debacle to the Iran situation, and yet we're still powering forward.
Is there a boxing metaphor in investing? You have to be light on your feet, I suppose, right now. Is that important?
Absolutely. This is the Muhammad Ali angle, so float like a butterfly and sting like a bee. But my favorite one is Mike Tyson. Everyone has a plan until they get punched in the face.
Yeah, that seems really appropriate right now. For so many plans being punched in the face by AI and the fast developments that we are seeing there. So all of that sounds like there's lots of opportunity in it, Koku, for investing, and you've been through some of those. Are we going into a higher interest rate environment, a higher inflation environment, and does that threaten to undermine any of the exciting investments of the future that you might be thinking of?
Yeah, so I think growth is diverging across countries, but there's a common theme around inflation that is sort of uniting all of the central banks. So you could see the ECB raising interest rates. The probability of a second hike by the ECB in September is down to 40%. The US was close to 50%, now it's down to 40%, because there was this argument that Kevin Walsh made that AI could sort of reduce wage inflation, but it is inflationary in the short term. So I think inflation is clearly above the central bank target. And I think it will ultimately depend on the situation in Iran with the US.
Yeah.
The metaphor I like to use here quickly is the three-body problem, which is a problem in physics. So you have two planets orbiting against each other. You have a perfect predictability. If you have three planets with gravitational pull, it is called deterministic chaos. It's unpredictable. So this is a metaphor for US, Iran, and Israel with the Lebanon situation, etc. So within the next 60 days, we'll have to see if they find an agreement on uranium or the toll fees on the Strait, and whether we have the risk on the Strait of Bab el-Mandeb, which is at the bottom of the Red Sea with the Houthis in Yemen, etc. So the situation remains highly unpredictable.
It does, and that's one area of potential volatility. I mean, I guess I was asking about inflation because I was also thinking about an increasingly regionalised world.
Yep.
Is that also part of the AI narrative, or just the global paradigm that we're in right now?
That's a very good point, because there's a sovereignty element on data centers for countries. So Europe has to have its plan. Asia is going very fast, the US obviously. So I think if we get more deglobalization, then you lose the sort of economies of scale that globalization has brought so far. So this is clearly one of the risks, and we'll have to see how central banks respond to that.
Okay, Koku, thank you so much. Really thought-provoking stuff for a Friday. Koku Agbubloa from SocGen, Global Head of Economics Cross-Asset and Quant Research. Coming up on the programme, Philippe Aghion will be with us, who won the Nobel Prize for Economics for his work on creative destruction. Wondering if he's just listening to that conversation. We will discuss the future risks to global growth with him next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is The Pulse. I'm Anna Edwards in London. Francine Lacroix is on the road. Let's get to her in a moment. She's thinking about the ECB because fresh from their difference of opinion on future rate hikes at the ECB symposium, central bankers and policymakers are in France and they're gathering at Aix-en-Provence, the economic forum that takes place there. Francine is amongst them and she's back with us now with the guest. Francine.
Anna, thank you so much. We are here at Aix-en-Provence for the Rencontre Économique, and I'm delighted to be joined by Philippe Aghion. Of course, he is a Nobel Prize-winning economist. Mr. Aghion, thank you for joining us. As
Very
always,
nice to
now
meet
we're going
you.
to talk about tech, we're going to talk AI, but actually, what do you see symptomatic as a concern for Europe? We worry about inflation, but actually what happened with the Strait of Hormuz has limited inflation, or it's coming down.
Yeah, of course. I never thought that Hormuz would trigger the equivalent of the global financial crisis. I knew that it would trigger, it would induce a small increase in inflation and a growth slowdown and a slowdown. And that's what it did. I mean, of course, when the price of oil goes up because you have the Hormuz crisis, of course, it means that the production costs go up. And production costs going up, of course, price go up. I mean, that induces inflation automatically. And it induces also a reduction in growth because both on the supply side, the input costs increase, right. And of course, and you don't get as much oil as you need, and therefore production is somehow disrupted, and also people have to spend more on gasoline and petrol and less on other things, and so so that of course depresses the demand, and right. Those forces concur to reduce growth a little bit. But I never thought it would go beyond 1% increase in inflation or 2% and a 1% decrease in growth rate. You see what I mean? And that's exactly what happened. And now that you had some kind of an agreement, even if it's not a complete agreement, inflation will go down and growth will slightly resume.
Monsieur Aghion, talk to me a little bit about AI and tech. This is what you're known for. Are you worried that actually it will reshape our economies, especially in Europe? What does it mean for productivity and jobs?
Alors first, you have Europe. It's clear that after a period of catching up between 1945 and 1985, per capita GDP of Europe was catching up partly with US per capita GDP. But then since the late 1980s, again, Europe is losing to the US. Because the US, they went into high tech, they went into the biotech and the IT revolutions, and Europe failed to enter those revolutions. We remain stuck in mid-tech incremental innovation, and that's why we lost to the US. Okay, but
can
now
we catch up?
And AI is an opportunity for Europe to resume growing faster. You see what I mean? But we need growth. AI has a high growth potential because it's easier to produce goods and services. It's easier to produce new ideas with AI. And now that we need to harness this power. So we need a true industrial policy in Europe. Europe has, in the name of competition policy, Europe has precluded industrial policy. We need to go really fully in industrial policy, defense, AI.
But Europe doesn't have the hyperscalers. Europe doesn't have the LLM models. So how can Europe actually harness the AI compared to the US that seems to have everything?
Well, I will tell you what we have. I mean, Europe, first, we have a lot of savings. You know that there's much less saving in the US. We need to make sure that European savings are invested in large part in Europe, okay? We have talents. We have very good mathematicians, researchers, a lot of breakthrough innovations worldwide, cite European research. We have cheap energy. That's very important. In France, we have nuclear energy. That's great. And we have very cheap energy. So we have values. We carry democracy and freedom more than the US, and we have a better social model. AI will mean job creation and job destruction. You need a good flex security system to accommodate that. In Denmark, when you lose your job for 2 years, you get 90% of your salary. The state restrains you and helps you find a new job. We are much closer. We are in Denmark, but other European countries were closer to Denmark than the US is. And so we have a social model as well that will better accommodate the job creation and job destruction induced by AI.
Monsieur Aguillon, you've been, of course, one of the closest advisors to Emmanuel Macron as president over the last 10 years. We're looking at French election in April of next year. What do the French people want when it comes to fiscal and also taxes?
Now, what the French want, I will tell you what they want. They want to make sure they are part of the process. They know we face challenges. The AI, the new geopolitics, the value chains are being reshaped, the resilience becoming the driving force of value chains now worldwide. They know that they have to face this challenge, but they want to make sure that it will be all together, that nobody will be left out. So you need a new de Gaulle. You need someone who will say, look, education, no matter your social origin, you will get good education, good health. If you lose your job, we are there to help you, retrain you, help you find a new job. We need industrial policy, we need sovereignty, and that's the Gaullian agenda. We need a new de Gaulle.
But who is that? Who is that person?
Yesterday, the Prime Minister spoke like a new de Gaulle.
You believe that?
That's what other people see. I can't say he's the only one, but yesterday was a very important moment. Yeah. He never said he would be a candidate, but he spoke like a new de Gaulle.
Monsieur Aguillon, can you actually, have growth and think about growth differently with all of the policies and all of the investment in education, whilst at the same time actually sticking to the rules that the EU has set?
I will tell you, the EU has to change its economic doctrine. We used to say, well, deficit should not go beyond 3% of GDP, putting in the same basket pensions spending and investment in growth. We can no longer do that. We have to adapt to have new way to implement the Maastricht Treaty. Second, in the name of competition policy, we precluded industrial policy, sectoral state aid. We have to stop that. We need DARPA. We need the equivalent of the American Defense Advanced Project Agency in Europe. And we need to have an industrial policy which is in line with competition policy. We can reconcile the two. And three, we need the savings. We need to make sure that they will be invested in Europe. We need more venture capital, more institutional investment, and more long-term funding of research, of basic research. Those things we need. And that gets you to Draghi, to Letta, and to the Bocconi report.
Are we closer to, very quickly, are we closer to actually putting some of the things that they put in their reports?
I will tell you something. I don't know if it will be done. Well, there is the 28th regime, all the discussion on the 28th regime, which is, I think, very positive. Anybody wants to do a new kind of unicorn can benefit from a regime which is the 28th regime, not go through all 27 regulations, country. And then the other thing is that I believe that a lot will happen with coalition of the willing. You will have countries that are leading the game. France has to be among the leaders. I can see Germany, I can see the UK, because the UK wants to get back to us. Maybe Sweden, maybe Italy, I hope. But it has to be a coalition of the willing, to have joint DARPAs, to have joint institutional investors, to have joint markets for high tech, to give more to the European Research Council so that the European Research Council can fund labs, not only individuals. And that I think we can do. I'm very optimistic.
Philippe Aguillon, thank you so much for your time today. That is it for now from Aix-en-Provence. Anna will be back, and of course we're speaking to the Veolia chief executive, and then we have the big exclusive interview with the new Banque de France governor.
Francine, thank you. Francine Lacroix there with the Nobel Prize winning economist Philippe Aguillon. As she says, she will be back shortly. She'll be speaking to the Banque de France governor, also speaking to the CEO of the French utility Veolia. I see utility stocks, the best performing sector in Europe today, as European stocks make modest gains, up by 0.3% on the stock 600. We'll be back with more from Aix-en-Provence shortly. This is Bloomberg.
we are dealing with supply issues, and so therefore fertilizer, the planting season, food security is high up there, but so too is fuel. And energy. So yet again, as we had with Ukraine, the energy crisis, the food crisis, the cost of living, and that kind of fiscal space needs to be created for countries that are going to be dealing with the debt crisis. They are still repaying their debts. Inflation will result in interest rates that will put many countries in jeopardy on the debt issue. So we're looking to find solutions here from the IMF, from the World Bank. There have been many offers of the windows and facilities that could be put at the disposal of countries. But I think at this stage we need scale. Many countries are still recovering from the previous shocks, and some of those crises are not over yet.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Good morning. Welcome to The Pulse. Welcome back to The Pulse. I'm Anna Edwards in London, and these are your top stories. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after a weak U.S. jobs report. Bloomberg understands that President Trump and his allies are renewing a push to reshape the Federal Reserve, with Governor Lisa Cook still a target. And Bloomberg learns that some European countries have accepted that ships transiting the Strait of Hormuz will now have to pay fees to Iran and Oman. Now, the French Finance Minister, Roland Lescure, has told Bloomberg that he will push for a finance bill for next year that brings a further improvement in the French public finances. He was speaking at the Aix-en-Provence Forum with Bloomberg's Caroline Conan.
We must have a budget, because the alternative is not really a go. If we don't have a budget, we have what we call a special law, which more or less freezes the budget compared with last year. That means that spontaneously the deficit is going to increase, and spontaneously we're not going to be able to put more things in action, more policies that are going to be pro-growth or pro-business. So, yeah, it's not an option. We have a hung parliament, as you know, 11 different political groups, so we have to convince a majority to vote it. I think that reason will prevail. I know that some of those guys see themselves as a president. I don't think they want to inherit a situation that would really lead them to waste their first year. They probably want to be efficient. They probably want to be able to correct the budget if they don't like it. So the most likely, I hope, scenario is we have a budget, it's not perfect, but we've managed to vote it, and then debate can happen for the big election.
But we've seen obviously what happened to the former Prime Minister the past couple of years, Michel Barnier, François Bayrou, both ousted because of the budget. Are we going to see a similar situation? Can you actually cut the deficit at the moment, given we still have a fragmented parliament?
Well, we did. We did last year. As you know, we were 5.8 in 24, 5.1 in 25. This year is more difficult because we've had a crisis. Hopefully it's over. But the Iran crisis had a big impact on growth, on inflation, and very likely on public finance. We're having a big meeting next Tuesday. We call it the Alert Committee with all the stakeholders, so parliamentarians, trade unions, company representatives, also the representative from local authorities to discuss this. We want to assess the state of the economy, assess the dynamic of public finance, and hopefully commit everyone to making the efforts we need to do to keep public finance under control.
So what's your target for deficit cuts next year? Because this year obviously targets 5%. Are we going to reach that? And next year, what is the target?
So we're going to do everything we can to reach or to be as close as possible to 5%. We're still in the midst of assessing the impact of the crisis. There's lots of uncertainty. I think the third quarter is going to be key. As you know, inflation as we see it in France and elsewhere in Europe, this is the time for recovery. And I hope that households, companies, everyone's going to just get together to make sure we have growth. And if we do have growth, hopefully we'll have a better outcome on public finance, but it's still very uncertain. I want 5%, and I hope we will reach 5%.
For next year?
For this year. And I want to make sure that next year we have a budget that brings us below 5%. This is still in the air. We have to work on our budget. This is the work of this summer. We're going to present it by September. But this is what I like to have, and this is what I hope we're going to have.
The French finance minister there, Roland Lescure, with his hopes for the French economy. Let's stick with the coverage from Aix-en-Provence, where Francine Lacroix is standing by again with another guest. Francine.
Thank you so much, and I'm delighted to be joined by the Chief Executive Officer of Veolia, Estelle Brachlianoff. Thank you so much for joining us. Look, I mean, there's a lot to talk about: inflation, energy. I also want to talk about biomethane. But if we start with the record heat wave that we've seen across Europe, what does it mean for your company?
I guess, this is quite striking that probably today the temperature in London is higher than what we have in Aix-en-Provence, which means that, the entirety of Europe is realizing that climate change is happening, and it's not just something in the future. We live it in our blood, unfortunately, and in our flesh. So which means that the big debate is not only about how do we fight against climate change, but as well how do we adapt to climate change. And adaptation to climate change, there is a very quick jump into water, because this is the first consequence of climate change. It's on water. Drought followed by floodings at times, extreme events, and that's exactly why we have to cherish water. And probably one day we can get rid of oil, but probably not of water.
But when you look at water and actually water demand for Veolia, do you see that increasing significantly already in the next couple of quarters, or will it take longer?
Oh, it's very immediate, when you have a big, like heat wave, people consume more water, but it's the same for agriculture, irrigation, for instance, and same for industries in the same time. That's why what we do is try to avoid as much as possible to have to limit and restrict the usage of water. And that's why cherish water, it means what? It means avoiding wasting water, and finding new sources of water, regenerating it, recycling wastewater, for instance. So we have a series of solutions we can develop. They are ready. We know it works. We've learned them from the south of Europe, and now the northern part of Europe is learning how to live with those heat waves and adapt to climate change.
Talk to me a little bit about inflation, because we've seen this, of course, massive war between the US and Iran that led to inflation going up because of the price of energy. Does that complicate your life a lot?
So I would start with making the link between your first question and the second one, if I may. The Strait of Hormuz and war in Iran. The first thing is, we are very present in the Middle East, in particular because we are the leader worldwide of desalination technology. So we operate a lot of plants in the Middle East, and they are a critical resource in the Middle East, where up to 90% of the water comes from desalination, seawater desalination. So they are protected with Patriot missile around them. So we have to visualize it. This is not abstract. Water is absolutely a critical resource. And it is the same in Europe, but of course in the Middle East it's in this one. When it comes to inflation, Veolia is very protected because we are, one, a multi-local company, so we are present in the Middle East, but in 45 countries. And two, our contracts are very well, indexed. So the higher the cost base, at one point we're reflecting back into the cost we charge to our customers.
It's going to be a big 12 months for France going forward because of the presidential elections.
I thought you were talking about football. Sorry.
I mean, football, yes, and most of us are behind France, although I shouldn't say, because I'll get the wrath of many, many other guests. But when you look at a lot of the presidential candidates that are here actually in X, what do French companies need?
The first thing is some type of stability and vision, which is what all companies need to invest in France and in other countries. Then invest in the future, so invest in infrastructure to make our country more resilient, to make our country even less dependent from importing things. That's why, you know, like to be able to recycle water, to be able to recycle strategic minerals, to be able to find new sources of energy locally as opposed to importing fossil fuel, all that contributes to strategic autonomy. So I guess I would have a wish for the presidential election that securing critical needs is in the agenda of the various candidates, because it's absolutely critical for the country to thrive, for the economy to be competitive, and even for the defense in a broader sense.
Yeah, how much do you worry about deficits?
Deficit, of course, is a big subject, and it should be. But I would distinguish between the debt, which is here to pay, you know, in a way, operating costs, as you would say it in a company, which will be social expenses, versus the debt, which will be here to invest in the future of the country, in education, in critical infrastructure, like I said. And I guess, you know, we should have a different type of approach of the two types of debts, because, you know, one will bring wealth and competitiveness over the long term, and it's absolutely critical we invest in that as well as in innovation and AI, for instance.
But do you think this is one of the main pillars that actually will decide the next French election, or will it all be immigration and other matters, more social matters?
I guess I was told one day by non-French people, you French are only about politics, never about the economy. And usually we have some type of striking back to, yes, the economy is stupid. I don't know if France is like that, but there will be probably a lot of debate about the economy, the debt. But in my opinion, it should be a lot about where do we invest, as opposed to only how much we invest and how much can we afford it. Where do we invest? Again, to secure the future of the country.
Talk to me a little bit about biomethane. So this is one of the big hopeful things that actually France and other countries should get in, but it's not viable without government subsidies.
This is a very good example. When I say strategic autonomy and securing critical resources, energy, we don't have any, you know, oil and gas in France. So we import, in particular, some fossil fuel, but there is a lot we can replace by local source of energy. Biomethane that we produce out of waste and wastewater is one, and a lot of bioenergy which can locally be sourced. Right. This is a reservoir which is largely untapped, not only in France but in Europe. At the European scale, it's 400 gigawatts. 400 gigawatts, just to give you an idea, it's 400 nuclear tranches, so it's massive. And it's a third of the import, which we could replace by this type of energy. So what does it need to be happening? We need a clear vision at a country level of, you know, we want to develop, say, 10, 20% of biomethane in that case in the next 5 or 10 years, and have a stable vision over the various governments which can change, and a little bit of subsidies, but it's more a signal, political signal, which will be stable over the time than only public money. Usually you can go without public money if you have a stable signal, an economical signal, a price one, for which is stable.
But are you confident that this is that direction will be taken?
I'm a fighter and optimistic at the same time. I'm not an optimistic by definition, so I always fight for what I believe should be, you know, like the priorities.
Thank you so much for joining us today. That was, of course, Estelle Brachlianoff, the Chief Executive Officer of Veolia. With that, and I'm going to send it back to you in London. It definitely has a bit of an economic festival vibe here in Aix.
Yes, I guess that's, Friday in the sun. Francine, thank you very much. Francine Lacroix there with the Veolia CEO, and they were talking there about energy prices, which takes us on to the next conversation very nicely. Bloomberg has learned that some leading European powers now accept that ships transiting the Strait of Hormuz will have to pay fees to Iran and to Oman. The US and Gulf Arab countries continue to insist that Iran and Oman cannot impose charges of any kind for the Hormuz Strait. Let's Let's get now to our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar, who's got the latest news flow on this subject. Abir, good morning. So why do some countries think that fees are inevitable? Why is the European contingent kind of coalescing around that view?
Good morning, Anna. Yeah, I mean, they seem to have fallen in line with what Iran has been saying over the past couple of months or so. Iran has been adamant on establishing these tolls once the 60-day period of negotiations with the United States is over. And so these countries behind closed doors, this is a Bloomberg scoop from yesterday, suggesting that countries in the EU, but also Gulf Arab countries in the region, have kind of succumbed to the fact that this will be the new reality, the new paradigm of the Strait of Hormuz is going to be tolls established once the negotiations are over. What we know from our sources is that countries in the EU, or some countries in the EU, are at least telling the Omanis and the Iranians to not discriminate against ships based on their nationality. Gulf Arab countries and the leaders there in public are opposed to this toll or this system that will start charging ships. But behind closed doors, they also are discussing this new mechanism that will probably see charges coming out of their ships and tankers. And you could really see countries in the region, the richest ones in the region and the biggest oil exporters, Anna, Saudi Arabia, the United Arab Emirates, doubling down on other shipping routes. That includes the Red Sea for Saudi Arabia. That includes the port of Fujairah up north for the United Arab Emirates. And it really just goes to show that Iran has said over the past few months, again, that it will toll the Strait of Hormuz, that it wants to do it with Oman. But if Oman does not agree to the terms that Iran sets out, then Iran said that it is going to do it with or without the blessing of the Omanis. The U.S. obviously, on the other hand, says that it is completely unacceptable to toll the Strait of Hormuz. But we haven't seen a lot of pushback beyond that from Secretary of State Marco Rubio, Anna.
OK, we'll see if we get that then. Abir, thank you very much. Bloomberg's Abir Abu Omar in Dubai. Now, President Trump has said that he will, quote, handle Cuba after Iran. Washington has maintained a blockade on Cuba since the strikes. But the campaign has been ramped up under President Trump, with the island nation suffering widespread shortages of fuel, food and medicine. Bloomberg Originals has been looking at whether Cuba's authoritarian government will bend to Donald Trump's will.
What's coming next for Cuba? Capture and kill is still an option?
I just can't tell you that. We've got options all over the map.
Perhaps no other nation epitomizes Cold War politics more than Cuba.
When you look for a country that's, let's say, punched above its weight on a global stage, Cuba should be on the list.
Cuba and the United States, by default of their geography, have always had some kind of economic relationship. When we had prohibition in the United States, Cuba became a haven for American tourists.
Cuba is just 90 miles south of Florida. It's in the heart of the Caribbean. It's been seen as kind of a strategic platform for U.S. rivals.
The U.S. has had a broad trade embargo on Cuba since shortly after the revolution in the 1960s.
Cuba is ruled by a single party, the Cuban Communist Party, and it controls the legislature, controls the military, controls all facets of society.
Socialismo o muerte. But the socialist idealism that birthed Cuba has ground to a halt, literally running out of gas.
There is a dire jet fuel shortage in Cuba as the U.S. is moving to cut off the country's oil supply.
Crippling blackouts and a teetering economy have sparked unrest on the island.
We have an unprecedented degree of suffering on the island.
The Trump administration has taken a hard line.
Cuba has always posed a national security threat.
Tonight, the Justice Department unsealing an indictment against former Cuban President Raul Castro.
Will Castro actually face this prosecution?
The message the indictment sends to the Cuban government is that the U.S. is serious.
Amid the upheaval, many are looking for change, and some see opportunity.
Realmente me gustaría que Cuba pudiera realizarse.
2 million plus Cubans that live abroad. They have a genuine desire to see their country prosper and the people prosper and move forward into a different direction.
Some highlights there of a documentary. Subscribers can watch that full documentary right now on the Bloomberg terminal or Bloomberg.com. Coming up on the programme, how the Ukraine war is hurting Russia's space ambitions. We will have more on today's Big Take story next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
This is the Pulse. I'm Anna Edwards here in London. Let us talk once again about private credit. Private credit funds are facing a relentless wave of investor withdrawal requests, forcing managers to trap over $14.5 billion of capital to protect their portfolios. For more, we're joined now by Neil Callanan, who leads our private companies coverage here at Bloomberg. So to bring us up to speed with what is the latest then here, Neil, we've got these private credit funds facing, this is now the second quarter of demands for their money back from investors in these private credit funds, and they're trying to hold the line. So what's the latest on this story in the second quarter?
Yeah, it's more of the same, really. Managers had done a great job in the last few years of asset gathering. They had convinced people that it was a great time to allocate money to private credit through these BDCs. And what we're finding is a lot of that money is hot money. It's not money that's used to being in products like this, and it's seeing the headlines about AI and what's going to happen with software and panicking and trying to pull money. And that's a continuation of what happened in the first quarter, but it now looks like similar to what happened post-Brexit with property funds in the UK, that this is going to be a 2-year story at this stage in order for people to make those redemption requests and meet them over time.
OK, so you've got these big redemption requests coming in, and then as a result, you see gating and companies say, no, you can't have all that back. It's going to take 2 years, not just 1 quarter, to return all this money, if that's what you... So that's the latest thinking. So are there funds then, private credit funds, that are handling this better than others? The ones who are maybe not facing such high redemption requests, not having to gate the funds? Where's the outperformance?
Yeah, we're really going to start to see manager differentiation in terms of the performance now. So the people who went heavily into software, we're going to find out if they made the right decisions on those loans and whether their returns are going to justify the risk they took. Obviously, because these are credit, all the equity has to be wiped out before they start to take losses. So then you're really starting to see how badly things can go within this sector. But at the same time, there are managers who have not had the same level of requests as other managers. So you have the contrast between one of the Blue Owl funds, which is very software focused, where redemptions are at 38%, whereas some of the likes of Oaktree and Goldman Sachs, their funds have fallen below the 5% threshold. And that just shows you that the retail market is not homogenous, that there is big differences between that money. Goldman obviously had a probably more diversified portfolio than many of them. And then Oaktree, its reputation over the years has been that it's a steady investor, and then it does well in periods of dislocation and volatility, like now, and that it's a counter-cyclical investor. So as you would imagine, they seem to be doing better in terms of the redemption requests, at least for now.
And I suppose all of this really hinges on the underlying credits involved here and whether the software sector is going to be eaten up by AI or not. And that's still, there's a lot of different thoughts out there and some differentiation to be done within the sector, perhaps.
Absolutely. What we're seeing is some of the BDCs are having to sell loans to get liquidity, and some of those loans are finding buyers at very good prices comparatively. Slight discounts, but not massive discounts. But the fear around that is that they're selling off the good loans first because there's a market for that, and what's left is going to be worse. And that's why, again, it may take 2 years before we really see the full outflow from this.
OK, Neil, thank you very much. Thanks for joining us. Neil Callanan, who leads our private companies coverage here at Bloomberg. Now, as mentioned ahead of the break, Russia's efforts to create its own version of Elon Musk's internet satellite network Starlink is the subject of today's Big Take story. Some 6 years after SpaceX began launching its network, Russia's first batch of satellites finally went into orbit in March, but by June, one of them had reportedly already failed. President Putin called the initial launch, quote, absolutely insufficient, and soon after, the Russian leader's plans for space possibly suffered another blow, with Ukraine announcing an attack on a space communication centre near Moscow. So far, so complicated for the Russian space journey. Let us bring in Bloomberg's Tony Halpin, who leads our Russia coverage and can give us some details on this Big Take story then. Tony, it's a complicated story, an interesting deep dive into the space sector. What are the challenges then facing the director of Russia's space agency? Let's put ourselves in his position.
Yes, I mean, Dmitry Pakhanov is very young for this environment. He's just 40 right now, and he leads an agency which has a history of firsts. You know, during the Soviet period, it was the first satellite in space, the first man in space, the first woman in space. But in recent decades, Russia has fallen far behind, and it's his task really to try and revive those glory years by doing things like emulating Musk in low orbit satellites, by trying to find ways that Russia can get reusable rockets to launch satellites, and to engage in projects like deep space exploration, which is years behind. But it's a huge challenge. I mean, just as you've noted, the Starlink model that he's following, there are more than 10,000 Starlink satellites in Elon Musk's network, and Russia currently has launched just 16.
OK, so yes, so perhaps some more political pressure then on those in this sector coming from the Kremlin. How much is Russia's war in Ukraine affecting the space ambitions that Russia has then?
Yes, it's having a huge effect. I mean, quite apart from strikes on infrastructure that you mentioned, the fact that they're even talking about and building a low-orbit satellite network is largely driven by the fact that Russia doesn't have that. It's been piggybacking until recent months on Starlink, and when that network was switched off, its forces on the front line were left severely handicapped, and as a result, they've tried to accelerate this program. They're years behind on things like reusable rockets. That's been important because they've lost an awful lot of customers for whom they used to launch satellites rather cheaply as a result of the war. So they're facing a funding crunch, a technology crunch, and that's made all the more difficult by the kind of isolation that they're experiencing because of the war.
Tony, thanks very much. Thanks for the update. Bloomberg's Tony Halpin with the Big Take story. And you can read the full Big Take story on the Bloomberg terminal. Coming up later from X, we've got an exclusive interview with the new Bank of France governor. That's Emmanuel Moulin. He'll be speaking with Francine Lacroix for his first TV interview since taking office last month. That conversation is at 10:20 a.m. UK time, so in around 25 minutes' time. Let's have a quick, as we bring this hour of programming to a close, let's have a quick look at where we are on the European equity market story. We are entirely flat, giving up some of the earlier gains. Pretty evenly divided between sectors going higher and lower. Utilities, autos and parts, those are sectors going higher, a diverse range of sectors up to the upside today. We do see a bit of underperformance by the French market, down by 0.2%. Up next, Bloomberg Brief. Have a good weekend, everybody. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are. where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It is 10 a.m. here in London and 5 a.m. in New York City, where markets are closed for the 4th of July holiday. Good morning. I'm Caroline Hepker. This is Bloomberg Markets. Now for our top stories. The yen showing some strength as traders brace for holiday intervention risk. The currency touched its weakest level in 40 years earlier this week. Worries over the AI trade easing. Stocks rebound after 2 days of tech-led sell-off as traders trim bets on Fed rate hikes after a weak US jobs report. Bloomberg learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve, with the governor, Lisa Cook, still a target. Now, Bloomberg's Natalia Krasnovich joins us now for a closer look at the markets this morning. Natalia, great to see you. How has the rotation story moved? Has it actually got more room to run, Natalia?
Yeah, so we do see that we saw a pretty solid sell-off in momentum stocks in the U.S. When I spoke with sources, they told me that on the one hand, there is no specific catalyst for that sell-off because exposure across momentum stocks got so elevated and stretched, so people are taking some profits off the table. We also, when we look at positioning across hedge funds, we see that some of them are started to sell TMT stocks. They move into cyclical corners of the market. This is also part of this rotation story. Another part of that is outperformance across small cap stocks. This is also in part related to short covering or healthcare M&A. So we see this rotation continuing. But overall, U.S. stocks gained closer to the end of the trading session, especially yesterday, because now traders are trimming back expectations that the Federal Reserve will hike interest rates following that jobs report.
Yeah, absolutely. It was much weaker than we'd expected. Dow Jones, though, ended at a record close yesterday. In terms of the second half of the year, which is what everybody is focused on, do you think that what is the outlook going to be for the second half of the year?
Yeah, so again, when we talk to sources and ask questions about what is the most important part of this equation right now, yes, some people are concerned about higher for longer rates in the U.S. However, fundamentals and corporate earnings is still the #1 story in the U.S. And when we look at what analysts expect for the upcoming earnings season, expectations are still really high. The S&P 500 is expected to post about 23% earnings growth for the second quarter. This is still a really, solid expectations. So again, fundamentally, this is a very bullish sign for the U.S. stock market. And then technically speaking, when we look at positioning across different types of investors, retail traders who have become really one of the biggest driving forces for the U.S. stock market, they are still very bullish. They are very very active. When we look at data from Citadel Securities, for example, we see that in May, in June, trading activity was way above historical average. And they also still have a lot of money to deploy because cash balances across U.S. retail traders are very elevated.
OK, how do you think we're going to be set up for next week? Obviously, today is a holiday, so it's going to be much quieter around the world. It has been already pretty quiet. How do you think we're set up for next week? Again, as we are still really digesting that jobs report that we had out yesterday.
Exactly. So we may see that investors will engage again in tech stocks because we already saw that the options market is telling us that some traders are buying call options on semiconductor stocks, the biggest AI names. So potentially we may see a short-term rally at least, but we have to keep in mind that we are approaching July and August, which can be a slow season. And when volumes are thin, sometimes moves in the stock market can be really, exacerbated. And sometimes people, traders, institutional investors, they trim positions during the summer, like holiday months. So we will see. Maybe we will get some short-term volatility at least.
Well, we're starting with the long weekend now, aren't we? Thank you so much. Bloomberg's Natalia Niadyevich, who is joining us this morning. Thanks a lot. Well, now, for a broader look at the markets, we have with us James Lord. He is the head of FX EM strategy at Morgan Stanley. Really good morning to you, James. Thanks so much for being with us. Look, I think we're on watch for Japanese intervention into the yen markets this morning. Are you expecting that to happen today? There's been a lot of anticipation that maybe it would happen on a US holiday. What's your thinking there?
Yeah, I mean, we don't really forecast intervention per se, but I can very well understand why the market is so focused on this. I mean, it wasn't that long ago where we had the intervention from the Ministry of Finance in Japan. It had a temporary effect. Dollar yen has moved back up. I think up until the news that we had earlier this week that was telling the market that maybe the authorities were having a slightly different approach to their intervention, a bit more uncertainty. Before that point, the market was very much attentive to the kind of tone that was coming out from officials, how there used to be in the past this sort of ladder of escalating rhetoric around intervention, that the more forward the tone was, you could sort of see like when intervention might be more imminent. If they're moving to a different approach where you sort of don't have that same level of guidance, then it becomes much more uncertain about the timing. But clearly, thin markets, as you and Natalia were just talking about, thin liquidity, I can well understand why traders and investors are a little bit attentive to that today. All I could say really about dollar yen and how it should behave around intervention is that if we did see intervention, I think the market would be quite quick to buy dollars back. I mean, at the end of the day, intervention does not change or affect the fundamentals of an exchange rate. Free-floating exchange rates are driven by fundamentals over time. So if the dollar is strong, if there's good US data, if there is strong risk appetite in markets for which the yen is often used as a funder, then I think you would see dollar yen start to drift back up again. So that is increasingly the approach, I think, to buy the dollar back or sell the yen after you see that intervention.
Yeah, we know that Japanese authorities have said that they're not going to telegraph their intervention. At least they have signalled that, haven't they? OK, Morgan Stanley is among a handful of more sceptical banks, though, when it comes to seeing continued dollar strength. I wonder how that US jobs report affects your thinking about that going forwards, the strength of the US dollar. Yeah,
well, it encourages us that we're on the right track with the view, really. I mean, markets had become quite enamoured with the US dollar, good data, fairly hawkish Fed. In the FOMC, and you've seen a lot of dollar buying from a lot of our client base. We have not been chasing the dollar higher because ultimately we don't think the Federal Reserve is going to be hiking rates this year. This is a key call from Morgan Stanley's US economics team that the Fed is going to be on hold this year and even cut rates in the first half of next year, which is much more dovish than the market pricing. So, since the FOMC report, we've had, much lower oil prices. Yes. Chairman Walsh referred to the lower inflation risk that has materialized over the last few weeks in the Sintra panel. And we've had this weakish jobs report. So I think all of that helps us to think that we're on the right track with the Fed call. We've got obviously an important CPI report coming up, the June CPI report ahead of the July FOMC. So that will be a really important piece of data to see the path forward. But we're quite comfortable with our sort of fairly neutral view on the dollar at the moment and looking for an opportunity to sell it, really.
Yeah, we're about 10 days out from that US inflation report, as you say. Emerging market currencies gained against the dollar after that jobs report. What does this new Fed pricing in the markets around fewer hikes to come actually mean for emerging market central banks?
Well, we like EM currencies. From a sort of bottom-up perspective, fundamental perspective, policy credibility perspective, and also from a top-down risk appetite, global growth perspective, both of those two things are helpful for EM. You mentioned EM central banks, and I think a key anchor for the asset class for EM currencies is the growing credibility, I would say, of EM central banks, that you don't have the same sorts of conversations as we used to about tolerating higher than above target inflation that we used to have in some EMs. But now I would say that policy credibility is very strong for EM central banks, and that's really helpful for the asset class.
OK, what are your top picks then for the second half of the year in emerging market currencies, especially given that if you look at the MSCI Emerging Market Fixed Income Index, actually you've seen it largely wipe out the gains that it had for the first half of the year. So what are your picks for the second half of this year?
Yeah, so fixed income is, obviously yields have gone up, so that's been unhelpful for total returns. Currencies are kind of just about hanging in there, and there have been some very strong performers, particularly in LATAM, particularly in Central Europe, Hungarian forint, Turkish lira. So we like BRL, we like Colombian peso, we like Turkey, and we like Hungary. Those are probably the core markets that we like from an FX perspective. One thing that we've been talking a lot to clients about, though, is whether they should be diversifying the funding mix. Should you just be long these currencies against the US dollar, or given the uncertainty about the Fed cycle, maybe you should just be diversifying and positioning by short the G3. So you could do dollars, euros, yen, diversify the mix. Actually, that improves the carry that you have because funding in euros and yen is cheaper than funding in dollars. And it lowers the volatility profile of your portfolio as well by taking that more diversified approach. And it allows you to just sort of focus on the EM story. So you pick that basket of currencies that you like, diversify the funding, and I think that would largely sort of insulate you against the sort of dollar cycle.
OK, really briefly, you mentioned oil prices. They dropped 25% in June. Just lastly, on that central bank point around emerging markets, how have they handled that massive swing, a huge jump up and then a ramp down?
Yeah, I mean, I think a lot of EM central banks were very quick to sort of highlight the risk to inflation as oil went up, and many were ready to hike, ready to defend, tighten liquidity as necessary. But I think, now, and there is still a reasonable amount of risk premium for rate hikes priced into a lot of the front ends of EM curves. But I think now that oil prices are back down, if it sort of stays there, we've got a little bit of risk as the ceasefire ends in the middle of August. We'll see what happens after that. But I think, there is quite a bit of supply coming to the oil market clearly now. And if oil prices stay around these levels, I think EM central banks will be quite relieved about that.
Yeah, absolutely. Those 60 days, the deadline coming up in August. James, thank you so much for speaking to us. Really good to have you in the studio. James Lord of Morgan Stanley. Thank you so much. So now to the other stories, though, trending on the terminal this morning. US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. Michael Burry says that the Micron rally has reached historically extreme levels. In a Substack post, the Big Short investor wrote he is shorting the stock, claiming its recent gains have been driven by AI hype and investor FOMO rather than fundamentals. New York City officials are preparing the city for Taylor Swift and Travis Kelce, who are expected to host a celebrity-studded event tonight at Madison Square Garden with about 1,000 guests. The couple have reportedly donated $26 million to local and national charities ahead of their wedding. Recipients include the Food Bank for NYC and Dolly Parton's Imagination Library. So let's take a quick check of the markets this morning. So looking at European stocks, largely unchanged here in Europe. We had seen a record high for European stocks only yesterday. Meanwhile, the Bloomberg Dollar Spot Index sees a weaker dollar, down about 0.1%. Of course, the weak US jobs report, lower oil prices has really challenged the expectations for Fed rate hikes, and that has weighed on the dollar. It could well see its worst week since April. And then just lastly, no cash treasuries trading today. So I brought up some European bonds for you. European bonds selling off, yields for German bonds actually relatively flat at the moment, 293 for those benchmark 10-year government bond yields in Europe. So those are the markets. Coming up, the SpaceX IPO breaks records. We will hear from Charles Schwab CEO Rick Wurster with his outlook for future IPOs. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
There are always problems on Earth. There are always problems on Earth. There are always things that we wish to be better, that we want to solve here on Earth, and we should solve them. But there also have to be things that get you excited about the future, that make you glad to wake up in the morning, because you can't wait to see what happens next. And that's the future that SpaceX wants to bring to you.
And that was the SpaceX CEO Elon Musk with his vision for the company. The SpaceX market debut shattered records, becoming the largest IPO ever and setting the tone for future market debuts. Bloomberg's Anne-Marie Hourdin spoke to Charles Schwab CEO on the outlook for the IPO markets.
And so you're seeing tremendous interest in AI-related names and the space names. I think it comes from the retail investor being able to touch and feel the level of innovation in our economy. And I think clearly they're holding names that are doing, stocks that are doing well with really strong fundamentals. Exactly what the returns will be, only time will tell.
This was like a Super Bowl moment for financial markets, and we learned that there were war rooms. You set up various ones, and you increased your team. Can you just give us some color? Where were you during all of this? What was the vibes like in these war rooms that you set up?
It was a pretty amazing event in that It was one of the top 5 most active days for our clients in the 50-year plus history of the firm. And if you think about all the market events we've had over those 50 years, for the IPO to crack the top 5 is pretty unbelievable. We had 140,000 clients call in live. We had lots of digital engagement. It was impressive to see, and our teams were fully staffed, ready, and able to handle our clients' needs that day. It was wonderful to see the teamwork and the effort that went into making this a success on our side.
How do you think this is going to establish potentially what's next when it comes to other mega IPOs like Anthropic and OpenAI?
Hopefully it establishes retail having a really strong presence at the table. I think it's wonderful for the retail investor to be able to participate in something like this. So I hope this IPO establishes that. I think it also establishes an incredible level of interest among our client base for new and innovative technologies and being able to participate them. We recently closed a deal with Forge, which allows our clients to invest in pre-IPO companies. And so I think that the interest around these new ideas and emerging companies is quite high and will only continue.
Charles, Rick, the point that you just made is actually really important, given the fact that people note that increasingly the value is being created before the IPO when companies are still private. Do you think that some of these IPOs will expedite the efforts to get access to retail investors into private markets through a whole host of different ways?
I do think it will expedite it because people will have interest in getting in earlier because these companies are waiting far longer to go public. And so there's a lot of value being created while they're private and people want in.
That was Charles Schwab President and CEO Rick Wurster there. Well, let's get a quick check on the markets now, shall we? With the United States closed for a holiday, let's look to the European stocks, which are higher this morning on the Stoxx 600. We saw a record close yesterday, so it looks like 2 days of gains. Lots of attention, though, on the declines for the semiconductor index over in the US, the SOX, which dropped over 2 days, 12%. But as I say, markets shut for the holiday in the United States. The Bloomberg dollar spot index at the moment is slightly softer. We're down this morning. And looking at those German yields here in Europe, you're seeing yields nudging a little bit higher. The weak US jobs report, lower oil prices, really challenging expectations of Fed rate hikes. So that has weighed on the dollar. No cash treasuries trading. So we've seen something of a European bond sell-off this morning. So that's where we stand. Nasdaq futures are also up today. That's a look at the markets. Coming up, semiconductors reported their strongest quarter ever, but investors are questioning whether the rally can continue. We'll discuss next. This is Bloomberg.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Caroline Hepker. Chip stocks posted their best quarter ever, driven by insatiable demand for AI equipment. But after recent jitters sent these stocks tumbling, investors are wondering how much further the rally can go. Bloomberg's Matthew Bloxham joins us now for more on this. So just tell us firstly, Matt, what is behind the rally that we've seen in terms of these chip stocks?
Yeah, and it's been quite the rally. Philadelphia Semiconductor Index maybe up around 100% this year. Most of that in the second quarter. And it's kind of really this kind of second wave, if you like, of AI that's coming through, and this huge investment we're seeing from the big hyperscalers in AI infrastructure, and the realization that actually memory chips in particular are a massive part of that expansion. And that, you know, I guess this has caught the semiconductor industry a little bit unawares, and that they haven't had enough capacity to kind of really deliver against the demand that's out there.
Yeah, absolutely. So some questions really about the sustainability of this trend. Matt, we're going to have to leave it there. Thank you so much for being with us. Yeah, it's brief, but I really appreciate you coming on set. Matthew Bloxham there taking us through a brief look at, well, the AI demand. Coming up, we're going to hear from the Honeywell Aerospace CEO on the company's spin-off from Honeywell International. This is Bloomberg. So let's have a look at the markets briefly before we leave you. So the European market seeing some gains this morning on the stock 600. We saw a record high yesterday. We're seeing, well, eking out a little bit more of a gain this morning. Remember, US stocks are closed for the holiday today. And the weak US jobs report, lower oil prices mean that we have come off in terms of rate hike expectations on the Fed. We're only pricing in about 50 basis points of hikes by March of next year. Looking at the dollar, of course, all of this is weighed on the dollar. That is slightly lower on the Bloomberg Dollar Spot Index. No cash treasuries are trading in the US. So looking at those German yields, 2.92 for German Bund yields this morning. That is where we are on the markets. We'll be back with more updates on the markets in just a moment. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It is 10:30 a.m. here in London and 5:30 a.m. in New York City, where markets are closed for the 4th of July holiday. Good morning, I'm Caroline Hepker. This is Bloomberg Markets. Here are our top stories. The yen showing some strength as traders brace for holiday intervention risk. The currency touched its weakest level in 40 years earlier this week. Worries over the AI trade easing. Stocks rebound after 2 days of tech-led sell-off as traders trim bets on Fed rate hikes after a weak US jobs report. And Bloomberg learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve, with the governor, Lisa Cook, still a target. Well, let's think about the markets this morning. Bloomberg's Natalia Nijevic joins us this morning to look at what's happening. Markets, of course, are closed in the United States. Stock futures looking quite positive, pretty flat in Europe. Just give us an overview of what's happening in markets today.
Yeah, so we do see that the Nasdaq 100 futures are up by almost 1%, slightly above that level. Actually, traders are now scaling back expectations for rate hikes, which is positive for the U.S. stock market. We also saw a pretty solid sell-off across some of the biggest tech stocks. So maybe some investors are thinking that maybe it's time to go back and come back to some of those AI-exposed stocks. Now, Europe, as you mentioned, relatively slightly higher for the European stocks. Of course, we are keeping an eye on oil prices. So as of now, we see that Brent crude is trading up by 0.3% after a pretty solid, again, sell-off in the past couple of days.
Yeah, absolutely. We're still counting down, aren't we, to in terms of the kind of peace negotiations between the US and Iran. How is all of that playing out in oil markets? We're starting to see more barrels come out of the Strait of Hormuz. How are markets thinking about this? I mean, we've come back down, way back down, haven't we, for oil prices?
Exactly. Yeah, so we see that supply through the Strait of Hormuz is accelerating, which can be bearish for the oil prices, right? So we saw that Citigroup analysts, for example, say that Brent crude price for Brent crude can be somewhere between $60 to $65 per barrel by the end of this year. But again, there are still so many unknowns. But as of now, we see that expectations for lower prices are kind of getting more popular across Wall Street strategists right now. So we'll see how this plays out. But definitely, yes, supply is picking up.
Yeah, well, we saw a 25% drop in terms of oil prices just in the month of June, so that's a real massive retracement, isn't it? What individual stocks are you watching today, Natalia?
Yeah, so it's a pretty quiet day. As we know that the U.S. stock market is closed. However, we do see some movers. So, for example, Stellantis shares declined. The car maker was downgraded, HSBC. Analysts are concerned about cash outflows, and they also say that there is a potential need for destocking. So analysts are saying bloated U.S. inventories and weak market share development are pointing to another need to destock. And by the way, the stock is down by almost 50% on a year-to-date basis. We know that the environment overall across the auto sector is not as great right now. Another stock that I'm watching is Maersk. So that stock is up today. It was raised to neutral from sell at Goldman Sachs, and now analysts are saying that they are turning less negative on 2027 supply and demand outlook. They say that slightly later and shallower acceleration in new capacity growth is expected to be in 2027. And then finally, EQT. So we see that Citigroup analysts, they are still cautious on European alternative asset managers, and they say that AI represents fundamentally a different challenge for those type of stocks. And EQT, by the way, is down by almost 23% year to date.
Okay, Natalia, great. Thank you so much. Bloomberg's Natalia Niedziewicz joining us. Thank you so much. Now, since its spin-off from Honeywell International, shares of Honeywell Aerospace have seen double-digit gains. CEO Jim Courier joined the close to discuss the path forwards for the company.
We're not seeing any decline in the air travel business that affects our portfolio. But I think it's important to understand when we think of commercial aerospace as part of Honeywell Aerospace, there's the commercial air transport section, which is airlines and airline traffic, OEM production rates, but as well as business aviation, where we have a very unique positioning with our products and technologies in business aviation. So half of our OEM business is actually business aviation. The other half is commercial air transport. Our commercial aftermarket business, which is what you're referring to in terms of airlines and flight travel and the like and flight hours, 60% of that is commercial air transport. 40% of it is business aviation. It's truly an underappreciated aspect of Honeywell Aerospace as to how much exposure we actually have in business aviation. And what we've seen as a result of the conflicts and the rising fuel prices is actually an uptick in flight hour traffic for business aviation.
Well, Jim, you mentioned that, being a standalone business, completing this spinoff, you can really just focus on your strategy, not necessarily being part of a conglomerate here. You also see a bunch of sell-side notes coming out initiating coverage of you as a standalone. And Jefferies in particular points out that now you have a chance to run the M&A playbook. You've shut the books on the first day of trading. Where would you say M&A falls on your priority list? Is that something that you're evaluating?
Yeah, so as we discussed at our Investor Day in early June, there's 4 pillars upon our capital allocation strategy. First and foremost is investing capital into our factories and into the supply base to unlock additional capacity within the industrial supply base because we have so much demand for all of our products in commercial and defense. So that number one priority for us. The more we can unlock, the more we can deliver on the $19 billion of backlog that we have, which is up 20% year on year, indicative of how much demand there is for our products and technologies. So that first and foremost is our top priority. Unlocking the supply base, increasing capacity, and deliver for our customers and for our shareholders in that regard. Specifically around M&A, that's number 2 on our priority list. And if you think about what we did when we acquired 2 companies back in September of 2024, Case and Civitanavi, they fit into a very specific framework. First and foremost, technology differentiation. It's what Honeywell Aerospace has been founded upon, is being innovators and differentiating with our technology. So you must have differentiated technology and servicing a demand that's high growth in excess of the growth that we're seeing in our business today, which will outgrow what the market growth is right now for Honeywell Aerospace. If you have those 2 elements, then we look at who are you serving today? Are they the same customers? Are there synergies between what the target company may be doing and what Honeywell Aerospace is doing? And then the 4th piece of that rubric is really around, can we scale you greater than how you can scale yourself? And if you think about those 2 acquisitions that we did in September of 24, they hit all 4 parts of that rubric, and particularly on the scaling front.
That was Honeywell Aerospace CEO Jim Courier. Now, coming up, inflation worries are top of mind for central bankers around the world, and our very own Francine Lacroix speaks with special guest Emmanuel Moulin, Banque de France governor, about his outlook for it. That's coming up. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Markets. I'm Caroline Hepker. On Wednesday, central bankers from around the world spoke on a policy panel in Sintra in Portugal. They talked about the thorn in all their sides, inflation.
The second round effect is probably going to take some time. What I'm really focused on is the indirect effects.
The origin of the shock being higher oil prices, I mean, to the extent you believe that there is now a truce and the prices will go down.
We're not into forward guidance, but we are into framework guidance, which means that it's important that the markets, the analysts, the people understand our reaction function.
Even though now, like fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular.
So the origin of the shock has disappeared, more or less, before we see second-run effects. I mean, there will be some, so that makes it, I think, relatively easy. We might need another hike, but I mean, in all likelihood, and that's, of course, what the market is pricing, but not as much as we thought in June.
We always say we are data dependent. We have our next Governing Council meeting end of July. Then we will have new data again. We will look at how the situation looks like. Decline in the oil prices now, of course, is from an inflation point of view definitely good news.
That's where we're going to have to calibrate our rate path, but I'm not concerned. I mean, I think this is more than doable.
So, as inflation concerns continue to weigh on policymakers, our own Francine Lacroix is in Aix-en-Provence. It looks glorious down there. She has a special guest to continue the discussion. Hello, Francine.
Good morning, Caroline. It is quite special, actually, in Aix-en-Provence. It's a little bit hot, but we're not going to complain, as it's kind of the festival of the economy. I could not be more delighted to speak exclusively now to the Banque de France governor, the newly minted Banque de France governor, Emmanuel Moulin. Monsieur Moulin, thank you so much for joining us on Bloomberg. Talk to me a little bit about inflation. So this is the one thing that the ECB, of course, looks at day in, day out. We had some inflation figures earlier this week that were a touch below expectations. Does it make your job easier?
Well, it certainly is going to make our job easier. It's true that we've been hurt by supply shock, which increased price of energy. And the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well,
is it base
we will have new forecast in September. But I think, we are comfortable in our base scenario. And the news on what's happening in the Strait of Hormuz is globally good news.
I mean, overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two meetings.
Governor, talking about data, so Banque de France has a lot of great data looking at small and medium enterprises, inflation. What are you seeing in the last month?
Well, we've seen, what we've seen is really soft growth. This is not very dynamic. Unfortunately, we had not a very good Q1. We see industry doing pretty well, thanks to investment in defense in particular, and in energy, electricity, and also the boom in AI. We see services much softer and construction much softer. So we don't expect a sharp increase in growth in Q2, but we'll see. We'll see. I think the fact that we have less pressure on the oil price is also good news. So it might make growth a little bit higher than we expect.
So you've been in charge for just over a month.
Yes.
What's been the biggest surprise?
Well, I knew part of the job, but monetary policy is a very serious job. We we use a lot of data. We look at really a big set of data. We look at different scenarios. We have very, technical and in-depth discussion at the table of the Governing Council. We act as Europeans, not as national governors, as Europeans, and we take, the best decision in that context.
I mean, how do you look at AI in the future, what it means for, first of all, inflation? Is it automatically inflationary in the shorter term because of CapEx, and then disinflationary?
That's what we think. Now in the short term, it's mainly inflationary because you have large capital expense, so it's an increase in demand, and mainly in the US for the moment. Then we can expect that it might be deflationary because of productivity gains, but it will take some time before we see that, because we need adoption. We need that AI fits through all the production process in companies, not only generative AI, but really changing the way we produce and we manage our companies. So it will take some time.
What are some of the data points that you look at? I know you look at, services inflation, wages coming up. Is there something that you see as more indicative?
We look at a broad set of data. So we look at, inflation. We look at core inflation. We look at services. We look also at inflation at products that are not linked to the energy to see if there is, broad-based inflation. We look at wages. We don't really see second round effect at the moment. And we look also at expectation, because they are key in terms of our credibility.
And when you look at some of those figures overall, I mean, how is AI going to change what you look at in terms of models?
Well, I think, we'll be able certainly to analyze a much broader set of data. And what we need is also to make sure that we can have real-time, assessment. I was listening to Kevin Walsh that he was saying that we always look at data, which are historical data and which are in the past. And we need to project ourselves in the future and see, we do forecast, but we need also to try to gather a very broad set of data in order to make the best decisions.
Governor Mouna, I mean, France is going to go through a big year. And, the next 12 months will be very crucial because there's going to be a presidential election.
Yeah.
Do you worry about a market event, kind of, bond spreads moving as we've seen in the past?
Really, we've had a minority government for quite some time now. We had some difficulties to pass the budget, but we have a budget for 2026. And we've seen, the spreads very stable. And we have no issue in terms of auctions of our debt. We have solid demand. We have very good bid to cover ratio. So I think, we need to make sure that we stick to our commitments and the government sticks to its commitment in terms of reduction of the deficit. But I don't see a market event at the moment.
Would the ECB stand ready to act if there was a market event?
I'm not into political fiction, and we are doing scenario for forecast, but not for for political events. So we are following the situation, but I think we're in a good shape at the moment.
Governor Mouna, just a final question. I mean, in the next 3-4 months, what will your priorities be as you find your feet?
I'll have, priorities will be obviously our monetary strategy and to make sure that, inflation goes back to our target. That's our first priority. My second priority is monetary sovereignty and payments. And we need to make sure, that we remain sovereign in terms of payment, that we embrace innovation. And that's what we do with the digital euro that has been voted in Parliament, and the Banque de France will be, at the forefront in order to develop the digital euro.
What is the biggest question actually for the digital euro? Because we don't know whether it comes in a portfolio, a wallet. There's so many questions.
Well, there are so many questions, but it's going to be an electronic bill, so you will be able to pay with an equivalent of cash in all, between citizens, in shops, in e-commerce, etc., which you cannot do at the moment with your cash. You have to go through either, a US provider, Visa, MasterCard, or Apple, or these companies. We will have really, central bank money, which will be available to all the citizens in the digital world.
Governor Emmanuel Moulin, thank you so much for joining us. Of course, that's it for now. We'll have plenty more from X, and that was the Banque de France governor, the newly appointed Banque de France governor, Emmanuel Moulin. With that, Caroline, I'm going to send it back to you in London.
Lovely. Thank you so much. That is Bloomberg's Francine Lacqua there. Excellent. Thank you so much for bringing us that interview. Right, let's get a quick check on the markets for you today. Yes, the US markets are closed, but there's still some things to think about here in Europe, where you see stocks actually are rising on the Stoxx 600. We saw, of course, the South Korean Kospi and a big rally in Asia overnight. Now, the Bloomberg Dollar Spot Index is weakening this morning. We had those much softer than expected US non-farm payrolls figures out yesterday, and that has cut the expectations for Fed rate hikes this year and into next year. Then looking at the European bond space, no US cash treasuries trading, of course, today. European bonds selling off just a little bit, really across a lot of the sovereign bonds in Europe, but I've just got the German 10-year yield there, so we're up by about 2 basis points. That's a look at the markets for you. Coming up, much more here. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
This is Bloomberg Markets. I'm Caroline Hepker in London. Now to the top stories trending on the terminal this morning. US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. In sports, Spain delivered a dominant performance in the World Cup to beat Austria 3-0 and book a place in the round of 16. Spain set to face Portugal after its 2-1 victory over Croatia. So that's a bit of the sports news for you. Let's get a quick check on the markets in the next part of the programme. Coming up, Bloomberg Markets with Guy Johnson.
Now, some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell certain portion of their stocks to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in Al Ula, Saudi Arabia, and this is Bloomberg.
Morning, how you doing? Welcome to Bloomberg Markets. I'm Guy Johnson. I'm in London. As we know, US markets are closed today. It is the 4th of July holiday, but obviously it's the 3rd of July. We'll get to the 4th of July tomorrow. What do you need to know? What have we got coming up for you? Stocks rebounding after a 2-day-led tech sell-off. Traders trimming bets on Fed rate hikes after that weak US jobs report we saw yesterday. So let's talk about what we are understanding about what is going on right now. Bloomberg is learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve. That's also in focus, with Governor Cook still the target, and the heat dome has settled over the United States East Coast, pushing New York City to its hottest day since 2012, with temperatures in Central Park spiking to 100 degrees Fahrenheit. I think for the rest of the world, that's about 38, so that's quite hot. But yeah, 100 I think is about 38. Anyway, let's do some more translation and figure out what is happening with these markets. You have a equity market here in Europe that is up. The Nasdaq is certainly having a fairly solid session thus far. We're up by 1%. Brent is also a little bit positive, but the dollar, unsurprisingly, after what we saw yesterday with payrolls, a little weaker this morning. Natalia Knezovic joining me now for a closer look at what is happening. What is happening?
So we see that European stocks are now trading at a record high. The Nasdaq 100 futures are up by almost 1% because we saw that steep sell-off across semiconductor stocks. So the Philadelphia Stock Exchange Semiconductor Index lost about 11% in just 2 days. So people are coming back potentially if we don't get any crazy headlines over the weekend. We expect the market will open much higher on Monday.
But momentum is losing momentum.
Exactly. So that's a big story right now. We saw steep sell-off in momentum stocks. When I asked traders what's been happening, they said technically there is no big catalyst for that, but exposure got really elevated across momentum stocks and people are just taking profits. If we look at WTF function on Bloomberg Terminal, factors to watch, we see that momentum is the best performing factor across 11 or 12 tracked by Bloomberg. The worst performer is volatility, low volatility factor. Huge gains, people are taking profits, and it's also important to know that hedge funds who had really great performance over the past quarter, long-short global equity fund managers posted the biggest gain in history. I'm citing data from Goldman Sachs trading desk. So some of those fund managers, they just don't have to chase this rally, and they're taking profits potentially ahead of like slow season, July and August.
Someone's coming. That already appears to be here very much in New York. Natalia, thank you very much indeed. Natalia is going to be with us throughout the morning, keeping us updated on what we need to know with these markets. In terms of what is going on the central bank front, focus has shifted from Portugal to France. Central bankers, policymakers who were at Sintra are now in Aix-en-Provence for the Economic Forum, of course, fresh off the back of that ECB event. Let's head there now, and we're going to speak to BNP Paribas Chief Economist Isabel Mateos Ilago, who joins us to talk about what we need to know. Isabel, first of all, what was your takeaway from Sintra? What was the sense that you got from that event in terms of where policy is going next, both for the ECB and the Fed?
Hi, good morning, and thanks for having me. So I think Sintra was a good week for central bankers. There was good news on Fed independence, and there was good news on inflation, with the latest figures certainly for the Eurozone coming in weaker than expected, and inflation expectations coming down generally more quickly than could have been feared. And so you sensed, I think, a palpable relief from central bankers, while at the same time they don't declare victory yet. They remain on their guard, but I think the tone was distinctly less hawkish than what we heard at the June policy meetings, and I think appropriately so.
Okay, why appropriately so? What do you think happens next?
Because I don't think inflation is going to drop like a stone. It's not going to drop in a straight line or very, very quickly. We've had a bit of instant relief with energy prices coming down very fast, and I'm back now where they were prior to the onset of the war. But the reality is the problems haven't gone away. The normalization of both oil transit and oil production is going to take a couple of quarters at least, and so we're not sure oil prices are going to stay where they are. In fact, we see a good probability that they're going to tick up a little bit from here. As well, let's not forget that a lot of the disinflation that we saw in Europe in the June data came from administrative measures which are going to expire this month, and so we could see inflation tick up, in fact, in places like Germany and Italy. And then there could be other shocks, concern around food prices which could reappear. And so I think even though for now we've seen some relief, and we're still not seeing really strong pressures of inflation going beyond energy and the energy-adjacent sectors, it would be too soon for central bankers to lower their guard and say, OK, we can go back to where we were. So I think they're going to wait. It's still our base case that the ECB will deliver an additional rate hike in September. But it was noticeable how the Governing Council members who spoke in Sintra left the door wide open to not doing this additional rate hike. And similarly, the other central banks who spoke were, I think, again, appropriately cautious at this stage.
Isabel, just a few minutes ago, Francine was talking to the Bank of France governor at Aix. He says he doesn't see second-round effects at the moment, and he's pointing to very, very low growth. Is that low growth factor, do you think, going to be enough to dissuade the ECB from doing more?
Well, I think we have to see. So growth in France certainly was very weak in the first quarter. We think the second quarter is actually better based on different nowcasts, our own and others. Q2 should be better. And, you know, growth in the rest of the Eurozone is actually not that weak. So, you know, even in fact, the ECB forecast is tracking for growth on a full year basis just under 1%. So maybe in some, you know, compared to other countries, it's weak. But for Europe, I think it's not weak enough that the ECB could say it's too weak, we need to cut interest rates. I think, in fact, it's the kind of growth and the last PMIs, by the way, also showed that manufacturing remains in expansion, and the deterioration in services that we had seen earlier is stabilizing. Consumer confidence is stabilizing. So I don't think this is the kind of environment where the ECB would think, oh, we need to cut. And in fact, it's the kind of environment where being at a neutral interest rate, which is where they are, seems pretty appropriate.
OK. 57,000 jobs yesterday on US payrolls. Is that enough to keep the Fed? Is that weak enough to keep the Fed on the sidelines? The market is still pricing hikes.
And so are we. Look, when you say is it weak enough, look at what happened to the unemployment rate. The unemployment rate came down. And in fact, we expect it's going to keep trending down between now and the end of the year. And that's because the break-even rate of job creations is, in our estimation, not very far above zero. And so 57,000, yes, it was a lot lower than the consensus expectation, but it's enough to keep the labor market tight, and it's enough, therefore, in our view, for the Federal Reserve to have to tighten policy sooner rather than later. And we, in fact, expect they will deliver 3 rate hikes over the course of the next 12 months. And for now, we think starting in December, but, you know, I think if we had had a very strong payroll closer to 130 or above, then I think July would have been a very, very live meeting, probably less so now. But in my mind, the case for rate hikes from the Fed is undiminished by this payroll report.
Where does 3 take us? Does 3 take us to restrictive, or does 3 keep us still neutral? Like, it feels like we're accommodative now. Maybe 3 takes us into neutral. Where would that position us, do you think, in terms of the setting of monetary policy in the United States?
Well, if you think of, you know, the pre-AI boom estimates of what neutral is, I think you're right. I would agree with you. It would take us to slightly restrictive. I think there's an ongoing debate which has been further fueled by Kevin Warsh's arrival on the Fed, that, look, maybe we are going to have a productivity boom thanks to all this investment in AI. If that's the case, then neutral will be going up. So I guess we'll need to see what the task force on that topic comes up with. But based on the reaction, the behavior of the economy, it's very clear that that policy is not restrictive currently. And 3 would take us closer to neutral or a little bit restrictive, which is what you need given inflation is well above target and has been well above target for over 5 years now.
Can I just pose a slightly complicated question to you? At the moment, AI is inflationary. It looks inflationary. It appears to be inflationary. And clearly, therefore, it needs to get cheaper if we're going to deliver the kind of productivity that everybody is hoping for, including Kevin Warsh. If we were to see the stock market rolling over because the AI bubble bursts, would the Fed therefore want to rescue the stock markets and prop up prices, or would it want that to play out so you get the productivity benefits of the AI story at a cheaper rate more quickly?
Well, a couple of points here. First of all, I thought it was very, very meaningful that when he was asked about the inflation impact of AI on the policy panel, Kevin Walsh, even though so far he'd been mostly, including during his confirmation hearing, saying, you know, AI is going to be disinflationary, he was actually very clear that for now we're seeing the impact of AI on the demand side, and that any productivity boosting impact was not policy relevant on a 6 to 9 month horizon. So I thought that was a very important signaling that he gave. Now, to your question of, you know, does the Fed need to rescue the market after the bubble bursts? Look, every single technology revolution that we've had over the last 100 years, there's actually some really interesting chart in the recent BIS report, that every time you have a bubble, you have overinvestment, and then the bubble bursts, but you still get the productivity benefits. So I think the two facts are, you know, you can totally disentangle them. Now, I think also we're in the build-up phase. You could think of these as overlapping phases. You have the build-up, and then, you know, you start having the productivity gains. There's no absolute necessity, there's no mathematical necessity for a collapse at some point, but it's true that historically this is what happened. But the really important point is, even if the market collapses, you still get, for the economy as a whole, you still get the productivity benefits.
Isabel, enjoy Aix, enjoy the Luberon. It's a nice place to hang out. Thank you very much indeed for being with us this morning. Isabel Mateos Ilago of BNP Paribas at the Aix-en-Provence Economic Forum. Thank you very much indeed. Let's get you a quick update on what else you need to know. What are the big stories that we're watching? Here is your Bloomberg brief. The US President, Donald Trump, and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. Private credit funds are facing a relentless wave of investor withdrawal requests, with second quarter exit requests exceeding those of the prior quarter. More than $14.5 billion worth of investor capital is trapped at over a dozen funds, compared with $8.6 billion that shareholders were able to get back. And Michael Burry says the Micron rally has reached historically extreme levels. In a Substack post, the Big Short investor wrote he is now shorting the stock, claiming its recent gains have been driven by AI hype and investor FOMO rather than fundamentals. Okay, you're up to speed. That was your Bloomberg brief. Quick market check just to tell you what we've got right now. This is the picture. US futures are positive by the tune of 0.3%. The dollar is up versus the yen, but we are watching that very, very carefully. It is basically balanced, and Brent is slightly big. But remember, the US markets are closed today, and as a result of which we have very light volume pretty much across all assets today. What are we going to do next? Bloomberg's Paul Wallace will be joining us very shortly. We'll get an update on the US-Iran peace talks, and we'll get a sense of kind of where they are going next. We'll do that in a moment. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Welcome to Bloomberg This Weekend. I'm David Gray.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
"17 minutes past the hour. Welcome back. You are watching Bloomberg Markets. I'm Guy Johnson in London. The United States markets are closed today, so there's plenty to talk about elsewhere. The European Central Bank certainly making a lot of news over the last few days. Officials there saying the inflation shock from the Iran war, they don't believe is over yet. Chief economist Philip Lane sat down with Bloomberg's Francine Lacqua at the ECB Forum on Central Banking in Sintra, Portugal, to discuss the modest increase in confidence levels that we are starting to see as oil prices begin to abate.
For the economy, it's only been, a few weeks. So clearly what's changed is the oil market. And that is moving quite a bit in the weeks since we've made our decision. And so let's see how that percolates across the economy. So what we have seen is in terms of confidence indices, there has been some improvement, but not a return to the pre-war levels. So it's not the case that there's been this very rapid rethinking of how investors and consumers feel. I mean, I think probably they need to see this current peace agreement convert into something more durable. And as you know, every day there's, plus and minus signals. And that needs to settle down, I think, before consumers and investors take a more decisive revision of their views.
I mean, this is really the concern, right, is that we're not really sure what these ongoing talks will bring. Madame Lagarde yesterday was really talking about no forward guidance, but scenarios. So with these ongoing talks, are we closer to the milder scenario or base scenario?
So I think the most important fact that we see is right now the oil prices reverted to pre-war levels. But the view of the market in terms of 2027 and 2028 is that it will be well above pre-war levels. So in other words, over the next couple of years, maybe because around the world energy firms, governments will want to rebuild inventory, that maybe demand for oil for restocking purposes will keep the oil price high compared to the pre-war level. So from our point of view, it's very welcome that we see this decline in the price of oil, but in terms of the overall inflation impulse, the fact that we do have maybe for a couple of years oil prices above the pre-war level, that essentially is a cost-increasing impulse to the economy.
So it's very clear that the ECB wants everyone to know that the last hike was not an insurance hike. Will the next hike be an insurance hike?
So I think it's important that we are clear on our terminology, if you like. So as President Lagarde said last night, we feel that the June decision was a robust decision, that we looked at it from every angle, and even from the angle which we did anticipate of having, if you like, this more rapid decline in oil prices. Even under that kind of more rapid normalization, it made sense because of 4 months of high oil prices to raise the rate from 2 to 225. What I think it's important to say is as we go forward, as we evaluate the kind of pros and cons of different rate decisions, we will be, if you like, mainstreaming the concept of how does this decision look like under uncertainty. Now, for me, I would reserve the phrase insurance hike to a situation where there's a tiebreaker, that maybe you could at least stay where you are maybe you could hike, and the risk considerations will push in one direction. But that was not the June decision. That was a clear decision, robust across a wide range of scenarios.
Yeah, I mean, given the wide range of scenarios and the uncertainty and the second round effects, is it better to hike in July or September?
Well, again, the way you phrase that question is maybe overly narrow. So what I would say is, before we get to the second round, I mean, for me, the second round effect is probably going to take some time. What I'm really focused on is the indirect effects. So even though now, like, fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular. And that channel is maybe where there's still uncertainty. And it's essentially the tension between these many firms have been absorbing higher cost increases for a number of months, whether they can recover those cost increases by raising prices, or whether, especially in the context of now the fuel prices reversing, it's absorbed in profit margins, and there's less by way of the indirect effect. And only after that can you start to have a vision of how strong the second round effects on wages might be, which would be later this year and into next year.
So you're telling me my question is too narrow because you could not hike at all?
I think, as you very well know, we're very much committed to basically going one meeting at a time, to not boxing ourselves in by kind of speculating about rate decisions, and essentially focusing on, at the time of the meeting, when we look at everything, what makes sense.
That was, of course, the ECB's chief economist, Philip Lane, speaking with Francine Lacroix in Sintra at the ECB's policy forum, talking about the impact that this rapid drop in oil prices is having in terms of policy. Let's talk about whether or not those oil prices are going to stay down. Peace talks between the United States and Iran are temporarily paused. Tehran beginning a week of mourning, of course, for the former supreme leader, Khamenei. President Trump told reporters Wednesday there was progress between the two countries in negotiations. Joining us now, Paul Wallace, on the latest on this story. Paul, where are we as we go into this weekend? Where do the talks currently stand?
Hi, Guy. I think compared to a week ago, we're at a less tense phase of these talks. A week ago, we were kind of in the middle of a couple of days or 2.5 days of clashes between Iran and the US that started when Iran fired on a ship going through the Strait of Hormuz, and then the US retaliated, and then Iran struck US military targets or targeted them in places like Bahrain and Kuwait. Those tensions have eased somewhat, and the two sides had talks in Qatar at the beginning of the week that involved Jared Kushner, Donald Trump's son-in-law, and Steve Witkoff, his main envoy for the Middle East. And those, broadly speaking, those talks did the job of getting the sides to sort of step back and say, okay, let's keep things calm over Hormuz for now, and they will continue their talks. This is to get a permanent peace deal. They're meant to take only 60 days and resolve really complicated issues like the future of Iran's nuclear program, and the future of its highly enriched uranium, and of course the management of the Strait of Hormuz. It will probably take longer than 60 days, but I think where we stand right now is that things aren't so tense, but they've got huge problems they still need to resolve.
Paul, thanks for the update. Greatly appreciate it. Thank you very much indeed. Paul Wallace joining us from Istanbul. Quick check on where we are with markets as we figure out what is going to come next. This is the picture we currently find ourselves with. As you can see at the bottom of the screen, Brent Crude not doing very much today. Still north of 70, kind of 72 area. Dollar yen is one to watch as well. We've got light volume that we are seeing in global FX with the United States out. Is this an opportunity for the Japanese to intervene? Equities are broadly higher. You're looking at a picture here in Europe, 0.2%. US futures are up 0.3%. We'll get a sense of where we go next with Cameron Dawson, New Age Wealth. We'll get her take on what we are looking at and what the second half of the year is ultimately going to look like. She will join us next. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Hi, Basia. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. US markets, as we know, are closed today. It is the 4th of July weekend. It has started on the 3rd of July, and obviously the festivities with the 250-year anniversary will continue throughout the weekend. Markets look, therefore, a little bit calm. S&P futures are up 0.3%. Dollar yen, keep an eye on that. Are the Japanese going to intervene? That is certainly what we're watching for, and we will discuss that with Jane Foley a little bit later on from Rabobank. Brent's also not doing very much. We're keeping an eye on that. Stock 600 flat here in Europe. The dollar is slightly weaker after the payroll data we saw yesterday, and the gold price is up a little bit after the payroll data that we saw yesterday. So what do we need to know? Let's find out in more detail. Natalia Knezovic joining us around the desk. What do we need to know?
So we need to know that the S&P 500, as you mentioned, are up, but NASDAQ 100 futures are up much.
Yeah, by around 1%.
Exactly, by about 1%, again, following the jobs report, and then also looks like some traders are coming back to beaten down semiconductor stocks. Now, in the energy space, we see that Brent crude is flat today, flat for the week, but we see that some strategies are becoming more bearish. For example, Citigroup now expects that oil for Brent price will be somewhere between $60 to $65 per barrel until the end of the year. And then in the LNG space, we also keep an eye on that. Qatar appears to be sending the first LNG tanker through the Strait of Hormuz since in about a week. So this is also a positive development.
Single stocks?
Couple movers. It is a quiet day. However, we have, for example, Stellantis shares are down by almost 1.5%. We saw that HSBC downgraded the stock, said that analysts are concerned about cash outflows and potential need to destock, and the stock is down by almost 50% since the beginning of the year. Another one is Maersk. Shares are up by almost 2% today. So it was raised to neutral from sell at Goldman Sachs. Analysts are more positive right now on supply and demand mismatch. And then finally, Samsung shares are up by almost 8%. The information reported that Anthropic is in talks with Samsung to produce custom AI chips, and it is also an interesting note from Citigroup analysts. They are cutting a long position on Korea's Kospi index. They say that the fear is when semiconductor stocks peak, the overall market could peak as well.
Yes, that certainly seems to be a reasonable expectation at the moment. Natalia, thank you very much indeed. Natalia Knezovic will be back very shortly. But let's get another perspective on what we are seeing with this market. New Edge Wealth CIO Cameron Dawson looking ahead to the second half of 2026, writing, quote, "The market catalysts are great now, but they won't last forever. Timing, unfortunately, is everything." Okay. She joins us now. Let's get a sense of where we are going. Cameron, great to see you. Timing is everything. Talk me through the timeline.
Yeah. Well, it's such a challenge as we look into the back half of the year, as we think about the
drivers that propelled this market higher, at least through April and May. We certainly saw such powerful returns that ended up turning very choppy as we got into June. And what's fascinating is even though the overall market, the S&P 500, was down slightly in June, what we saw was actually a lot more breadth. So fascinating. More names ended above their 50-day moving average at the end of June than at the start of June. And that gets to the point of that we're seeing these big starts of leadership rotations. You have some last shall be first kind of rotations, things like healthcare doing better, financials doing better, European stocks doing better. And then now we're having this introduction of volatility within the semiconductor trade. The challenge with that timing aspect of things is that semiconductors through the first half of the year accounted for 75% of the return in the S&P 500. So we really need to see that trade continue to have some momentum to it. We think in order to make those price targets of 8,000, 8,100, 8,200 even by some strategists by the end of the year. So in the near term, we wouldn't be surprised to see more volatility as we progress at least through July.
Cameron, I'm reading a lot at the moment about an earnings bubble, i.e. the expectations on earnings are going up simply too fast right now. What do you think of that view?
Yeah, well, I think that we have to consider that there's been an incredible, powerful uplift to the semiconductor side of things. You've seen a 90% uplift in the 12-month forward earnings estimates for the SOX index over the course of the last 9 months. And that has been driven by the fact that you've seen a huge increase in hyperscaler capex. This whole dynamic here is that we went into the year expecting 30% growth for hyperscaler capex. We're now running at 90% growth. That delta of an increase in an extra 60% growth is being pushed into the semiconductor complex where they have limited supply. And simply what you're seeing now is a huge amount of operating leverage where you've seen 18 percentage points of extra operating margin for the SOX over the course of the last 6 months. So the big question is whether or not that margin is sustainable. If you see hyperscalers pull back on capex even just slightly, those margins peak, those earnings thus peak, and then overall S&P 500 earnings likely are at a peak, at least in the near term. So we've been asking the question, given this huge uplift in earnings that we have seen, are 2027 earnings likely the highest we'll see in the next couple of months on a forward basis?
Okay, so say they are, and we start to see maybe a roll-off. What I don't get at the moment is that people are talking to me about the broadening out of the trade. It's kind of simple. You rotate out of tech and you rotate into the rest of the S&P, for instance. What I'm wondering, though, is whether or not if tech goes down, if the semi-sector goes down, doesn't it just drag the rest of the market down with it? And that broadening out, yeah, it's going to be a story that might protect you, but it's a relative trade versus an absolute trade. Absolutely, on the absolute trade, everything goes down in that scenario.
Yeah, it creates a big challenge for a cap-weighted index where you now have semiconductors as nearly 19% weight in the S&P 500. You go back 15 years ago, that was a 2% weight. So the path forward for the cap-weighted S&P 500 is highly sensitive to semiconductors and, of course, the broader technology complex, as well as the broader Mag 7 complex. I think that's really important to note is that one of the reasons why you saw the cap-weighted index down in June and yet a new high in the equal weight S&P 500 is because of the dead weight that the hyperscalers and overall Mag 7 placed on the index. So you could be in an environment where you certainly have a last shall be first kind of market. Things, as I mentioned, healthcare, financials, et cetera, do better. The market might look more broad, but on a cap weighted basis, it's actually just flat to slightly down. The big thing, though, that we've seen over the last couple of years is that every time we get a little bit of this broadening, this hope rally that we'll see some of these other areas participate in the rally, they've been rather short-lived. They've had 1 to 2 month lives, and then you've seen them give back all of that relative performance. And the key reason for that is simply they just haven't had the earnings. So the one place where there has been the earnings has been tech. So if tech earnings start to roll over, it's not necessarily that you're going to see healthcare or financials earnings do a lot better. So it raises the question if you could see kind of broader volatility, not just sort of this short-term rotation.
Okay, let's factor in something else. What are you plugging in terms of rate hikes?
Yeah, well, I think let's start where the market is expecting. The market still has a 120% chance of a hike by the end of the year, so 1.2 hikes. We find it hard given the data that we got in the US yesterday on the labor market side of things, where job additions were much lighter than expected. Yes, you got a lower unemployment rate, but it was just because of falling participation rate. We don't think that that kind of labor data necessarily suggests that there's a lot of urgency to hike rates. And as we look forward over the next couple of months, we're going to see some of the inflation data come off the boil, at least on the headline basis, because of the fall in oil prices and falling gasoline prices that we've already had. So we think that if headline inflation is falling, it's really hard for the hawks at the Fed to necessarily argue that they have to be hiking rates because of a slight uptick in something like super core services inflation, that core services ex housing, where we have seen some uplift. So our base case is a hold through the end of the year. Of course, if we see another inflation shock or re-lift up in some of the momentum in the labor market, you could see some of those hikes get priced back in. But we think that we might be close to, or at least a couple weeks ago, peak Fed hawkishness, and we could find ourselves in a situation where we're pricing out those hikes as we move through the summer months.
But no cuts.
No, we don't think that this supports cuts. The data doesn't suggest that the labor market is screaming for cuts. You still have inflation data that is well above the 2% target. And at the end of the day, even though we've seen some financial market volatility, financial conditions are still very easy. We have huge flows into very risky parts of the market, leveraged ETFs, options volume, all suggest that there is ample liquidity. Yes, you've seen some rise in interest rates that suggest that there's some of the markets doing the tightening for the Fed. But at the end of the day, this is not a labor market that's falling off a cliff.
Okay, let's put this all together. If you were to see the stock market going down, let's say that the S&P falls by 15, 20%, would that be enough to deliver cuts? Or is the underlying economy at the moment strong enough to survive the stock market dropping by 15, 20% and the Fed doesn't have to do anything?
Yeah, I think that's a really fascinating question, because one of the reasons we think this U.S. economy has been so resilient is because of the wealth effect and because of the soaring stock market. And I think the question that I would add to that is that it's not just a drop in 15, 20%, it's how long it lasts. If it's a very short drop where people don't see it on their statements at the end of the month, and you have a quick rebound like we had after Liberation Day or after the start of the Iran war, that kind of hit to the market is unlikely to dampen growth. But if you see a drop in the stock market that is protracted, you get to that 15 to 20% down, but it happens over a longer period of time, there is precedent that could weigh on consumer spending. That happened actually in the 2000s. There was a strong correlation between the path of the equity market in the early days of the 2000s bear market and overall consumer spending. So the wealth effect has been very powerful in supporting consumers, mostly because they've had negative real wage growth. So they've been having to dip deep into their pockets, and looking at things like stock market balances certainly has helped. If that starts to turn in the other direction, then the positive feedback loop that has supported markets and the economy could turn into a negative feedback loop, but it has to last for a while for it to matter.
Cameron, thanks for joining us this holiday. We really appreciate it. Love the spacesuit as well. Cameron Dawson of New Edge Wealth. We greatly appreciate it. OK, let's get you up to speed what else you need to know. Here's your Bloomberg brief. Iran hosting foreign officials from key backers, including China and Russia, this weekend for the funeral of former Supreme Leader Ali Khamenei. Beijing will be represented by the deputy leaders of its top legislative body, and Russia by former President Dmitry Medvedev, who is now deputy chairman of the Russian Security Council. Some in the Labour Party here in the UK are worried that Andy Burnham risks repeating the mistakes of not being prepared for government as he delays key personnel decisions. It was a mistake, some would argue, that Keir Starmer made. Burnham won't announce key appointments until after the selection process for the party's new leader formally concludes, which could give new ministers a slim window to prepare, i.e. he's not Prime Minister yet. He doesn't want to name a cabinet because he's not Prime Minister yet, but that will leave him little time. New York City officials are now preparing the city for Taylor Swift's and Travis Kelce's, who are expected to host a celebrity-studded event tonight at Madison Square Gardens with around 1,000 guests. The couple have reportedly donated $26 million to local and national charities ahead of their wedding. Recipients include the Food Bank for New York City and Dolly Parton's Imagination Library. And that is your Bloomberg Brief. Quick check on the markets just to tell you what is happening. We are looking at a market that is very quiet today, understandably, given the fact that it is the 3rd of July, i.e. effectively it is the 4th of July holiday that we are watching. So we're seeing quite cautious markets, but keep an eye on what is happening, things like the dollar with dollar yen. Everybody's anticipating that we could see maybe some action coming through from the Japanese authorities, who will take advantage of the thin liquidity. What are we going to see next, or what are we going to talk about next? The heat wave hits the US coast hard, reshaping plans for some 4th of July celebrations. We'll find out what's been affected next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the 3rd floor or the lobby. You actually have to start in the basement.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
47 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson, this 3rd of July. Let's talk about some of the corporate news that we are paying attention to this morning. Since its spin-off from Honeywell International, shares of Honeywell Aerospace have seen double-digit gains. Its CEO, Jim Courier, joined the close to discuss the path forward for this new company.
We're not seeing any decline in the air travel business that affects our portfolio, but I think it's important to understand when we think of commercial aerospace as part of Honeywell Aerospace, there's the commercial air transport section, which is airlines and airline traffic, OEM production rates, but as well as business aviation, where we have a very unique positioning with our products and technologies in business aviation. So half of our OEM business is actually business aviation. The other half is commercial air transport. Our commercial aftermarket business, which is what you're referring to in terms of airlines and flight travel and the like and flight hours, 60% of that is commercial air transport. 40% of it is business aviation. It's truly an underappreciated aspect of Honeywell Aerospace as to how much exposure we actually have in business aviation. And what we've seen as a result of the conflicts and the rising fuel prices is actually an uptick in flight hour traffic for business aviation.
Well, Jim, you mentioned that, being a standalone business, completing this spinoff, you can really just focus on your strategy, not necessarily being part of a conglomerate here. You also see a bunch of sell-side notes coming out initiating coverage of you as a standalone. And Jefferies in particular points out that now you have a chance to run the M&A playbook. You've shut the books on the first day of trading. Where would you say M&A falls on your priority list? Is that something that you're evaluating?
Yeah, so as we discussed at our Investor Day in early June, there's 4 pillars upon our capital allocation strategy. First and foremost is investing capital into our factories and into the supply base to unlock additional capacity within the industrial supply base because we have so much demand for all of our products in commercial and defense. So that number 1 priority for us. The more we can unlock, the more we can deliver on the $19 billion of backlog that we have, which is up 20% year on year, indicative of how much demand there is for our products and technologies. So that first and foremost is our top priority. Unlocking the supply base, increasing capacity, and deliver for our customers and for our shareholders in that regard. Specifically around M&A, that's number 2 on our priority list. And if you think about what we did when we acquired 2 companies back in September of 2024, Case and Civitanavi, they fit into a very specific framework. First and foremost, technology differentiation. It's what Honeywell Aerospace has been founded upon, is being innovators and differentiating with our technology. So you must have differentiated technology and servicing a demand that's high growth in excess of the growth that we're seeing in our business today, which will outgrow what the market growth is right now for Honeywell Aerospace. If you have those 2 elements, then we look at who are you serving today? Are they the same customers? Are there synergies between what the target company may be doing and what Honeywell Aerospace is doing? And then the 4th piece of that rubric is really around, can we scale you greater than how you can scale yourself? And if you think about those 2 acquisitions that we did in September of 24, they hit all 4 parts of that rubric, and particularly on the scaling front.
That was, of course, the Honeywell Aerospace CEO, Jim Courier. Okay. It is hot in America. It is hot in New York. It is very hot in New York. We've got this heat dome that has settled over the East Coast. It's pushing New York City to its hottest day, we think now, since 2012. The soaring temperatures are disrupting the start of the long holiday weekend. Let's talk to Bloomberg's Miles Miller, who's in New York, about what is happening here and what could happen or not happen. Miles, first of all, how hot is it? How hot is it going to get this weekend? And what's on and what's off?
Yeah, we had a situation yesterday where the temperature reached the highest level in 14 years. We have quite a number of celebrations because, of course, New York plays a big role in America's 250th birthday. We've got the Parade of Tall Ships that starts today in earnest. We've got the ball drop in Times Square happening several times across all New York time zones, starting at 10 this morning. And with that comes the crowds. But it is so hot in New York. We had really taxing situation on our energy grid with a number of blackouts in small communities here. But of course, we're going to be hosting a large part of the celebration of the country's 250th birthday. We'll have the fireworks on both sides of both rivers here in Manhattan. And then, again, that parade of tall ships, which means that a lot of people from around the world are going to be here in New York and are going to be really hot. It's not just New York, of course. It's also going to be in D.C. and in Philly, too, for these celebrations. We have learned that Philly is going to scale back their celebration because of that. Will the celebration on Capitol Hill that is normal for 4th of July actually go on as planned? It's unclear. All these cities are making these changes in real time because it is just simply too hot.
Yep. Too hot to handle. So my next question is, does Madison Square Gardens have air conditioning?
All right, so let's talk a little about Madison Square Garden, right? The air conditioning, where I was at Madison Square Garden for one of the Knicks watch parties, and then after the Knicks won, I was there for a taping with some of the big Knicks fans, right? The AC works well. The issue is downstairs on the track level. Yesterday it was 140 degrees, which meant trains that were trying to get out of Penn Station, which is connected to Madison Square Garden, couldn't get anywhere. I think you're asking because of the wedding that is very top secret. I think the AC was working really well last night for folks like Jack Antonoff, who went to this rehearsal dinner.
Yeah, so we're talking about Taylor Swift's wedding here, basically, and I'm wondering whether she is going to be disrupted by the weather, and it doesn't sound like she is going to be. How much disruption is it, though, causing within the city?
Oh, it's causing a lot of disruption, right? Whenever we see temperatures reach these levels, we have issues with the energy grid. We have issues with people being able to, run their AC, at a good level. And that is going to be the crux of the issue in these next couple of days with this heat wave. How do you manage all these folks coming in and out for a big wedding, for the World Cup, and to see the big ships and the fireworks with this extreme heat? In a number of these places, you can't bring in water bottles and all that kind of stuff. You got to have sort of these plastic water bottles. And then, the price goes up when it's a special event. So, when people coming out should really figure out how to be patient and how to keep cool in the best way they know how.
Stay patient, keep cool, and stay hydrated. You make a good point. Miles, great stuff. Thank you very much indeed. Miles Miller joining us on how hot it is this weekend in New York. Europe and the United States certainly facing heat issues right now. There's a lack of heat in the market right now, and the reason for that is quite simply the fact that we do have the United States out today for the 4th of July celebrations, a particularly big celebration, obviously, with 250 being notched up by the United States. And that means that we're seeing very, very light volume. Equity markets aren't really doing very much today. Keep an eye, though, on what is happening in particular with the dollar-yen trade. We are watching very carefully to see what happens and to whether or not we get some intervention. We've seen a little bit of volatility already in dollar-yen this morning, but we are watching to see whether Japanese authorities take advantage of the light volume, maybe to intervene, to put in a near-term top for dollar-yen. Anyway, we'll discuss all of this next, plus also the AI trade. Fawaz Chowdhury of Horizon Global Partners is going to be joining us. We'll talk geopolitics with Tina Fordham of Fordham Global Foresight. That's all coming up. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas.
The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome back. You're watching Bloomberg Markets at noon in London, 7 a.m. in New York. We've got a lot to talk about, so let's get you updated this 4th of July weekend holiday. What are we going to be doing? We're going to need to talk about Asian stocks. They're climbing, along with most of Europe. The yen strengthening past 161, but fairly flattish, to be honest. US markets are closed for the holiday, though we do have futures trading, which is worth paying attention to. In terms of the geopolitics, the US-Iran peace talks are on hold as Tehran holds the funeral service for the former Supreme Leader Ali Khamenei. And Bloomberg is learning that President Donald Trump and his allies are renewing a push to reshape the Federal Reserve, with the Governor Lisa Cook still a target. Markets look like this. Let's give you a sense of what is happening. I just want to point out that volume is very, very, very low as we come into the afternoon here in Europe with the US out. S&P futures are a little bit higher. We're up by 0.3%. Dollar yen is doing absolutely nothing. We're keeping an eye on that. We've seen a little bit of volatility overnight. Brent crude is doing nothing as well. We're up by 0.2% as we watch what happens in the Gulf this weekend. European equities are up by 0.2%, but again, very light volume. The dollar's down a little bit on the back of the payroll number that we saw yesterday. And with the dollar down, gold is up by 1.3%. So that's kind of the basic view of what is happening with this market. For a more sophisticated view, Natalia Knezovic joins us now to take a look at what is happening. And let's start with the options picture. What are you seeing there?
So on the one hand, Guy, we see that there are some concerns about AI trade, memory stocks, momentum. We saw big decline, huge declines across momentum baskets. But the options market is telling us that people are actually bullish. So, for example, demand for upside calls on the largest ETF tracking the Nasdaq 100 is now rising faster than on broader markets. So, for example, cost of call options on technology stocks is sitting at the highest level since 2007. People people are bullish. This is a signal that rotation into AI and growth stocks continues. Another thing that I would like to point out is that we see that correlation between single stocks is the lowest in almost 15 years. This is data from Goldman Sachs, but I'm sure we have something on Bloomberg Terminal as well. It tells us this is a single stock pickers market, right? So people are trying to find opportunities across single stocks as they don't, trade.
What's interesting is that it's all cancelling itself out to actually deliver a VIX, which is still relatively low. Retail? What's retail?
Yes. As we know, retail traders is becoming one of the biggest players in the U.S. stock market. We see that data from Citadel Securities shows that May and June trading volume across equities in the U.S. was the highest ever. Moreover, it was about 65% above average levels for 2025. So retail traders are participating, and looking forward, I think it's really important to keep an eye on cash balance sheets for individual traders. And again, data from Citadel Securities tells us that they have a lot of cash to deploy. So they still have the so-called dry powder that can invest into U.S. stock market.
And there's plenty of leverage in this market as well, which is an interesting factor to bear in mind as well. Natalia is going to be back. She'll keep us updated on what we need to know about these markets throughout the morning. Let's get another perspective. Horace Chowdhury, Chief Investment Officer at Horizon Global Partners, joins us now. Folks, we're just hearing the market is buying calls on tech stocks. Is this a rally, a tech rally that is still worth chasing?
Yeah, absolutely. I know there's a pullback. Momentum factor you mentioned has pulled back. There's consternation around crowding in the memory trade. But all the revisions are positive. Hyperscaler CapEx continues to be revised up. There's some concern around Meta's news flow that they are going to be offering cloud infrastructure themselves. So they're concerned around oversupply. But we certainly feel that overall compute demand is still rising, and we are supply constrained on compute demand.
Are you happy with the multiples that you're seeing with tech stocks?
Multiples are not stretched at all. I mean, if you look at S&P as a whole, 2 years out, it's only 17 PE. Some of the companies, the biggest companies like NVIDIA or Micron or others, 2 years out, NVIDIA is now 13.5, 14 PE 2 years out. Now, I understand they're cyclical stocks and semiconductor stocks. Generally, there's concern that earnings could be peaking, so low multiple is a reflection of that. With that said, I think still CapEx revisions are positive. Hyperscaler CapEx is continuing to get revised up for next year and the year after. So I don't think multiples are stretched. Free cash flow generation is robust. So I think the buybacks will continue from these companies.
The earnings estimates are getting jacked up at a very fast pace for us, and people are saying we're in an earnings bubble, that you don't normally see this rate of acceleration in terms of earnings estimates outside a bounce back from a big crisis. You are 100% comfortable that these earnings numbers, the E, is okay?
I think you have to understand that the cyclical companies have huge operational gearing. We are in a global CapEx cycle, whether it's semiconductors, but even industrial companies, grid equipment, transformers, etc. There's a shortage of a lot of equipment out there, including memory. And then these companies, when you get pricing power, you get huge earnings growth. Now, they're cyclical. At some point, the earnings will peak. I'm saying next 2-3 years out, we know that, for example, if memory shortage or other shortages, they will continue. So at some point, the earnings will peak because it's cyclical. And because these companies have become that much bigger in the overall index is more cyclical. S&P is now more cyclical. NASDAQ is more cyclical. Yeah. But it's not a bubble. No.
There's another word for pricing power. There's another word for shortages, and that word is inflation. How much of a challenge is that going to be?
Oh, yeah. I think the real rates are moving up to reflect this. So if you look at the 10-year real rates, they are rising. And I think that initial move in February, March, April especially, people attributed that to oil. It's inflation coming from oil and the oil shock. But as the oil prices come back to $70 and the Hormuz shock has faded, real rates have stayed high. And now there's concern, which is rightly so, that it is a more demand-led inflation, not an oil supply shock. And that is because we're in a global capex cycle and there's a shortage of stuff. We're not going to see demand destruction of DRAM pricing or semiconductors at these higher price levels because it's demand-led. So this will cause global neutral rates to rise, inflation to come, and real rates to be higher. So that will constrain the ability of the central banks to be dovish or to cut rates.
Okay, so what level of interest rate hikes, and it's usually about pace and level, what would be a problem, do you think, for this stock market?
I don't think the stock market necessarily will see a problem because the companies which are the largest companies in the stock market, it's a very narrow index. And if you look at the likes of NVIDIA or Broadcom or Mac, I don't think there will be much of a pullback in their multiples because of higher rates. If we are saying that the index is more cyclical companies have lower Ps, like Micron or even NVIDIA now, and lower Ps then don't react as much to long-term interest rates. So if the index is more cyclical, yes, we should be concerned about when earnings peak, but that simultaneously, we cannot be concerned about the interest rates impacting it because the index is becoming shorter duration, not longer duration. So I don't think interest rates higher will either constrain capex or the multiple.
Okay. Do you think that the vulnerability of the US tech sector could lie elsewhere, i.e. not in the United States? I look at the Cosby. I look at the levels that have been achieved this year. I look at the narrowness of that market. I look at the leverage, the extreme leverage that is now in that market. If you were to see the Cosby roll over aggressively, what would be the feedback story back into the NASDAQ?
I think people are looking at Kospi, and within Kospi, it's really SK Hynix. There are only 3 companies in the world that can make memory. There's a shortage of memory. And within that, Hynix has been the only one making high bandwidth memory for a long time. And now Micron is going to start making it and delivering it. So almost every NVIDIA graphics card is basically SK Hynix high bandwidth memory. So, but that is well earned. This is a new segment for memory that opened, graphics cards for data centers. And they're at 80% gross margins. It's a monopoly pricing. So, and it's still 5P 2 years out, the stock. So they're making money hand over fist. Hynix will have $330 billion of revenues next year and higher operating profits, $250 billion operating profits, higher than Microsoft, double the amount from Amazon. So it's a very profitable business. Now, at some point it will peak, but I think it's looking good. I think Hynix is looking good. I think Kospi is looking good despite the rally.
So but you still think that the semi-sector is cyclical?
Semi-sector is cyclical. It's just a super cycle. And we're all debating how high and how large the cycle is. There's no doubt semi-sector will remain cyclical. Hynix is doubling its capacity over the next 4 years. At some point in the future, we will get an oversupply of memory. But next 2 years or next 3 years, we are still going to be constrained. No, there is no doubt that the sector will remain cyclical like it has for the last 40 years.
Absolutely. Fawaz, great to catch up. Thank you very much indeed for joining us this holiday. Fawaz Chowdhury of Horizon Global Partners. We appreciate it. Let's get you a quick update on what else you need to know this morning. Here is your Bloomberg brief. The US is pressing gasoline retailers to pass on lower fuel costs to consumers. The Treasury Secretary, Scott Bessent, telling CBS News he expects average prices to fall to $3 a gallon by Labor Day. Citi sees Brent falling to 60 to 65 a barrel by year end, and this as we see the US-Iran MOU expected to hold. We'll talk about that in just a moment. A dangerous heat wave is gripping the US East Coast as millions prepare to celebrate the 4th of July. Outdoors, the worst conditions are now underway, with many records already being broken. Cities are seeing major strain on power grids as people look to stay cool with their air conditioning in their homes and their businesses. In sports, Spain delivered a dominant performance in the World Cup to beat Austria 3-0 last night, and they booked a place as a result in the round of 16. Spain will face Portugal after Portugal's 2-1 victory over Croatia, and Argentina now faces Cape Verde later today. Australia faces off with Egypt. And that is your Bloomberg Brief. Quick check on the markets just to see where we are. As I say, we are seeing very light volume. S&P futures are up by 0.3%. Dollar yen is doing absolutely nothing. Brent crude is doing absolutely nothing. Very light volume in those spaces. European equities are a little higher, but beginning to fade now as we enter the afternoon session, where we'd normally see volume supplied by the US. The dollar is down post payrolls. Actually, gold is benefiting on that story. Up next, we'll get back to the chip story and get more details as to what is happening there. Chip stocks posting their best quarter ever. Is there still room to run? We were just hearing from Fowers that he thinks there is. What's the view from elsewhere? We'll find out next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
14 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson. Let's talk about power prices and electricity grids. The national grid in the UK is looking to capitalise on the AI data centre boom. The UK utility company announcing plans to invest $1.8 billion into a firm developing power generation for Microsoft. National Grid's CEO spoke to Danny Berger following the news.
National Grid has long been invested in delivering energy through long-term infrastructure to our customers. And so in some respects, you could say this is exactly what this acquisition that we've invested in today is all about. But to your point, we are now facing that sector of the market that is growing so rapidly. I mean, the increase in power demand coming from data centres and just more generally from the AI evolving economy, it's an exciting place for us to find ourselves.
It feels like it's really rewriting things really quickly, Zoe, and I wonder how far away you think we are from being able to keep up with the demand from it.
Well, that's why I think this investment is so important for us. What we've done in investing in Juland, which is a technology-enabled energy company, is find ways to actually bring the very best that we can across different sectors to harness that innovation and get the right solutions so that we can actually get speed and scaled power to customers really quickly. And if you take a look at the specific project that we're developing, Project Kilby, you can actually bring the very best of the cultural opportunities from Microsoft, from an energy major like Chevron, through Juland, who's brought that innovation together. And that's what's giving us, I think, a real advantage, real pace to deliver the power, but also the opportunity to scale that over time.
You know, I myself lived in London for about 7 years, so I'm very familiar with National Grid. But to see you coming over into the U.S. itself is an interesting turn. Do you think this is the start of many more opportunities for you in America?
It's interesting, Danny. Most people aren't aware, but we already have quite a significant scaled position in the US. We are servicing already both the LDCs, the local distribution companies for gas, in both Massachusetts and New York. And of course, we have a very big presence there around our electric utilities as well. So we have in our 5-year horizon, as an example, about £70 billion. So let's say between 90 to sort of 95 billion US dollars, of which we have about 40% of that being invested in the northeast of the US. So we've got great capability, not just across the broader company, but already in the US, that helps us to bring momentum behind this acquisition that we're announcing today.
I mean, there are many who are, see the opportunity like you do, Zoe, in trying to provide energy and different utility to data center projects. Is there any part of the market you think looks frothy?
Look, I think what we have found is that whilst the numbers of data centre in the queue are significant, that the drivers behind needing this speed to power continue to be solidified in all of the conversations that we're having. And so, of course, we have conversations across many of our jurisdictions, both with data centre developers, but also with the tech companies that sit behind. And I think it really is a challenging domain, and it's really about pace. And I think what's exciting about this investment that we're making, it's really through the Dualant vehicle, finding a way to crack that equation. It's about speed, but it's also about doing speed at scale. And I think that's what's most exciting. And that's the unlock, I would say, around underpinning those that are real projects that really want to put money behind investing versus those that perhaps are more speculative and seeing what might pan out.
How do you deal with the politics of the situation, Zoe? I was just looking, there is even a lawsuit this morning around AI, very, very different from energy and what you're doing, but specifically around Albertsons and Walmart using AI algorithms to determine the price of gasoline at their pumps. I mean, there is this real deep backlash occurring in the United States right now about this fear AI is going to be driving up my utility bills. How do you navigate that environment, especially ahead of the midterms when politicians are taking note?
Yeah, and the first thing I would say when it comes to specifically building projects is that we must do so in a way that's really deeply respectful for the communities that we find ourselves operating in. And that's the way we've always gone about our projects. There's a lot of opportunity for community consultation, to get input from the local communities, and to make sure that we're welcome in the jurisdictions that we're building in. I think that broader debate is something that, of course, will play out over the course of time, but we're really focusing on the things that we can control, where we have unique capabilities that we can bring to the story, and that's really about creating that affordable power that's reliable in the current context.
I understand the desire to only focus on things you can control, but when you can't control them, isn't that a real risk for the build-out?
Well, I think there's the potential that these things could play out at different rates than perhaps might be anticipated. But I can tell you from our own 5-year forecast, we have solidified plans around our investment in that sort of 90 to 95 billion US dollars, which is underpinned in our jurisdictions for regulatory rate cases that are firm. And so I think we can speak with confidence in the next 5 years exactly what projects we will be delivering and by when. When we come to this particular announcement today, we've also got a firm PPA in place. This is something that's been signed by Microsoft for the Kilby project. And so this isn't sort of a speculative investment. This is really underpinned by the fundamentals around customers and actually meeting that demand with the right infrastructure and energy players.
Hey, Zoe, just quickly, because, you mentioned you have commitments. What do you make of those more speculative projects? There have been quite a few of, some politician leases some land, doesn't have a hyperscaler committed to it yet, but hopes that they will. I mean, do you think that those will find the right path and find the right commitments, or do you think that there maybe is some speculation that concerns you in the overall market right now?
Well, I can really speak from the jurisdictions that we're most familiar with, and I think we see that there's a project maturity that evolves over time. So inevitably, there's a lot of in the queue. We find that narrows quite quickly when you start to get into establishing contracts around capacity that people will take, and that very quickly sort of starts to simplify those that are more speculative versus those that ultimately are putting money in the ground. And so I think in our jurisdictions, we actually have a pipeline that's substantially larger, but the projects that we're actually doing designing and construction around are firm projects. They've got real money behind them, and we work very closely with the integration of how the projects are being built and how those connections into the grids might take place.
The CEO of National Grid, speaking of course there to Bloomberg's Danny Berger. Let's talk about another aspect of all of this. Where are all those electrons going? Well, most of them increasingly feel like they're going into semiconductor chips, a sector that has just posted its best quarter ever, driven, of course, by the insatiable demand we are seeing for all things AI equipment. But after some recent jitters sent some of these stocks tumbling, investors are wondering how much further this rally can go. Let's try and answer that question now with Matt Bloxham of Bloomberg Intelligence, who joins us around the table. Matt, further to go?
I think definitely in the short term, the answer is undoubtedly yes. I mean, if you look at just CapEx for this year across the kind of big hyperscalers, it's up $300 billion year on year in 26. It's almost doubling, and the market expects another $200 to $300 billion of incremental CapEx on top of that. So getting north of $900 billion of annual CapEx across 5 companies in 2027. And that's kind of fueled by almost a bit of a kind of technology land grab. They're all building capacity, anticipation there's going to be runaway demand from enterprises for the capacity they're building. And so that's the big question, is are enterprise investments in AI moving from kind of proof of concept into scaled deployment? And that is this question that I think we're not going to get a clear answer to for maybe another 12 months or so. My sense would be that it was probably going to end up being a bit slower than people think. There's clearly some industries that are racing ahead, but I think assuming a kind of cross-industry-wide kind of surge is probably unrealistic, because there's still a lot of stuff to work out around the productivity gains of AI or the revenue gains of AI, and the costs are starting to creep up. You can't hide the cost of token usage for too long, and I think a lot of companies are now starting to grapple that. Anecdotally, you hear evidence of companies figuring out cute ways to reduce or limit the growth in token spend, either caching or using small language models. So you're kind of starting to see some signs that this is starting to become a noticeable cost item, and having to think about ways around that because the top line benefits aren't there yet.
What is the inflation rate for kind of chips right now? Kind of how fast is it still?
It's a good question. I mean, I think if you look, obviously, one of the things in focus is the memory chips. I'd say that, we're kind of probably looking at, 50% plus expansion in cost year on year, possibly higher. And, there's a real bun fight out there for the capacity. These companies, SK Hynix, Samsung, Micron, they can't build the capacity quick enough to meet the demand that's right there. So, we're seeing cute examples of companies, for example, Apple looking to get permission to use Chinese manufacturers for Chinese equipment. Elon Musk is talking about building his own memory chip. He's obviously got this Terafab project between SpaceX and Tesla. So people are looking at the rising costs. They're looking at the limited supply and thinking maybe it's time for us to think about different strategic answers to this issue.
The semiconductor sector is notorious for being cyclical.
Yeah.
And the end of the cycle is usually brutal. Mm-hmm. Is that what we are heading for at some point? I don't know when. It's hard to call.
I think you have to, if history is your guide, I think you have to kind of assume there's a good likelihood that that's where we end up. Hopefully some of these chip manufacturers have learned that lesson, and although they've, this big $1 trillion plus announcement from Samsung and SK Hynix early in the week, hopefully that doubling of capacity is going to be done in a phased way, so that if there is a slowdown of demand, they haven't committed too much capital too quickly, they get stranded assets. But if you look at the valuation multiples for those companies, the forward PE is a single digit. The market is not assuming this is sustainable. They're assuming this is a kind of short-term kind of phenomena, if you like, and that we're going to return to normal service at some point in the coming years.
Matt, great to catch up. Thank you very much indeed. Always appreciate the time. Matt Bloxham of Bloomberg Intelligence. Still ahead, we're going to talk geopolitics, figure out what is happening. The US-Iran peace talks remain on pause right now. Tina Fordham of Fordham Global Foresights is going to be joining us very shortly. We'll get her take on what is happening here and what the oil price is telling us. We'll do that next. This is Bloomberg.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Friday the 3rd, half past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson here in London. Of course, it is the 4th of July weekend in the United States, a very special one this year, of course, but we are seeing very light volume as a result of the Americans' absence. If you look at what you're seeing in London on the AVAX sort of column on your Bloomberg, you'll see Euro Stoxx 50 down by 35% in terms of the volume. If you look at the IBEX in Spain, down by nearly a half. So the takeaway basically is that you're not getting much volume out of this market. S&P futures are largely unchanged. In fact, most things are unchanged. Even dollar-yen, which we were expecting some volatility in today, is largely unchanged. Brent, we'll come back to that in a moment. European equities were up 2/3%, beginning to maybe fade some of that now. As you can see, we're up by less than 0.1%. The dollar is becalmed. In fact, one of the biggest gains this morning is gold. After the payroll data we saw yesterday, which was maybe a little weaker than anticipated, we are seeing, with the dollar down, gold gaining some traction. So that's the kind of the macro top-down picture. Let's actually come at it from the other angle and talk about some single stocks and what we are watching there. Natalia is back with some details. What are you watching?
Let's start with L'Oreal. So shares are down by 3.3%. This is the second worst performing stock in European equity benchmark. JP Morgan analysts are expecting that the second quarter results will be strong, like-for-like sales growth of about 5%, but then starting from there, they say that growth might slow down as demand for cosmetics, skincare, and makeup begins to weaken in key markets in U.S. and Europe. And you know what Alex Steele would say in this case?
Skincare matters.
No, invest in your face.
Invest in your face. Also, skincare matters, believe you me. That was one of their key touch lines. What else are we watching? Pharmaceuticals, anything there?
Yes, so Ebivax. So this is, I believe it's the best performing stock today. Shares are up by 9% today. So the company eased some concerns about safety of its experimental drugs, and then it reinforced speculation that it could become a target for a takeover. Shares are up almost 60% for the week after almost 1,700% gain in 2025. And then finally, I'm also watching Stellantis. Shares are down by almost 2% today. HSBC downgraded the stock. They say there are some concerns about cash outflows and potential need for destocking.
Okay, the auto sector continues to struggle. Natalia, thank you very much indeed, Natalia Knezovic, on what is happening with the single stock stories. Let's go macro again and figure out what is happening. The oil price is currently Brent 71.73, a little softer, but basically unchanged on the session. This as we watch very carefully what is happening with the peace talks that are taking place between the United States and Iran. Temporarily paused at this stage. The reason for that is that Tehran is beginning a week of mourning for the former supreme leader Khamenei. President Trump, though, telling reporters Wednesday there was progress between these two countries as we see negotiations maybe proceeding, but maybe at a more gradual pace. Let's talk about how you kind of price all this in and whether or not the oil price is actually a fair reflection of the reality on the ground. Tina Fordham, founder and geopolitical strategist at Fordham Global Insights, joining us now. Foresight even, not Insight, Foresight, I'll get that right. WTI crude is currently at 65. Brent crude is currently at 71. Both those two numbers have come down really sharply over the last few weeks. Too sharply?
Well, markets are telling us that the war is over.
Yes.
The peace deal, the memorandum of understanding, is wafer thin.
Yes.
In Monty Python terms. There is a lot of triumph of hope over experience going on. I saw that my former colleagues at Citi have oil back down to 60 by year end. And, you know, what we're seeing is countries are stockpiling. But at the same time, if you look at the language that President Trump is using, he still talks quite openly about blowing Iran to smithereens, or, you know, insert choice word here. And at the same time, Iran is stronger than it was before by a certain number of metrics. So, yes, markets are getting ahead of themselves, but markets are going to market.
Yeah, they certainly are. So let's talk about what could go wrong. My read of the Iranian outlook is that now they know they are determined not to lose control of the Strait of Hormuz, regardless almost of what the Americans will say. The Americans are saying, here's a load of money, keep the Strait of Hormuz open, and the Iranians are going, well, we could just charge a toll and then we get loads of money, so actually why do we need to worry about what you're saying?
And that's why, I mean, the oil price action, the shift back to fundamentals, not surprising. You know, markets are doing what they're supposed to be doing, but the strategic context has really changed, not just in the Middle East, where, you know, the Israeli-U.S. war on Iran had an impact and changed the power dynamics in the region, just not the way they wanted them to. But this idea of monetizing the Strait of Hormuz, which was not, you know, that was not the practice of Iran before. It's a change in trend. It's a revenue generator. It's also an idea to inspire other countries sitting near choke points in strategic waterways. So this war, mark my words, will have a ripple effect, what I call a geopolitics butterfly effect, well beyond this, because Iran has ended up having a loaded gun, if you like, pointed at global oil markets.
Which other straits would you watch?
Well, the Straits of Malacca come to mind, but, you know, the Panama Canal was previously in the news. And while we are, you know, monetizing and optimizing and stockpiling and concentrating and sovereignty and autonomy, you know, the pressures on natural resources and on any strategic waterways are building. And what else do we see in response to that? More pipelines being built, diversification kind of being key.
Iran to Taiwan. Let's just kind of make that connection as well. How do you think the Chinese are? The Chinese are sending a delegation to Tehran this weekend. What lessons will they learn from the Iranians?
Well, of course, China will be and has been watching very carefully what happens with Iran. They weren't as impacted as we were here in Europe by the supply shortage. And, of course, China has done something that the U.S. hasn't, which is build up its green energy and its alternative kinds of supplies. You know, China has ended up benefiting, including by some of the, you know, softer metrics that I like to look at, including that the world trusts China more than the United States right now. It looks like a reliable and stable partner. Does that then mean that the geostrategic calculus in Beijing shifts to unifying with Taiwan? Maybe they're not in a rush, or maybe they start doing something they often do, which is use salami tactics to test the waters, because it would be immensely to China's advantage if it were able to show that the U.S. won't implement its security guarantee. And that, again, would have a ripple effect with Japan, Philippines, and other Asian neighbors, Australia.
Back to the Strait of Hormuz. What I'm hearing is that you think that the oil price should go higher from here, not lower from here.
I mean, markets are reacting to the supply dynamics. There are still, 8,000 sailors trapped. I have clients in maritime law who are not feeling confident. But, it was always the case, for example, that the onset of U.S. shale would change the price dynamics of the Middle East. And geopolitical developments in the Middle East don't have the oil price impact that they did in 1974. So we've seen that demonstrated. But what we've also seen is that the United States is not able to dislodge an adversary that it has superior military power over without undertaking significant risk. And what I'm saying is that sends a message to others.
One final quick question. What is your assessment of where we are on the battlefield in Ukraine?
Well, what Ukraine has managed to pull off is nothing short of remarkable. They are holding the line in those eastern territories that Russia has had for the last few years with drones only. The death toll of Russian soldiers continues to be off the charts. The Kiel Institute published a report this week about the strain happening in Russia. And at the same time, Ukraine is firing deep inside Russian territory, including in St. Petersburg, around the time of Putin's annual confab there, the St. Petersburg Economic Forum. Around Crimea, there is a reasonable chance, General Petraeus said this week, that there's a reasonable chance that Ukraine is able to take back Crimea. That would be hugely symbolic. And of course, next week, NATO leaders, including President Trump, will gather in Ankara. And these two conflicts, Iran and Ukraine, will be top of the list there. I mean, Ukraine has ended up being the strongest and best prepared army in Europe. And that was not something anyone predicted 4 years ago after the Russian invasion.
Putin certainly didn't anticipate that. Tina, nice to see you. Thank you very much indeed for stopping by to see us. Tina Fordham of Fordham Global Foresight. Thank you very much indeed. What else do you need to know this Friday? Let's get you up to speed. Here is your Bloomberg brief. The US President Donald Trump and his allies are renewing a push to reshape the Federal Reserve after the Supreme Court blocked efforts to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's Board of Governors to clear the way for more of the president's own picks. Here in the UK, some in the Labour Party are worried that Andy Burnham risks repeating the mistake of not being prepared for government. A similar mistake was made, of course, by Keir Starmer. This as he delays key personnel decisions. Burnham won't announce key appointments, such as the Chancellor, until after the selection process for the party's new leader formally concludes, which effectively will put him in to 10 Downing Street, making him Prime Minister. But that will leave him and his ministers with a very narrow window to prepare for government. And Michael Burry says the Micron rally has reached historically extreme levels. In a Substack post, the Big Short investor wrote he is shorting the stock, claiming its recent gains have been driven by AI hype and investor FOMO rather than fundamentals. And you're up to speed. That was your Bloomberg brief. Quick check on the markets just to show you what is happening. It is a quiet session, as we've already indicated, as a result of the holiday that is taking place over in the United States. Volume is light pretty much across the piece. S&P's up slightly in terms of the futures picture. Dollar yen doing nothing. Brent crude doing absolutely nothing as well at 71.65. European equities have faded an earlier rally and are now up by 1/10%. The dollar is down a touch after the payrolls yesterday. In fact, the surprise this morning is that gold is finding maybe a little bit of traction. Let's get back to that story, though, or we'll come back to that story of the heat in the United States in just a moment. It is, of course, the wedding of the century. Yes, this weekend in New York, and it's super hot. Taylor Swift and Travis Kelce reportedly preparing to tie the knot in New York City in the heat. We'll find out whether they've got air conditioning next. This is Bloomberg.
anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation was a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, yet ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Listen, I'm more concerned about, last month, people were tremendously excited about a big jobs number. But if you actually broke it down last month, you had 54,000 jobs in state and local, and we didn't really get anything this month. And then you had this huge bump in restaurants and in bars, and then obviously that came off significantly, although I'm surprised it actually came off that much this month. I thought it would have taken another month or two for that to come off. But listen, I think that the hiring in the country is just okay. I mean, I think it is. I think Mike McKee said it right. It's stable. It's okay. But you've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay. I just don't think we are hiring that many people. And I was looking at some of the data earlier in the week, the Challenger job cuts data. You had layoffs, I think, in tech of 443,000 jobs. That's up 83% year on year of increased cuts. So anyway, I think, when you break it down and I look across industries, once again, healthcare is incredible. You look at healthcare and education, 67,000 of the, 57,000 jobs. It's all healthcare and education. And so anyway, I think the hiring is stable, but I would say broadly unimpressive. And, one man's opinion, that's part of why I don't really understand, significant raises in interest rates relative to this. I think we're in an employment dynamic today that is just okay. And, I'd say one thing about, you saw that, the hiring, maybe we don't have enough people because the labor force declined, but you've seen a persistent decline in average hourly earnings or wage or earnings data. And that doesn't suggest that companies are stressed about hiring people when you're not really seeing any significant wage growth. So anyway, one man's opinion, good economy, employment, just okay.
You are one man, but you are one man we respect and happens to be incredibly brilliant. So your thoughts matter a lot, Rick. Okay, so you don't see any reason to hike based on this data, but it is at least data that should allow the Fed to hold, or do you go so far as to say with this data in hand, there is room for the Fed to be contemplating cuts this year?
I mean, I don't think contemplating cuts, at the beginning of the or the next meeting or two, I think would certainly be enthusiastic to say the least. Listen, I think you got to wait to the back end of the year or to the very back part of the year. But I don't think they're off the table for the back part of the year. I mean, I think Chair Warsh said yesterday, you are seeing, and by the way, you look at oil now under 70, you are seeing some improvement in energy costs. When you break down inflation and you look at what is the component parts of inflation today, core goods is running at pretty close to zero, 3-month, 6-month moving average, pretty close to zero. You still have service level inflation, which no doubt is too high. But if you strip out shelter, And I would argue, if we got mortgage rates down in the country, you'd improve shelter inflation. You're running at, depending on 3 months, 6 months, 2.5 to 3-ish, a little over 3. So anyway, I just think you have time. And I think Chair Warsh, and by the way, I have a huge applause for stepping back and thinking about, through task force and otherwise, the way you actually improve inflation when you've got sticky things like healthcare, education, insurance that don't really get impacted by the overnight funds rate. There are other tools you have. These things are really complex. Let's get some experts to analyze. Are we restrictive on the overnight funds rate? Well, not in housing, but maybe some other places. Or sorry, maybe you are restrictive in housing, I should say, but maybe not in other places. These things are really complex. And I applaud the fact you're going to really step back, think about what are some really complex issues, and what are the most appropriate tools to try and deal with those effectively.
Rick, there are many people who have expressed discomfort, let's say, about a Fed chair who's not more giving in his reaction function and his understanding of how he sees the labor market, for example. Claudia Salm was talking about that with Tom Keene on Surveillance Radio just about an hour or so ago. Does that make you uncomfortable at all? Not necessarily that we're not getting forward guidance, but we're at least not getting more insight into how Chair Warsh is thinking about labor market, about inflation, about these key issues that the market needs to trade on and that matter for our economy.
And I really don't. I actually think, the way it was articulated, in the first press conference about, you want to see what the market's reaction function is to move to the dots. And by the way, if you look at historically, the forecast of the dots, particularly after you go out a quarter or so, not really very good. The fact that the markets have to pivot to those numbers or pivot to the Fed's reaction function, I actually don't think that's right. And I think there's a real elegance to, if you want to move, if you really want policy to be effective, you actually want to create change. You don't have to, particularly when you're easing, you don't have to be so prescriptive about that change. You actually want to create a little bit of energy and a little bit of surprise, because that's how you create economic and financial velocity. So, do you have at inflection points a little bit more volatility? Maybe. But I think at the end, I thought he made a statement that said, when we have something to say, we're going to say it. I like it. Like that to me is like, as long as you lay out the metrics, what are the benchmarks you're looking at, and then the markets can interpret those and make their decisions based on what those metrics and what your clear path of focus is versus the Fed having to tell you specifically, here's where we're going to go with it.
Let's talk about the market reaction, Rick, because post-FOMC, it had been one of higher yields where the 10-year yield started to bump up against 5.5%. We back off of that this morning, 2-year yields declining 4 basis points. Do you think we've seen a peak in yields now?
I will say one thing. I think I did a presentation that I said it's summertime, time to get serious. Although I go in a long weekend, I'm not sure everybody's as serious. But listen, I think these real rates are pretty interesting now. We're not adding a lot of interest rate exposure yet, but you're getting to the point where these real rates are pretty interesting, particularly if you think, which we do, that you'll see some abating of inflation. You're seeing that with energy costs, et cetera. So our view today is, I don't think we're going to make a lot of money on interest rate exposure. I actually think Europe's interesting because you see growth tangibly slowing and you're pricing in significant hikes. I think Europe, days like today, you get a little bit of softness, maybe add some European duration, or maybe we did. I think that's more interesting. In the U.S., gosh, I think income. Like, let's just carry. And if you can keep your income up, you're in this amazing environment with these real rates and with some spread. You can create 6.5% yields or even a bit above that. And to me, that's a much better disposition than like, gosh, I think the Fed's going to cut, because they're clearly not going there anytime soon.
Well, when it comes to bank, year to date, your total return is certainly exceeding the ag, both in the U.S. and globally. That also stands if you take it out from a wider time horizon, too. I know you were also discussing on ETF IQ this idea that IG beta is less interesting to you. So where in this American market are you squeezing out the yield?
There's a little bit of, I call it dynamic patience. There's, the new issue markets give you some opportunity. High yield is still, particularly Europe, like some of these spread markets, if you're a dollar investor, you swap back to dollars. European high yield, even European IG is pretty attractive when you bring it back to dollars. And, in particular, if you believe Europe is going to have to reduce rates over time. EM gets you some yield, and there's some places to pick up some yield across emerging markets. Securitized markets, there's so many things to do in securitized markets around commercial, residential, non-agency, et cetera. So it's those areas. And, I think we're in one of those environments. You pick a little bit here, you pick a little bit there. There's yield everywhere. And I just find like where you get really tight trading levels like USIG when there's a lot of supply coming. Yeah, agency mortgages are just okay. We trade them around a lot. But I like clipping coupon in some of the high yield markets and then going global to get some of that yield.
Hey, Rick, I hate to do this to you. I only got 30 seconds, but I would just love to get your thoughts. The pace of issuance for IG, already $1.1 trillion. Is that sustainable?
It's a lot. And, the markets that are blessed by huge pension demand, huge life or insurance demand, and you get a lot of cash. It's a lot that's coming. And part of why I don't think spreads are that interesting. You got to absorb a lot of that supply. My sense is, could you have a little bit of indigestion? Yeah, I think so. But there's still pretty immense demand to soak this up. So I don't think it'll be that interesting. But my sense is, it's not really that exciting to own it either.
Rick Reader of BlackRock speaking to Danny following the payroll report that we saw yesterday, coming in a little weaker than anticipated. The United States is, happy birthday, America, enjoying its long weekend, 4th of July, it's the 3rd of July today. A lot going on in New York. There's a lot happening in New York, where officials are definitely preparing the city for Taylor Swift and Trevor Kelsey's expected wedding that is taking place over the weekend, Madison Square Gardens. We think around 1,000 guests are going to be there. But this is all happening with this heat dome and the extraordinary heat that we're seeing. Is New York ready for all of this? Let's find out. Miles Miller joins us from the Big Apple. Are we ready?
Yeah, we certainly seem pretty ready for it. We've got two sort of really big things happening. We've got the July 4th celebrations, and then we've got Taylor Swift and Travis Kelsey's wedding happening at Madison Square Garden. As for the wedding, very self-contained in Madison Square Garden. You won't see any of the stars really going in there. They erected a big tent so that 500 vehicles can go in, get those people in and out without any hitch. We know the festivities start around 5 o'clock, a cocktail hour in the concourse area where people spill their beers and chant obscene things to fans of other teams. And then the big event happens on the arena floor, and the party is expected to go on until 5 in the morning. When that is all said and done, then the city puts on a major 4th of July celebration. It's going to be a big one for the country's 250th birthday. We'll have fireworks on both rivers, the East and the Hudson, and then that parade of ships. It's going to be quite an undertaking for New York with this heat dome over us, and so let's see how we all fare, but it is very hot outside.
Miles Miller, keeping cool, I'm sure. Thank you very much indeed. Coming up, we are going to be joined by Jessica Novoskis of Marquette Associates. Jane Foley of Rabobank will be with us as well. It's a big hour coming up. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
One p.m. in London, that makes it 8 a.m. in New York. Welcome to Bloomberg Markets. I'm Guy Johnson. US markets are closed today. It is the 3rd of July today, but it is the 4th of July weekend, which Americans are enjoying. Happy birthday, America, as I mentioned just before. It is a big one for America. So they're out enjoying themselves. But it means that markets are basically very, very quiet. And we're seeing very light volume across most of the major assets. European stocks are doing very little right now. They are, though, heading for their best week since May. AI trade jitters certainly beginning to subside. European benchmarks, as you can see, are at all-time highs. And actually, we picked up over the last 10 or 15 minutes. The yen is showing some strength as traders brace for holiday intervention risk. We'll talk about that with Jane Foley shortly. The currency touching its weakest level in 40 years earlier this week. Haven't seen much volatility so far, though. And supply shocks are easing. The new Bank of France governor says the ECB is now in a comfortable situation after last month's interest rate hike. OK, let's just quick recap of the markets just to show you where we are. As I say, I wouldn't read too much into the price action today. The reason for that is the super light volume that we're seeing. S&P futures ticking up a little bit over the last 10 or 15 minutes. We're up by 0.3%. Dollar yen is doing nothing. Brent crude is doing very little. We're down 0.2%, 71.63. European equities, we were, last time I checked, kind of up by 0.1%. We're now up by 0.3%, but these are not enormous moves, and they are being delivered on super light volume. The dollar is doing nothing. Gold, though, is up. 41.80 spot 66 is where we are now, up by 1.42%, though it has taken a battering of late. So that's the kind of top-down macro picture. What you need to look at, though, is some of the other kind of trends that we're watching within markets quite carefully at the moment, because what you're seeing is quite a lot of inter-region flows. The flow story is really interesting, and Natalia Gnezovic is here with more on that story. Your team tracks all of this. What are you seeing?
Investors are actually turning away from the U.S. Stock market. We saw the most recent report from Bank of America. It shows that outflows from U.S. stock market are now happening at the fastest pace since March. U.S. stock funds had about $17.2 billion of outflows through the week, for the week through July 1st. And the mood, of course, is shifting. We see lots of concerns about valuations, etc. And then Also, JP Morgan strategists earlier this week said that extreme outperformance of U.S. semiconductor stocks versus AI hyperscalers created unsustainable valuation, and they expect it will ultimately will narrow. Notably, we see that investors turned to some international stocks instead. We see some gains and inflows into Japanese equities. The biggest inflows in 7 weeks are sitting at about $2 billion. So it's kind of a rotation trade.
We're starting to see that. Talk to me about what we're getting in options.
Yeah, so options traders, this is a different part of the story.
Yes.
The market, it depends how you look at the market, right? Because options traders are really bullish on U.S. stock market. We see huge demand for call options, specifically across technology stocks. We saw that premium is much more elevated versus broader markets. Even yesterday, I spoke with options traders, and they said that they see pretty solid demand for call options on semiconductor stocks, so demand is there. And then again, this is a kind of stock pickers market because we see that correlations across single stocks are now at the lowest level in 15 years, so it's a good environment for stock pickers.
Okay. I'm always told that this is the time for active. Maybe this is the time for active. Natalia, thank you, Natalia Knežević, on what we're seeing in terms of the markets. Jessica Novoskis, OCIO, portfolio strategist at Market Associates, joins us now this holiday. Jessica, thank you very much indeed, first of all, for joining us on the holiday. What do you make of this market? We are seeing, obviously, there's a real bifurcation in terms of the views that I get. Earlier in the show, we had a guest on that says, the AI rally, you just want to roll with it. You just want to make sure that you're there. Yeah, be careful, but keep riding the wave. What do you think?
I think it's an incredibly difficult market to play because I don't think that person is alone in thinking that. I think there's so much uncertainty. There are such big numbers being spent, and this is a technology that a lot of people don't understand, don't know how to size. We don't know who the ultimate winners will be, who the losers will be. And there is so much momentum and leverage in this market that to take a stand against it and not participate has been a huge issue for folks. So you can size up the risks all you want, but to step back is to take a really big move in the market.
Okay, so if I don't want to step back, but I want to hedge my risks, or at least get some hedging in place, how do I do that?
So for us, when we build portfolios for our clients, we're taking a diversified approach. So equities are certainly a big part of that. I think it's very difficult to hedge that equity exposure specifically, but we're also building fixed income and private markets into portfolios. We're really looking for different allocations that can bring different risk factors into a portfolio, and it's at that total portfolio level then that we look for just more stable returns.
Okay, in terms of US versus international, how are you playing that picture?
Yeah, so again, for us, it's about diversification. So for a long time, we're obviously based in the US here. A lot of our clients were asking why we were invested in international stocks at all. I think last year proved exactly why we've always stayed invested. It's very difficult, right? The tariff war came and everyone thought that would be great for the US and negative for the rest of the world. And the outcome was actually the exact opposite. So it's very difficult to play regions. For our level, we look to work with really high quality investment managers that we look to navigate some of those more specific dynamics. But for us, we try to stay in line with sort of that MSCI ACWI, which is 65 US, 35% non-US. And for most of our portfolios, that works.
In terms of, are there any uncorrelated assets out there? When you try and think about what you can put in a portfolio, for a while it was gold. Everybody was like, gold is uncorrelated, it's going to be fantastic, it's going to be this great diversifier in my portfolio, and now it's not.
For us, our favorite asset class in terms of diversification is private infrastructure. So it is actually very stable. It's aligned with inflation. It can be counter-cyclical. So for us, that is one asset class that does tend to stay uncorrelated. Even real estate, right? We used to be a core part of real assets allocations, but we've seen the correlation there with interest rates, which also have a huge impact on fixed income and equity. So some of the private markets they do tend to get cyclical, especially in marks. So for infrastructure, for us, is really our top diversifier.
In terms of what could happen there, Is that an absolute trade, or when you think about diversifiers, do you think about them as being absolute or relative? I'm going to lose less if the whole market goes down, or I'm actually going to make gains when the whole market goes down. When you talk about diversification, which one of those two are you talking about?
Yeah, at the absolute level, or at the whole portfolio level, it is certainly relative. Infrastructure, actually, though, is absolute. Very few times has infrastructure actually put up absolute declines. The counter-cyclicalness comes into play there. So a lot of these are toll road assets. And so when the economy is down and folks aren't flying as much, they're driving more. So it's those types of assets that really hold up those absolute returns for infrastructure.
You don't think so? What do you think about fixed income? So what normally you'd build a 60-40 portfolio, and fixed income would play a big part in that kind of that offsetting factor. Doesn't feel like it's going to do that this time.
No, it doesn't. And there's been in the last few years a number of times when that 60-40 portfolio would have disappointed. For us, fixed income is sort of that stable cash yield in a portfolio, but it's not our key diversifier. Really, private markets where they are able to make decisions not based on the economic cycle, right? Secular growth, capital sources that hopefully are uncorrelated with interest rates. Those folks have a better chance of adding value. And then again, you have to look to counter-cyclical assets, and it's not commodities anymore. You have to go deeper into the real assets.
Jessica, the biggest diversifier over the last few years has been the Federal Reserve. When markets have tanked, the Federal Reserve has stepped in and protected investors. Do you think that the Fed is still going to play that role with Kevin Warsh at the helm?
That certainly remains to be seen. So we know that the administration is sensitive to the stock markets, and we know that the administration likes to try to influence the Federal Reserve. I think when Warsh came out in that first press conference, he showed that he is not going to be a puppet, right? He's that inflation hawk that we thought he was. So I think he's going to take the approach that he needs to take to build the legacy that he wants. He's drawn a hard line on inflation. We'll see how that evolves. If the economy evolves, right, and labor becomes more of an issue, growth becomes more of an issue. But so far, we have no indication that he is going to be overly sensitive to the stock market.
Jessica, enjoy the rest of the holiday. Thanks for stepping up early for us. We really appreciate it. Enjoy the long weekend. Thank you. Jessica Novoskus of Market Associates. OK, let's get you up to speed what else you need to know this Friday morning. Here's your Bloomberg brief. Iran is hosting foreign officials from key backers, including China and Russia, this weekend for the funeral of the former Supreme Leader Ali Khamenei. Beijing will be represented by the deputy leader of its top legislative body, and Russia by former President Dmitry Medvedev, who is now deputy chairman of the Russian Security Council. The US is pressing gasoline retailers to pass on lower fuel costs to consumers. Treasury Secretary Bessent telling CBS News he expects average prices to fall by $2-3 a gallon by Labor Day. Citi currently sees Brent falling to between 60 and 65 a barrel by the end of this year, as the US-Iran MOU, they think, expected to hold. And ECB President Christine Lagarde says she won't rule out leaving her current position early to participate in French politics. Lagarde reiterated that the captain of the ECB ship should stay on board during a period of turbulence. Remember, her term ends in October 2027. We have a French election in 2027. And that is your Bloomberg brief. Quick check on the markets. This is what is currently happening, and the answer, to be brutally honest, is not a lot. S&P futures have ticked up a little bit. Dollar yen is doing nothing. Brent crude is doing nothing. Beginning to roll over, actually, a little bit more, 71.50, but not by much. In terms of what we're seeing here in Europe, it is a very light session in terms of the volume picture. The stock 600 is up by 0.3%. The dollar is absolutely flat. The surprise, maybe over the last couple of days, has been some stabilization that we are seeing in the price of gold. 41.80. We're up by 1.4%. Let's turn our attention to the inflation narrative next. Certainly top of mind for central bankers around the world. We are going to hear France's interview with the Bank of France Governor Emmanuel Moulin next. That is coming up. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
"14 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. A few days ago, we were in Sintra. Now we're in Aix-en-Provence. The central bank circus has been moving around Europe over the last few days. But the south of France is now the venue for the action. And there, the new Bank of France governor, Emmanuel Moulin, has been saying that the ECB is in a comfortable situation. This, of course, after last month's interest rate hike. Earlier today, the governing council member of the ECB spoke to Bloomberg's Francine Lacroix at the Aix-en-Provence Economic Conference.
It certainly is going to make our job easier. It's true that we've been hurt by supply shock, which increased price of energy. And the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well, we will have new forecast in September. But I think, we are comfortable in our base scenario. And the news on what's happening in the Strait of Hormuz is globally good news.
I mean, overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two meetings.
Governor, talking about data, so Banque de France has a lot of great data looking at small and medium enterprises, inflation. What are you seeing in the last month?
Well, we've seen, what we've seen is really soft growth. This is not very dynamic. Unfortunately, we had not a very good Q1. We see industry doing pretty well, thanks to investment in defense in particular, and in energy, electricity, and also the boom in AI. We see services much softer and construction much softer. So we don't expect a sharp increase in growth in Q2, but we'll see. We'll see. I think the fact that we have less pressure on the oil price is also good news. So it might make growth a little bit higher than we expect.
So you've been in charge for just over a month.
Yes.
What's been the biggest surprise?
Well, I knew part of the job, but monetary policy is a very serious job. We use a lot of data. We look at really a big set of data. We look at different scenarios. We have very, technical and in-depth discussion at the table of the Governing Council. We act as Europeans, not as national governors, as Europeans, and we take, the best decision in that context.
I mean, how do you look at AI in the future, what it means for, first of all, inflation? Is it automatically inflationary in the shorter term because of CapEx, and then disinflationary? That's what we think.
Now in the short term, it's mainly inflationary because you have large capital expense, so it's an increase in demand, and mainly in the US for the moment. Then we can expect that it might be deflationary because of productivity gains, but it will take some time before we see that, because we need adoption. We need that AI fits through all the production process in companies, not only generative AI, but really changing the way we produce and we manage our companies. So it will take some time.
What are some of the data points that you look at? I know you look at, services inflation, wages coming up. Is there something that you see is more indicative?
We look at a broad set of data. So we look at, inflation. We look at core inflation. We look at services. We look also at inflation at products that are not linked to the energy to see if there is, broad-based inflation. We look at wages. We don't really see second round effect at the moment. And we look also at expectation, because they are key in terms of our credibility.
And when you look at some of those figures overall, I mean, how is AI going to change what you look at in terms of models?
Well, I think, we'll be able certainly to analyze a much broader set of data. And what we need is also to make sure that we can have real-time, assessment. I was listening to Kevin Walsh that he was saying that we always look at data, which are historical data and which are in the past. And we need to project ourselves in the future and see, we do forecast, but we need also to try to gather a very broad set of data in order to make the best decisions.
Governor Mouna, I mean, France is going to go through a big year. And, the next 12 months will be very crucial because there's going to be a presidential election.
Yeah.
Do you worry about a market event, kind of, bond spreads moving as we've seen in the past?
Really, we've had a minority government for quite some time now. We had some difficulties to pass the budget, but we have a budget for 2026. And we've seen, the spreads are very stable. And we have no issue in terms of auctions of our debt. We have solid demand. We have very good bid to cover ratio. So I think, we need to make sure that we stick to our commitments and the government sticks to its commitment in terms of reduction of the deficit. But I don't see a market event at the moment.
Would the ECB stand ready to act if there was a market event?
I'm not into political fiction, and we are doing scenario for forecast, but not for for political events. So we are following the situation. But I think we're in a good shape at the moment.
Governor Mouna, just a final question. I mean, in the next 3-4 months, what will your priorities be as you find your feet?
I'll have, priorities will be obviously our monetary strategy and to make sure that, inflation goes back to our target. That's our first priority. My second priority is monetary sovereignty that has been voted in Parliament, and the Banque de France will be, at the forefront in order to develop the digital euro.
What is the biggest question actually for the digital euro? Because we don't know whether it comes in a portfolio, a wallet. There's so many questions.
Well, there are so many questions, but it's going to be an electronic bill. So you will be able to pay with an equivalent of cash in all, between citizens, in shops, in e-commerce, etc., which you cannot do at the moment with your cash. You have to go through either a US provider, Visa, MasterCard, or Apple, or these companies. We will have really, central bank money, which will be available to all the citizens in the digital world.
The new governor of the Banque of France, Governor Emmanuel Moulin, speaking there at the Aix-en-Provence conference that is taking place over the next few days with Bloomberg's Francine Lacqua. Keep an eye on him over the next few weeks, months and years. Let's talk about where we are with the markets this morning. It is an American holiday. It's a very important American holiday. It's the 4th of July holiday. Today is the 3rd. There is a long weekend. It is 250 years, obviously, that is being celebrated this year. And it means that markets are a little lighter, quieter than they normally are. S&P futures are ticking up a little bit. We're still digesting the payroll from yesterday. Dollar yen is doing absolutely nothing. We're going to find out what happens next in that space, though, with Jane Foley. She'll be with us shortly. Brent crude, a little softer this morning, 71.61. Citi's out with a note this morning saying it expects 60 to 65 by year end. In terms of European equities, super light volume this morning. Stock 600 is up by 0.3%, off its earlier lows. The dollar is doing nothing, but the surprise maybe is that we're seeing some signs of stabilization within the gold price right now, as we see some weakness coming through with the dollar. But the gold story has been one of a downward spiral over the last few weeks after we hit, obviously, big highs earlier on this year. So that's where we are right now. Up next, we're going to address one of the key questions that we're trying to answer at the moment. What will the Japanese authorities do about the super weak yen that we currently have? Will we see intervention? Will we see rate rises? We're going to try and answer all of those questions. Jane Foley from Rabobank will be joining us after this. That's next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. Half You're watching Bloomberg Markets. I'm Guy Johnson. It is a long weekend in America. Markets are quiet around the world as a result of that. You're not seeing much action, certainly when it comes to European markets, and it's a similar story stateside, to be honest. Cash is obviously closed today. Futures are up by 0.3%. Dollar yen, we'll get to that in just a moment. Crude is a little softer, but not much, 71.54. We're watching what is happening with the negotiations around the Strait of Hormuz very carefully. In terms of the picture here in Europe, super light volume. Equities are up a little bit, but not by much, 0.3%. The dollar is absolutely flat on a sort of broad brush basis with the dollar index. Bloomberg dollar index down by 0.1%. Gold just beginning to fade a little bit. It's been up by 1.4 throughout most of the day so far, now up by 1.2%. So what are we seeing in terms of what is going on below the surface? Let's try and answer that question right now. We're going to start with the hedge funds because Natalia is back and she's been tracking what they're doing.
Yeah, so Guy, we saw that hedge funds turned into sellers of global stocks. For example, last week we saw that global IT and communication services stocks saw the biggest selling in over 10 years. And that sell-off was driven by a reducing of long positions as well as short positions. And it was led by, it's not a surprise, by semiconductor stocks. The question is why? We see that hedge funds posted the strongest quarterly gain last quarter since 2016, so they are not forced to participate in this rally.
Is this just a profit-taking story? They're just reducing leverage. Leverage was quite extreme.
And they want to maybe, sit on some gains ahead of potentially volatile rest of this summer.
CTAs, systematic funds?
Yeah, so exposure across CTAs has also become a little bit elevated, and the Goldman Sachs trading desk is now modeling that CTAs will turn into sellers of global stocks no matter which direction the market goes. So for now, selling is not going to be huge, maybe at around $6.6 billion in a flat tape, and then about $3.2 billion into a rally. But over the next months, that selling can be much more pronounced.
Has anybody told retail?
Yes, it is an interesting picture because institutionals are kind of on the bearish side, but retail traders are not. So we see that in May and June, retail traders were super active. Average daily retail cash equity volumes are now running at 65% versus above 2025 levels. And more importantly, despite this huge participation in equity in U.S. stock market, household cash has increased to 8% of total financial assets, and this is the highest level in more than 10 years.
Okay.
So they have more cash to deploy.
Yeah, they've potentially got more cash, but it's interesting that other sectors of the market definitely pulling back. Natalia, thank you very much indeed.
Thank you.
Natalia Knezovic joining us on what the internals maybe are telling us about this market setup. Let's turn from stocks to what is happening in the currency market. The yen has touched its highest level in 2 weeks versus the dollar amid rising speculation around intervention. This weekend, today, this afternoon, here in Europe, may be the perfect moment if you're the Japanese authorities to step in. Volume is very, very light out there. But I'm looking at dollar yen, and you can see it on the screen right now. Yeah, we're getting a little bit of volatility, but we're not getting much. Jane Foley of Rabobank writing, there is so much speculation that the Ministry of Finance may take advantage of thin holiday conditions today to intervene in favour of the yen, that the bigger surprise may be that no action is taken. Jane, good afternoon. Are we in the latter camp now? Do you think no action is the more likely scenario?
You know, it's quite interesting because there's a lot of discussion right now that the Ministry of Finance is changing tack. And of course, if that's the case, well, we need to try and figure out what that tack might be. And of course, you know, they do want to introduce this element of surprise. But of course, if we all expect them to intervene at a certain time, there won't be that surprise. Nevertheless, there would be very thin conditions today, so they could potentially get more for their buck. Now, what we have had, I think, today, we've had more news about the strength of earnings data, for instance, in Japan. The unions, one of the biggest unions, again, for the third year running, really quite strong wage inflation there. We've had, of course, a very strong Tankan report this week. We've had data such as retail sales been really very buoyant. And, of course, the Bank of Japan have been pointing to the resilience of the domestic consumer, the domestic corporate sector too. So from that point of view, you know, you have to ask, you know, are the factors coming together for the Bank of Japan to potentially accelerate the pace of its interest rate hikes? And I think that is going to be a crucial part of any turnaround in the end, if it can be manufactured in the months ahead.
So how high would rates need to go, do you think, to have a meaningful impact? How many more rate hikes would we have to see? What would the pace need to look like?
Well, that's all relative. And I think the key part of this, of course, is what's happening over in the US. Now, first of all, you know, we've got to say that even though dollar yen has kept on hitting the headlines recently, well, actually, over the last month, the yen hasn't really gone anywhere against most of the other G10. So this is largely a dollar story, at least in the last few weeks. So, and of course, what we've had since May is this big turnaround in Fed expectations. If you go into the start, for instance, of the Iran war, the market was still expecting the Fed to be cutting interest rates, and come May, early June, the market thought, no, you know, it's a lot more hawkish, and started to anticipate interest rate hikes. Now, that's going to be very difficult for the Bank of Japan or the Ministry of Finance to push against. So I think what happens perhaps in the July payrolls, what happens with respect to the signalling for wash, if we do get any signalling, is going to be really quite key. But it will be extremely helpful to the Japanese authorities if the market decided that maybe that US labour market strength had enough holes in it for the Fed not to be in any rush to hike interest rates.
And what do you think, Jane? Do you think the Fed... Because at the moment, I'm looking at some people telling me I'm getting 3 rate hikes this year, and other people are telling me we're going to get none, and then we get cuts next year. The spread is quite enormous. The market's really undecided. Maybe that's by design from a Walsh point of view, but kind of where do you think we are?
Well, you know, the Rabo view is very much with nothing from the Fed this year, that they will sit on their hands. But of course, you know, I think all of us who are trying to make these forecasts know that we are focused, of course, on that economic data. Now, there were holes in that payrolls report yesterday. The headline number was disappointing. But again, you can look through some of the other indications that we had. The Conference Board survey, for instance, indicating that consumers are suggesting that jobs are more difficult to get. If that's the case, well, that's going to bear down on inflation expectations. That's going to bear down on the likelihood of second-order inflation effects. So that could feed into a slightly more dovish view. But, you know, we are, I think, more focused on that inflation and employment data and activity data in the US than we've been for years, because we know that Walsh doesn't want to give us that forward guidance. So we're sort of back to perhaps where we were even before the global financial crisis, and putting a lot of store, or more store, on that economic data. And I think given those holes that started to appear in the June labour data yesterday, that July number is going to be perhaps even more important than it normally is.
Well, how weak does the labour market need to be for it to offset the above-target inflation that we have seen for not a year, but many years?
Well, you know, I think we are in a different phase of inflation than we were. And I think, we can trace this back to many really big picture macro factors. So, for instance, if we think about globalization, for 30 years, that was probably primarily responsible for bringing us low inflation. We were using goods, for instance, imported from countries that had much lower wage costs. If we are now bringing back, supply chains to a more domestic, to a closer, shorter position, then there's going to be inflationary impacts into that. There's opportunity, of course, related to that, but certainly there's a higher inflationary risk into that. So I think we are in a different scenario, and that implies higher interest rates. But then we have got higher interest rates than we had in, let's say, the post-global financial crisis era, and that will give that emphasis on inflation that we perhaps didn't have in that era. But that doesn't mean to say we're not going to have cyclical changes. We're still going to have periods when the labour market is loosening, when central bankers can focus more on that and away from the inflationary side. And I think what we need to determine over the next few months is whether or not that is going to be the case, whether or not the Fed officials can relax slightly with respect to inflation and then concentrate a little bit more in stopping the labour market from loosening. So this is where we are. Are we in this crux, or are we indeed going to be in a position where inflation remains the standout factor for these policymakers?
Jane, always great to catch up. Thank you very much indeed, as ever, for your time. Jane Foley joining us from Rabobank. What else do we need to know this Friday, this holiday Friday? Here is your Bloomberg brief. Let us start with Donald Trump and his views on what is happening with the Fed. Certainly the president and his allies, you could argue, are renewing their push to reshape the Federal Reserve. This after, of course, the Supreme Court blocked an effort to fire Governor Lisa Cook. Top officials and outside allies are exploring ways to remove members of the Fed's governing board to clear the way for more of the president's own picks. Private credit funds are facing a relentless wave of investor withdrawal requests, with second quarter exit requests exceeding those of the prior quarter. More than $14.5 billion of investor capital is currently trapped at over a dozen funds, compared with the $8.6 billion that shareholders have been able, basically, to get back thus far. And in sports, Spain delivering a dominant performance in the World Cup, beating Austria 3-0 last night. They're now going to face Portugal. Portugal beating Croatia 2-1, little controversial there. Argentina meeting Cape Verde later today. Australia taking on Egypt. OK, you're up to speed. That was your Bloomberg brief. Quick check on the markets, which, as I've been indicating, certainly over the last few hours, remain very, very quiet. The reason for this, obviously, is the US holiday, and therefore we're seeing very light volume. S&P futures are up by 0.3%. The dollar is doing absolutely nothing versus the yen. Brent crude is actually beginning to fade a little bit now. 71.41 is what we are looking at. Here in Europe, equity markets are largely becalmed. We're not seeing much action. The stock 600 is up by 0.3%. The dollar is flat as a pancake. And gold up throughout most of the day thus far, up by 1.4%, just beginning to fade a little bit. We're up by, let's call it 1.3%. Up next, we're going to talk about the weather in the United States. The heat dome that we're seeing on the East Coast, closing many facilities and causing cancellations. Many cities are having to change their holiday plans. We're going to find out what is going on. We'll do that next. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our Constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
.45 minutes past the hour. Welcome back. You're watching Bloomberg Markets. I'm Guy Johnson in London. So, June payrolls showing that US hiring has slowed sharply, with employers adding just 57,000 jobs. And that was well below estimates. BlackRock Global Fixed Income CIO Rick Reeder spoke with Bloomberg's Danny Berger yesterday following these numbers.
Listen, I'm more concerned about, last month, people were tremendously excited about a big jobs number. But if you actually broke it down last month, you had 54,000 jobs in state and local, and we didn't really get anything this month. And then you had this huge bump in restaurants and in bars, and then obviously that came off significantly, although I'm surprised it actually came off that much this month. I thought it would have taken another month or two for that to come off. But listen, I think that the hiring in the country is just okay. I mean, I think it is. I think Mike McKee said it right. It's stable. It's okay. But you've got an economy that's growing at some pretty significant numbers, and the employment picture is just okay. I just don't think we are hiring that many people. And I was looking at some of the data earlier in the week, the Challenger job cuts data. You had layoffs, I think, in tech of 443,000 jobs. That's up 83% year on year of increased cuts. So anyway, I think, when you break it down and I look across industries, once again, healthcare is incredible. You look at healthcare and education, 67,000 of the, 57,000 jobs. It's all healthcare and education. And so anyway, I think the hiring is stable, but I would say broadly unimpressive. And, one man's opinion, that's part of why I don't really understand, significant raises in interest rates relative to this. I think we're in an employment dynamic today that is just okay. And, I'd say one thing about, you saw that, the hiring, maybe we don't have enough people because the labor force declined, but you've seen a persistent decline in average hourly earnings or wage or earnings data. And that doesn't suggest that companies are stressed about hiring people when you're not really seeing any significant wage growth. So anyway, one man's opinion, good economy, employment, just okay.
You are one man, but you are one man we respect and happens to be incredibly brilliant. So your thoughts matter a lot, Rick. Okay, so you don't see any reason to hike based on this data, but it is at least data that should allow the Fed to hold, or do you go so far as to say with this data in hand, there is room for the Fed to be contemplating cuts this year?
I mean, I don't think contemplating cuts, at the beginning of the or the next meeting or two, I think would certainly be enthusiastic to say the least. Listen, I think you got to wait to the back end of the year or to the very back part of the year. But I don't think they're off the table for the back part of the year. I mean, I think Chair Warsh said yesterday, You know, you are seeing, and by the way, you look at oil now under 70, you are seeing some improvement in energy costs. You know, when you break down inflation and you look at what is the component parts of inflation today, core goods is running at pretty close to zero, 3-month, 6-month moving average, pretty close to zero. You still have service level inflation, which no doubt is too high. But if you strip out shelter, and I would argue, you know, if we got mortgage rates down in the country, you'd improve shelter inflation. You know, you're running at, depending on 3 months, 6 months, 2.5 to 3-ish, a little over 3. So anyway, I just think you have time. And I think Chair Warsh, and by the way, I have a huge applause for stepping back and thinking about, through task force and otherwise, you know, the way you actually improve inflation when you've got sticky things like healthcare, education, insurance that don't really get impacted by the overnight funds rate. You know, there are other tools you have. These things are really complex. Let's get some experts to analyze. Are we restrictive on the overnight funds rate? Well, not in housing, but maybe some other places. Or sorry, maybe you are restrictive in housing, I should say, but maybe not in other places. These things are really complex. And I applaud the fact you're going to really step back, think about what are some really complex issues, and what are the most appropriate tools to try and deal with those effectively.
Rick, there are many people who have expressed discomfort, let's say, about a Fed chair who's not more giving in his reaction function and his understanding of how he sees the labor market, for example. Claudia Salm was talking about that with Tom Keene on Surveillance Radio just about an hour or so ago. Does that make you uncomfortable at all? Not necessarily that we're not getting forward guidance, but we're at least not getting more insight into how Chair Warsh is thinking about labor market, about inflation, about these key issues that the market needs to trade on and that matter for our economy.
And I really don't. I actually think, you know, the way it was articulated, you know, in the first press conference about, you know, you want to see what the market's reaction function is to move to the dots. And by the way, if you look at historically, the forecast of the dots, particularly after you go out a quarter or so, not really very good. The fact that the markets have to pivot to those numbers or pivot to the Fed's reaction function, I actually don't think that's right. And I think there's a real elegance to, if you want to move, if you really want policy to be effective, you actually want to create change. You don't have to, particularly when you're easing, you don't have to be so prescriptive about that change. You actually want to create a little bit of energy and a little bit of surprise, because that's how you create economic and financial velocity. So, you know, do you have at inflection points a little bit more volatility? Maybe. But I think at the end, I thought he made a statement that said, when we have something to say, we're going to say it. I like it. Like that to me is like, as long as you lay out the metrics, what are the benchmarks you're looking at, and then the markets can interpret those and make their decisions based on what those metrics and what your clear path of focus is versus the Fed having to tell you specifically, here's where we're going to go with it.
Let's talk about the market reaction, right? Because post-FOMC, it had been one of higher yields where the 10-year yield started to bump up against 5.5%. We back off of that this morning, 2-year yields declining 4 basis points. Do you think we've seen a peak in yields now?
You know, I will say one thing. I think I did a presentation that I said it's summertime, time to get serious. Although I go on a long weekend, you know, I'm not sure everybody's as serious. But listen, I think these real rates are pretty interesting now. You know, we're not adding a lot of interest rate exposure yet, but you know, you're getting to the point where these real rates are pretty interesting, particularly if you think, which we do, that you'll see some abating of inflation. You're seeing that with energy costs, et cetera. So, you know, our view today is, you know, I don't think we're going to make a lot of money on interest rate exposure. I actually think Europe's interesting because you see growth tangibly slowing and you're pricing in significant hikes. I think Europe, you know, days like today, you get a little bit of softness, maybe add some European duration, or maybe we did. I think that's more interesting. In the U.S., gosh, I think income. Like, let's just carry. And if you can keep your income up, you're in this amazing environment with these real rates and with some spread. You can create 6.5% yields or even a bit above that. And to me, that's a much better disposition than, like, gosh, I think the Fed's going to cut, because they're clearly not going there anytime soon.
Well, when it comes to bank, I mean, year to date, your total return is certainly exceeding the ag, both in the U.S. and globally. That also stands if you take it out from a wider time horizon, too. I know you were also discussing on ETF IQ this idea that IG beta is less interesting to you. So where in this American market are you squeezing out the yield?
You know, there's a little bit of, I call it dynamic patience. You know, there's, you know, the new issue markets give you some opportunity. High yield is still, particularly Europe, like some of these spread markets, if you're a dollar investor, you swap back to dollars. European high yield, even European IG is pretty attractive when you bring it back to dollars. And, you know, in particular, if you believe Europe is going to have to reduce rates over time. You know, EM gets you some yield, and there's some places to pick up some yield across emerging markets. Securitized markets, you know, there's so many things to do in securitized markets around commercial, residential, non-agency, et cetera. So it's those areas. And, you know, I think we're in one of those environments. You pick a little bit here, you pick a little bit there. There's yield everywhere. And I just find like where you get really tight trading levels like USIG when there's a lot of supply coming. Yeah, agency mortgages are just okay. You know, we trade them around a lot. But you know, I like clipping coupon in some of the high yield markets and then going global to get some of that yield.
Hey, Rick, I hate to do this to you. I only got 30 seconds, but I would just love to get your thoughts. The pace of issuance for IG, already $1.1 trillion. Is that sustainable?
It's a lot. And, you know, the markets that are blessed by huge pension demand, huge life or insurance demand, and you get a lot of cash. It's a lot that's coming. And part of why I don't think spreads are that interesting, you got to absorb a lot of that supply. My sense is, you know, could you have a little bit of indigestion? Yeah, I think so. But there's still pretty immense demand to soak this up. So I don't think it'll be that interesting. But my sense is, like, it's not really that exciting to own it either.
That was, of course, the one and only Rick Reeder of BlackRock speaking with the one and only Danny Berger following yesterday's payroll data, which came a little early because of the fact that America is out today. It was payroll Thursday, not payroll Friday. Today is Friday. European equity markets are largely becalmed. US equity markets are open in the form of futures and not doing a great deal. So we're up by 0.3%. Dollar yen has done nothing today. We were waiting for some volatility there. We didn't get it. Crude is a little softer now. It's been softening up throughout the last half hour. In terms of the European story, Stock 600 are doing not much. We're up by 0.3%. In terms of the points gain, ASML is the lead there. So tech is in front. Some of the pharmaceutical stocks are a little softer. Astra, Roche, Novo Nordisk, those kinds of names are softening up a little bit today. Gold, just fading an early move, but still up by 1.3%. So that wraps things up in terms of the hours that I've been with you. We are waiting, obviously, to see what happens come Monday. There's a lot of things that are going to happen between now and then. But America is going to be enjoying its birthday celebrations, 250 years. Obviously, we're going to be watching as well what happens in New York City at Madison Square Gardens. The wedding that is taking place there will certainly cause a lot of consternation. But we're going to continue our coverage right here at Bloomberg. We'll be looking for maybe some activity in dollar yen. We'll try and get a handle on what is happening going forward with the Fed after we saw that week payroll data. All of that is going to be handled over the next few hours by Lizzie Burden, who's got some great guests lined up. Colin Graham of Rebecca is going to be joining us. Jennifer Lee of BMO Capital is going to be joining us as well. All of these great guests lined up over the next few hours. America, enjoy your birthday. We'll see you Monday. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London. Well, US markets are closed for a holiday ahead of the July 4th holiday tomorrow, but here's what you need to know. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after that weak US jobs report. President Trump and his allies are renewing a push to reshape the Federal Reserve, with the Governor Lisa Cook still a target. And a heat dome has settled over the US East Coast, pushing New York City to its hottest day since 2012. Well, let's get a check on the markets, shall we? The Stock 600 up 0.4%, but these are thin volumes around the world, given that the US is closed. We're headed for back-to-back record highs, in fact, on the benchmark European index, powering towards its best week since May. The CAC 40 in Paris is currently up 0.25%. Greater gains in Germany on the Frankfurt DAX up 0.7%, but the FTSE is down 0.1%. Now, let's turn to the cross-asset picture. We have got Brent weaker 0.3%. The dollar is also a little weaker, unsurprisingly, given what we saw on payrolls yesterday. And we are looking at treasuries closed for cash trading. But if we take the temperature in your bond space, the German 10-year at 2.93. Now, let's think a little more about those US jobs numbers, shall we? Hiring slowing sharply in June, curbing some of the budding momentum in job growth that we had seen earlier on in the year. White House National Economic Council Director Kevin Hassett spoke to Bloomberg about the labour market.
I would say that it's on an upward trajectory, that 3 of the last 4 months surprised on the upside, as you know. There were a little bit of downward revisions. This one came in a little bit below expectations, but if you lift up the hood, then the basic story that we think is animating the economy right now is that there's a construction boom.
Let's get some analysis now with Colin Graham, head of multi-asset strategies over at Rebecco. He says that despite slowing labour market growth, the overall picture is positive. So you kind of, Colin, sound a little bit like Kevin Hassett there. He's still optimistic, but that payrolls number is so far below expectations.
But I think it's also, you've got this, how do you seasonally adjust something like the World Cup? So we saw hiring accelerate before that. So again, the Fed is going to stay very focused on the labour market. So we think the US is, at Rebecco, we think it's a real high pressure economy. So rates are about right for the economy. You can't say they're too high because they're not having an impact on the economy. So you are seeing this high-pressure economy in the US, which, again, will be good for risk assets, especially in the US.
OK, so the market's not making a mistake assuming that this number means the Fed can relax, basically.
Yeah, I think we weren't in the camp that the Fed was going to raise rates. We saw the inflation numbers, but we thought that was a short term. And yet the central banks seem to be fighting the last war, which was the inflation in 2022 after COVID, rather than thinking about actually what is the situation today. So the oil price did spike. You saw inflationary pressures come through. And now you see the ECB talking about second-round effects. But we think the second-round effects are going to be much more lower this time than they were last time.
But even aside from the second-round effects, you've still got the threat of tolls being charged by Oman and Iran in the Strait of Hormuz. So you could still have higher shipping costs. Surely the inflation worries can't go away yet.
They can't go away. They won't be dissipated. It's just whether they're important enough to change the central bank's outlook. And I don't think it is, because if you look at what's happened in the last 2 years with the amount of tariffs, that is a much bigger element to the cost of goods moving around the world than tolls will be on the Strait of Hormuz. And you're seeing that companies are looking to get around that. You saw the announcement in Canada about building a pipeline. So there is other ways, and the longer this goes on, the more ways the economy will adjust to the friction that's been put in the works.
So if tariffs are the greater risk, how should markets and the Fed be thinking about that in the second half of the year?
Well, I think that they continue to say, well, we focus on inflation, and we think that that's going to come down. We focus on consumers in the US and thinking about service inflation, and we see that is on a downward trajectory as well. So from that perspective, they should feel a lot more there's a margin of safety on the inflation, which they want. So they can really, in the US, they can really focus on the growth side of things and employment, and making sure that, as you run into the midterms, that people have jobs, people who want to find a job can find a job. And I think that's the important distinction.
I wonder how you interpreted Kevin Walsh at Sintra. We've been wondering, is he a hawk or a dove? And he kind of seemed to say things on both sides of the ledger at Sintra, saying, yes, he wants to bring inflation back to 2%, but also saying that there's been improvement in price growth over the past few weeks. Are we interpreting him correctly?
We don't know. Now he's inside the tent.
Yeah.
His views will change. We know he resigned from the Federal Reserve because he was concerned about quantitative easing and the use of the balance sheet to buy government bonds. But we know that he and Bessent are going to work closely together. So the Fed and Treasury are going to work more closely together than we have in the past.
Yeah, and he's hiring some of Bessent's aides. Does that make us even more worried? Should we still be worried about Fed independence?
I think that ship's already sailed. I think we already know the answer to that question from an investor perspective. But they will do everything they can to keep the US economy chugging along. And I think that has to be your core scenario for this year. And let's talk about, is the Fed put still there? And I said, well, it's actually, I would say, a Fed and a Treasury put.
OK. And then when it comes to that communication, of course, there's loads of talk about whether they'll just completely do away with the dot plot. Never mind, Kevin Walsh just not putting his own dot on the plot. You've got the former Bank of England Governor Mervyn King coming in to head up the task force when it comes to communications. And he's basically saying, say less.
Yes.
Right? Talk about the destination, not how you're going to get there. How is that going to be received in the market?
Well, I think the market will be a bit worried because they're not going to get as much information, and they have to actually, if you like, do the work themselves. So they're not going to get as much guidance, and therefore, to me, that actually makes the whole thing a bit more data dependent, which is exactly what the Fed wants. They want people to be looking at the data and not what Walsh is saying, and how many words change between this statement and last statement. So from that perspective, I look at it and go, OK, I think this is a good thing. I think that central bankers should focus on what they're doing, and I think that's what Walsh is trying to do now. And of course he wants to talk on both sides of the equation. But, you've got to watch the hands, not the lips on this.
Let's just talk about the ECB as well. You mentioned it. Is there any need for a consecutive hike now? We've got oil prices coming down.
In our view at Robeco, no.
Right, okay.
They're very keen to raise rates. If we look at our assessment of the Eurozone economy, we think the rates have moved from at the top range to being tight compared to where the economy is. So for us, inflation is going to come down. We've got to focus on the growth side of things and try and get out of this sort of stagflationary twist that we're seeing within Europe.
Yeah, I mean, we were hearing from the Bank of France governor earlier on this morning speaking to Bloomberg, and I'm sure at some stage over the next few hours we'll be playing that interview, but really his emphasis was low growth. Is that what dissuades the ECB from going again?
Well, it should be, but we have to remember it's not in their mandate.
Yeah, well, quite. That's what I mean.
So, yes, but then we've seen the ECB's mandates changed over the last 20 years. We saw Draghi says, you can't buy, it was said you cannot buy government bonds. But he did whatever it took from that perspective. So if you think that, then yes, they will be looking at growth because, a certain way of getting inflation down is to have a recession. And, that's not good for any of the political parties within Europe.
OK, Colin, you're going to stick around with me. Colin Graham from Robeco there. Thank you very much for now. We're coming up on the programme. European nations now believe that some fees to transit the Strait of Hormuz may be unavoidable. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, the ECB is in a, quote, good position after June's rate hike. Bank of France Governor Emmanuel Moulin sitting down with Bloomberg earlier on today.
It's true that we've been hurt by a supply shock.
which increase price of energy. And the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well, we will have new forecast in September. But I think, we are comfortable in our base scenario. And the news on what's happening in the Strait of Hormuz is globally good news.
I mean, overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two meetings.
That was the Bank of France Governor Emmanuel Moulin speaking to Bloomberg's Francine Lacroix. Now let's come back to Colin Graham, Head of Multi-Asset Strategies at Robeco. Colin, we've talked about inflation. Let's talk about the stock market. Of course, it's a holiday stateside today, but how are we setting up for next week? I'm looking at futures in the US, up over 1.1% for Nasdaq futures right now.
Yeah, I think we're in a bull market. So, yeah, anything that falls. And I think this week has been characterized by, we've got a long weekend coming up, so take a bit of risk off the table. So I think we'll see more buying next week. And, don't want to predict the market because that's very difficult. But we've got earnings season coming up. We expect that to be, again, very, very strong. And, despite high expectations, we will probably see good numbers on top of that.
So you don't think we're in an earnings bubble then, that earnings expectations are just creeping up, not even creeping, but like running up too fast?
Yeah, so when clients ask me, they say, why are you long equities? It's so expensive. Shiller P, we're back to high levels, which suggests you're going to get 2% maximum from the S&P over the next 5 years on a per annum basis, so much below the average. And I say, well, that's fine, that's valuations. But if you also made that point a year ago, and the earnings have grown into the valuations. So as long as the earnings delivery continues, for us, that's that's a nice safety. And, you heard Rick talk about credit spreads. And as long as credit spreads remain very tight, there's no credit accident going to happen. So you've got earnings and you've got credits fine. So from that perspective, then equities is your natural choice in that environment.
But you saw a 6% drop on chip stocks yesterday. Doesn't that worry you? Like, if chips go down, wouldn't they drag the rest of the market down with them?
I'm not sure, because if you think about would Samsung, if it was listed in the US, would have fallen as much?
Yeah.
I'm not so sure.
Okay.
Because Korea and Taiwan are such small markets, then and the US is so huge, any small move in flow between a very large capital market and a very small one is going to cause these big ructions that happens. And it's not just Taiwan and Korea. We've also seen it in Japan, which is a much bigger market as well. The volatility over the last few weeks in Japan has been huge as well.
And you were saying to me that there's too much of a focus on the Kospi and not enough on the Nikkei.
Yes, absolutely. And then you've got the yen to come into this as well.
Yeah.
And there are, fundamentally good things happening in Japan, but it feels like it's all the same trade at the moment.
Well, who are the winners going to be then in AI?
Who?
Yeah. Not individual stocks necessarily, but where are you along the chain?
So we talked to our underlying stock analysts. They're saying, you've got to be across the chain. And we don't necessarily want to pick a winner right now. And as we've seen in previous tech bubbles, there are plenty of people and companies that were big names at the time but did not succeed. And so we've got to be aware that is the case, and what percentage of the pie are these big hyperscalers going to take? What percentage of the pie of the chips people are going to take? And the question I'm asking our analysts is, are you pricing a chip cycle here, or are you saying that the semiconductor chips is no longer a cyclical market and the innovations have stopped, and what happens when the next chip comes out of all that stockpiles of chips? Do they become obsolete, or what's happened there? So those are the types of things we're looking at and trying to avoid those pitfalls in particular sectors, in particular companies. But that's our analyst's job.
Okay, Colin, thank you so much for walking us through all that. Colin Graham from Robeco, really great. Robeco, great to have you on this holiday. Thanks for coming in to see us. Well, coming up on the programme, European nations are accepting now that the Strait of Hormuz transit fees may just be inevitable. We'll get to the geopolitics next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, some of the leading European powers are now accepting the fact that ships transiting through the Strait of Hormuz will have to pay transit fees. And those payments would likely be required by both Iran and Oman. We can get some analysis now with our Bloomberg opinion columnist, Mark Champion. He joins me now for more. Mark, if there could be fees on goods going through the Strait of Hormuz, how can Trump be saying that Iran's agreed to just about everything we need? Surely this isn't agreeable to the White House.
No, I mean, but I think we have to very heavily discount at this point what the president says about the state of negotiations. I mean, all along he said, that they'd won, that there was a victory, that the Iranians will do anything we say, that, so I think we have to discount that. The talks are going slowly. It's a 60-day period. We've had a couple of bouts. The last one, the Iranians refused to be in the room with the Americans. And it's pretty clear that, all they really discussed was issues around Hormuz. They didn't get into the nitty-gritty of nuclear at all, which is what this is all supposed to be about. So, and Trump has said, and predictably, he said that, he's willing, or he's told officials that if it goes beyond the 60 days, that's fine. It can take longer. So, I mean, his main concern is not to restart the war between now and the midterm elections, and to keep stuff flowing through Hormuz so that you have the price of oil stays low.
OK, so damage control before the midterms,
damage control.
Basically. And on looking at the Gulf states, of course, who didn't want to be part of this war but were badly dragged into it at the start, let's say in this 60-day period there is a deal. What do you think it would look like for them?
Yes, I mean, they're going to be very sensitive to the terms, and their sort of real unhappiness is that, before the war, which they didn't want, there was no problem getting their goods, their energy in and out of the Strait. Now there is. And then the question is, are they going to be subject to some kind of new arrangement in the Gulf to control shipping? They have two problems there. One is money. I mean, the Iranians are kind of spitballing $40 billion a year that they would like to, raise from this traffic. Now, that's ridiculous. There are arrangements like this where, fees for services are, actual transit fees are illegal, but fees for services are raised. Strait of Malacca, I think Singapore said that they raised about 22 million last year from fees there for services. In the Bosphorus Strait and the Dardanelles, the Turks raise about 250 million a year. So here we're talking about 40 billion. That's not going to happen.
Right.
So then the question is, so what will it be? And so how much money? And then an even more important issue for the Gulf is, because the money is doable, right? Maybe not at that level, but, you can, these are expensive products that are going through. The other issue is, do they have control over who goes in and out? Can they make problems for us? Can they, use that as geopolitical leverage anytime they have an issue with the Saudis, and that's what they're going to want to avoid.
Exactly. I do wonder whether Iran will use those fees for leverage to force those Gulf states to look away from the US and more to Iran. But Mark, you'll be coming back on later in the programme. So for now, Mark Champion, thank you very much, our Bloomberg opinion columnist. And you can find Mark's latest column on the terminal at OPIN Go. But coming up on Bloomberg Markets, leisure and hospitality led the slowdown for US hiring in June. So we'll unpack the jobs data next with Jennifer Lee. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend. Bring little Bloomberg into your weekend routine. Watch, listen, stream.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, investors are scaling back bets on Fed rate hikes, though they continue to expect at least one hike this year. Bloomberg's Danny Berger asked National Economic Council Director Kevin Hassett about the US labour market and how he thinks the Fed should operate under new leadership.
If you lift up the hood, then the basic story that we think is animating the economy right now is that there's a construction boom. It's the biggest construction boom we've ever had, in part because in the Big Beautiful Bill, we allowed people to expense factory construction. The president talks about all the time about all the commitments to onshore U.S. activity, and that's showing up in construction employment, which was up a lot this month. But the factories have to be turned on before the jobs go back up into the 200,000 range. And so I actually have been a little surprised on the upside by the job market because it's been north of 100 quite a bit. And because we don't have a massive inflow of illegal immigration, then that makes the break-even job number a little bit lower. And so I think this is a really strong, healthy job market, and that this was a little bit on the other side of expectation, but the trend over 3 or 4 months is consistent with our view that, again, that we were growing about 3%, and that we're going to have a better second half of the year as those factories turn on the lights.
You've been consistent on that, but you've also been consistent on this. You were saying this just a month ago. The Fed is behind the curve. Plenty of room to cut. What you're describing does not sound like an economy that needs a cut.
Mm-hmm. Well, I think that again, what one has to do, and right now, we've got Kevin Warsh there. It's different leadership, and we very much respect the independence of the Fed. I think that Kevin will watch the data and do what he thinks is right, and we'll support him in that. I think that as an abstract principle, going back a month ago on the show or anywhere else I've been speaking, I've been highlighting the fact that the old-fashioned Phillips curve that says if you have growth, you have to raise rates, doesn't apply in situations where there are big positive supply shocks. And so if there's a big positive supply shock, like you have an economy with an apple tree, you plant another apple tree, now you got a lot more apples, the price of apples goes down. And with AI basically increasing productivity of firms all across the country, then that's increasing their output. We're seeing it in real GDP numbers, but not putting upward pressure on prices. Now, on the other hand, if you mailed checks to people, as Joe Biden did, then they all of a sudden, open up their mailbox, so they got a few $1,000s, then they go out and spend it, but the supply doesn't go up with it. That's where you get the inflation that we saw.
Well, to be fair, I mean, the president also, I remember getting a check signed by President Trump as well, and we also had the One Big Beautiful Bill, so both parties doing that. But Director Hassett, well taken on your point of Fed independence. I wonder why then you made these comments on Fox yesterday. You basically said that there are a majority of members over at the Fed who are voting not because they're patriotic, but rather because they want to get Trump. Director Hassett, that sounds like trying to sway the Fed or challenging their independence by you with such a big part of this administration with such a senior role, making a comment like that.
We've said over and over that we think that the previous version of the Fed had made a bunch of moves that looked to us to be partisan. And a lot of the people who decided to cut rates right ahead of the last election, to raise rates the minute that Donald Trump was inaugurated, a lot of those people
hang on, Director Hassett. I got to push back because they cut by 175 basis points from late 2024 through the 2025. That doesn't seem like something that's moving against Trump. That's allowing that's giving the White House effectively what it wants.
They're moving towards normalcy, and I hope that they continue under the firm and solid leadership of Kevin Warsh. I hope that they now move into a direction where they're data dependent.
National Economic Council Director Kevin Hassett there speaking to Bloomberg's Danny Berger. And for more on the US economy and the Fed, we're joined now by BMO Capital Markets senior economist Jennifer Lee. Jennifer, thank you so much for making time for us on this US holiday. You were hearing Kevin Hassett there. He's not worried about the labour market. Are you?
Good morning, and thank you very much for having me on. I don't think I'm as enthusiastic as Mr. Hassett is. I was actually a little taken aback, quite frankly, after when I saw the headline number of just a 57,000 gain. I was pretty disappointed overall. That was my instant reaction. And even when I went deeper into the numbers, I'm still disappointed. Obviously, at the same time, we have to remember all these numbers get revised all the time. So I'm very curious what's going to happen to this 57,000 in a few months' time. Are we going to see like 100 in front of one in front of it? So we'll have to see. But as it stands, we were seeing still some, most industries are still hiring, but it's definitely at a slower pace. And it was interesting that 4.2% jobless rate as well, just because there is not only just about 500,000 people unemployed now in the household survey, but a lot of people left the labor force as well. But so, there's just still jobs to be had, but fewer people, which is bringing down the jobless rate. So overall, still a tight labor market. I don't think 4.2% will definitely define that. But broadly, just some of the details, a little bit discouraging.
Yeah, I mean, you mentioned the downward revisions. We already saw downward revisions for the 2 months before this, 57K for June. Mm-hmm. So does 57K change the Fed story for you?
No, I mean, again, I was just sort of tongue-in-cheek when I was like, at least we saw a plus sign in front of the number. But I think overall, we are still seeing steady-ish job growth for sure, but it's just coming down. Things are slowing down. People are, a lot of people are leaving the labor force, as we saw. Even when you break it down between native-born workers and foreign-born workers, that is also declining on a year-over-year basis. So the labor force is starting to shrink, and it already, actually, I should say starting, it's actually been shrinking for some time now for all these different demographic reasons, including retiring baby boomers and, and of course, low fertility rates. So this is, again, just a smaller job market in terms of supply. Demand is also slowing as well. And then we'll have to see what happens, from here. So there could be potentially some upward pressure on wages. So keep an eye on that one too.
Okay, I mean, when it comes to the inflation picture, I do wonder how much the Iran war is really distorting the picture, whether lower oil prices could be masking something else going on, stickier inflation elsewhere.
That's a good point. So I have been a bit more on the hawkish side, and I think there are so many different views out there, but I've been a little bit wary of inflation. Of course, we started off the year at $60 per barrel oil, and then it went up to over $100, and now we're back down to about 68 or so. So at least it's coming back down in the right direction. We probably saw the peak in inflation probably in May. I'll say that now, but at the same time, before the war in Iran began, there were already some pockets of sticky inflation for various factors. We had, of course, the tariffs were driving various prices of goods and services higher. Demographics, as I mentioned, just last year with all the deportation of the illegal immigrants, that also caused a lot of pressure for certain sectors like agriculture and construction and leisure and hospitality, who rely a lot on those workers. So potentially, again, some pressure on wages there. Climate change and all those, different wacky weather. We've got El Nino potentially, and that's pushing prices higher for various food products. This is like a global phenomenon, obviously. And of course, what happened with the Strait of Hormuz didn't help. We had a lot less fertilizer to deal with. Of course, AI, that's pushing prices for utilities higher. So there's still a lot of, I think, underlying inflation pressures that we still have to be wary of. Having the war in Iran pushing energy prices so much higher did not help, obviously. That's coming back down, so that's a good thing, but it doesn't mean that we're all clear on the inflation front either.
Well, you mentioned tariffs. I mean, I wonder for businesses how much it's going to add to pressure on them that the US isn't renewing USMCA.
Yeah, I think, again, another piece of disappointment for the week. I don't think it was a shock, but, given, especially for Canada, given that, 75% of everything that we export head to the U.S. Over half of everything that we import comes from the U.S. At the same time, Canada and Mexico the combined are still the U.S.'s biggest trading partners. About a third of all their exports head to both Canada and Mexico. So this is going to be a problem, especially for all these businesses to do all these cross-border business activities, especially the auto sector as well. This is going to be an issue. Obviously, the best case scenario for these businesses would have been, some sort of certainty over the next, decade or so. But now we're going to be living off of a year-by-year basis, and I think that will be very difficult for businesses to make any kind of investment decisions, just given that unknown scenario. Even the ISM manufacturing survey that was just out on Wednesday, I think all the respondents' comments. Every single one of them made a comment about either the Middle East war or the uncertainty with tariffs, either or both mentions of those two factors. And that's going to be obviously still adding to their list of concerns over the next half year.
Okay, Jennifer, thank you very much. Jennifer, do stay with us. You'll be coming up in just a moment again, and we're going to be playing the latest from the ECB, because central bankers there saying that the biggest inflation risks from higher energy costs may yet be still ahead. That's next. This is Bloomberg.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, ECB officials say that the inflation shock from the Iran war isn't over yet. Chief economist Philip Lane sat down with Bloomberg's Francine Lacqua at the ECB Forum on central banking in Sintra, Portugal, to discuss the modest increase in confidence levels as oil prices fall.
For the economy, it's only been, a few weeks. So clearly what's changed is the oil market and that is moving quite a bit in the weeks since we've made our decision. And so let's see how that percolates across the economy. So what we have seen is in terms of confidence indices, there has been some improvement, but not a return to the pre-war levels. So it's not the case that there's been this very rapid rethinking of how investors and consumers feel. I mean, I think probably they need to see this current peace agreement convert into something more durable. And as you know, every day there's, plus and minus signals. And that needs to settle down, I think, before consumers and investors take a more decisive revision of their views.
I mean, this is really the concern, right, is that we're not really sure what these ongoing talks will bring. Madame Lagarde yesterday was really talking about no forward guidance, but scenarios. So with these ongoing talks, are we closer to the milder scenario or base scenario?
So I think the most important fact that we see is right now the oil prices reverted to pre-war levels. But the view of the market in terms of 2027 and 2028 is that it will be well above pre-war levels. So in other words, over the next couple of years, maybe because around the world energy firms, governments will want to rebuild inventory, that maybe demand for oil for restocking purposes will keep the oil price high compared to the pre-war level. So from our point of view, it's very welcome that we see this decline in the price of oil, but in terms of the overall inflation impulse, the fact that we do have maybe for a couple of years oil prices above the pre-war level, that essentially is a cost-increasing impulse to the economy.
So it's very clear that the ECB wants everyone to know that the last hike was not an insurance hike. Will the next hike be an insurance hike?
So I think it's important that we are clear on our terminology, if you like. So as President Lagarde said last night, we feel that the June decision was a robust decision, that we looked at it from every angle, and even from the angle which we did anticipate of having, if you like, this more rapid decline in oil prices. Even under that kind of more rapid normalization, it made sense because of 4 months of high oil prices to raise the rate from 2 to 2.25. What I think is important to say is as we go forward, as we evaluate the kind of pros and cons of different rate decisions, we will be, if you like, mainstreaming the concept of how does this decision look like under uncertainty. Now, for me, I would reserve the phrase insurance hike to a situation where there's a tiebreaker, that maybe you could stay where you are, maybe you could hike, and the risk considerations will push in one direction. But that was not the June decision. That was a clear decision, robust across a wide range of scenarios.
Yeah, I mean, given the wide range of scenarios and the uncertainty and the second round effects, is it better to hike in July or September?
Well, again, the way you phrase that question is maybe overly narrow. So what I would say is, before we get to the second round, I mean, for me, the second round effect is probably going to take some time. What I'm really focused on is the indirect effects. So even though now, like fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular. And that channel is maybe where there's still uncertainty. And it's essentially the tension between these many firms have been absorbing higher cost increases for a number of months, whether they can recover those cost increases by raising prices, or whether, especially in the context of now the fuel prices reversing, it's absorbed in profit margins and there's less by way of the indirect effect. And only after that can you start to have a vision of how strong the second round effects on wages might be, which would be later this year and into next year.
So you're telling me my question is too narrow because you could not hike at all?
I think, as you very well know, we're very much committed to basically going one meeting at a time, to not boxing ourselves in by kind of speculating about rate decisions and essentially focusing on, at the time of the meeting, when we look at everything, what makes sense.
So that was the ECB chief economist Philip Lane speaking to Bloomberg's Francine Lacroix. Let's bring back Jennifer Lee, senior economist at BMO Capital Markets, for her take. Jennifer, you heard a cautious Philip Lane there. You're not so cautious. You say that it's likely the ECB is one and done. Why? When we were talking about the tariff risks earlier and he was flagging the continued geopolitical uncertainty around the Middle East.
So, first of all, I would hate to be a central banker these days. Very tough questions. To me, I mean, he was doing the right thing, just trying to temper expectations. He's definitely not going to say, yeah, we're done. That's it. Like, oil prices are back and we're okay. The ECB, as President Lagarde had pointed out in Sintra, they had the benefit of being in a very good position before everything began. They had basically inflation at target. They were sitting pretty, and that was great. And then, of course, everything happened. So I don't know if I could actually say, that it was a mistake. Hindsight's going to be 20/20, of course, but I think right now they just have to be cautious. And just like looking at any one economic indicator, like U.S. payrolls, you sort of have to take it. It's not the be all and end all. And we've seen some very encouraging June inflation numbers out of Europe. France, for example, they just landed back at the 2% target. Who would have thunk that? And of course, everyone else is coming down to about 2 or 3 month lows. We need another month at least of better inflation data, I think, before we can make a firm decision on what the ECB is going to do, just given the fact that, that the tankers are starting to move through the Strait of Hormuz and oil prices are coming back down. We'll take that as a win, and that's a good thing, and that's going to help inflation keep coming down. So, I think most likely, I say this now, that the ECB is probably going to be finished. It looks like it's going to be a one and done deal. But of course, just as quickly as oil prices have come down, they could also easily go back up. So again, we need to see another month's worth of good inflation data.
And let's see what happens at the end of the 60-day negotiating period as well. Jennifer, thank you so much for being with us this afternoon. Jennifer Lee with BMO. Thank you. Well, coming up on Bloomberg Markets, a sweltering heat wave threatening parts of the US East Coast, ahead, of course, of the country's 250th anniversary. We'll talk about that next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. 2:53 p.m. here in London. Well, President Trump's gearing up to visit Mount Rushmore for Independence Day as a heat wave scorches the east coast of the country. Bloomberg's Miles Miller joins us now for more. Miles, I hope you're keeping cool. Let's start in New York. What are you seeing?
Yeah, New York is very hot. We are on about day 2 or 3 of this heat wave here in New York. And, you know, the mayor has put out this call for everyone to conserve energy. AC is clearly not a big thing in Europe. I was just in Paris and experiencing the beginning of that heat wave. So there'll be some commiseration about how hot it is here. But he asked everybody to keep their temperature up on their AC, which caused some consternation. But yeah, we are going to be experiencing really hot days leading up. So this day and then tomorrow leading up to the July 4th holiday. There are so many people in town for the July 4th celebrations, the celebration of America's 250th birthday. And so there's going to be a parade of ships on the Hudson River. We'll have the fireworks on the Hudson River and East River. And then we will also have folks who are here for the World Cup. And then folks who are here for Taylor Swift's Hush Hush wedding. All of that with the heat causes big issues. And it's not just here in New York, it's happening in Washington and Philadelphia, too. 2 places essential to America's 250th birthday, having big celebrations, but will be very hot, and they may wind up changing some plans because of it.
And Miles, the wedding's supposedly taking place at Madison Square Garden, not seemingly to a Brit the most romantic of venues. What's security going to be like?
Yeah, I mean, imagine a wedding at the O2. That'd be a little strange, or Wembley, you know, like it just, you know, I like, no and I don't want to say too much because, like, I don't want to say it's tacky, but it kind of is. Yeah, no, security is quite something. 140 cops have been assigned to Madison Square Garden for this wedding that's happening. Yesterday was the rehearsal dinner, went off without a hitch, no problem. I was over at Madison Square Garden yesterday. The entire area had police barricades around it, and then tonight starts the big shutdown outside Madison Square Garden and the surrounding streets so that 500 cars can show up and deposit 1,000 guests into the world's greatest arena for America's royal couple. How about that?
Lovely. Well, Miles, I'm sure you'll be covering all of the events over the weekend for us. For now, thank you, Miles Miller. And coming up, Miles mentioned the aircon pressures. We're going to talk about energy next with David Energy CEO and co-founder James McInnes. That's next. This is Bloomberg.
Anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Solar de Uyuni.
Welcome to Bloomberg Markets. I'm Lizzie Burden in London, where it's just going to be 3 p.m. Well, US markets are closed for a holiday ahead of the July 4th holiday tomorrow. But here's what you need to know this afternoon. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after that weak US jobs report. Elsewhere, President Trump and his allies are renewing a push to reshape the Federal Reserve, with Governor Lisa Cook still a target. And a heat dome has settled over the US East Coast, pushing New York City to its hottest day since 2012. Well, let's get a check of these markets. Happy Friday, by the way, and it is green across the screen for European stocks this afternoon. Although it is thin volumes given the US is closed, you've got actually the benchmark stock 600 powering towards its best week since May. The DAX in Frankfurt outperforming, the FTSE in London underperforming, and the CAC 40 in Paris somewhere in between. But let's take a look at the cross-asset picture as well. The dollar a little weaker today, which is perhaps unsurprising given what we saw in the payrolls numbers yesterday. Gold up for a third day as the jobs data weighs on Fed hike bets. We're still at $4,164 a troy ounce. Brent steady here as the tanker traffic through the Strait of Hormuz picks up and your talks between the US and Iran continue. $72 a barrel on oil. And given that treasuries aren't trading in cash today, let's take the temperature in the bond space. German bunds on the 10-year at 293. Now, talking of that US payrolls report, hiring slowed sharply in June, curbing some of that budding momentum in job growth that we had seen this year. White House National Economic Council Director Kevin Hassett's been speaking to Bloomberg about the labour market.
I would say that it's on an upward trajectory, that 3 of the last 4 months surprised on the upside, as you know. There were a little bit of downward revisions. This one came in a little bit below expectations, but if you lift up the hood, then the basic story that we think is animating the economy right now is that there's a construction boom.
Well, our next guest says that inflation remains a pressure on the US consumer. Ethan Devitt, the Global Wealth Managing Director at Moneta, joins us now for more. Ethan, thank you for making time for us today. I wonder how much weight you place on the jobs report.
I don't place a lot of weight on the jobs report, actually. This is really in the sphere of a rounding error. We've had positive numbers in the last read, and then just Friday, this week, we've had slightly negative numbers. We know that they are prone to being revised, and probably a function of the seasonal movements as we have now moved firmly into the summer. So definitely there was a little bit of puncturing of expectations around the interest rates, a little bit of a sense that the economy was not as vibrant as before, but I don't think this is really going to change the direction direction of travel, not going to change the momentum around equity markets.
Well, yeah, we've gone from higher for longer to maybe no more hikes. Has the market swung too far then?
If they are believing no more hikes, I think that is a little bit too far to swing based on one jobs number. Remember, we were looking at cuts not too long ago. Then we had this exuberant market performance. We've also had the inflation being pushed up. We do know now that the oil factor of this inflation is subsiding. However, the consumer goods factor is rising. We saw that through the price of Apple recently. So all of that points to quite a mixed picture for inflation, but definitely erring on the side of rising. So I would say that given we are finding it very difficult to read the new Fed chair, it is really anyone's guess at this point what his preferred approach is likely to be.
Yeah, I mean, is he a hawk or is he a dove in your view, given what we heard at Sintra?
Well, what we do know, he's playing his cards very close to his chest. He's certainly not giving anything away in terms of telegraphing. We've seen the phrase tight-lipped being bandied about in relation to him. And that's probably with a view to probably not revealing his hand, shall we say, too early. He's definitely minded to not intervene, in my view. I don't think he wants to make the mistake that may have been made in the past, preemptive intervention. There's that moral hazard of propping up the market too early. But however, he knows what the president's overall desire is. And there will come a time as elections near when that pressure may rise.
And indeed, we may see more volatility as we head towards those midterms. We've just had a pretty stonking quarter. Does it get uglier from here?
I would say we're going to have some moments of revision of the numbers we're seeing, and we're going to be digesting once the 4th of July holiday is over, because for now everyone's at the beach. I think they're dealing with the heat, they're at the beach, they're not focused on this right now. But we did have a fairly seminal, I'd say, statement about balance of power with the frontier models and CEOs and their proprietary data. And that may have been said to be the quiet part out loud. Maybe it wasn't even the quiet part as far as many market watchers were viewing it. But this is suggesting that this is not necessarily for the frontier models necessarily to gain ground here. There is a suggestion that we see some retention of sovereignty by the large corporations, and that this could well be putting pressure on those companies, on Anthropic, on OpenAI, right around the time they are finalizing their paperwork around a potential IPO.
What did you make of the hit to chip stocks yesterday? Is it kind of a healthy rotation? Is it the start of cracks in the AI trade, bigger cracks?
For now, I'd say it's a bit more just rotation, profit taking. I think we have not yet really got the full narrative of what the cracks in the AI trade would look like. What we do know, though, is that the pressure on compute is immense, and there is going to be a lagging factor. There have been orders put in, there have been basically orders not even fulfilled, and I suggest that when we see a slackening in demand, that will not immediately factor into slowing of orders. So that's going to be something to digest. So I'd say now it's really, there has been so much froth, so much positive momentum here. We've come to the end of the second quarter. That's a time to take profit.
And do you think that we're in an earnings bubble where earnings expectations are just going up too fast? We're about to start another season.
Well, that was definitely a headline today, that these earnings are simply too high. Are now expectations have been set regarding that. I'd say that the earnings have continued to surprise everyone. We've seen a slower consumer, but yet that's not being reflected in earnings. And we know that inflation has been an issue for companies too, and that has not been reflected in earnings. So I'd say, can this be sustained, remembering that earnings numbers are backward looking? I think they will come under pressure. But what we do know from previous quarters is that companies are very quick to telegraph well in advance. No surprises is the order of the day. And as we're coming, you mentioned volatility as we approach the midterms. There's going to be more volatility. We know there's some surprises in store. We're not out of the woods yet around geopolitics. I don't think that CEOs want to instill more volatility by not managing expectations around their earnings.
Well, yeah, you kind of wonder if there's a pullback when it comes to AI capex in the future, whether that becomes a macro risk.
Well, certainly there is a lot intertwined in the AI trade. And if we look at, just take, for example, the South Korean markets, how much they are riding on the AI and semiconductor trade. And we know that other Asian markets similarly have been lifted in that way. That's why the rotations have been so healthy when they have occurred. We've seen a rotation into healthcare. Healthcare has done well over the past month of June. And we know that financials have also had their time when they've been doing well. Certain stocks have not done so well. But if there is a pullback in CapEx, that will, I believe, send a chill through the markets. All things will sell off initially, but then we'll start to see the green shoots come through in those sectors that have been overlooked, that really have not even priced in any productivity gains from AI, and there will still be productivity gains. So that's still to come.
Okay. So a healthy spreading out perhaps in the pipeline. Ethan, great to see you. Ethan Devitt there, Global Wealth Managing Director over at Moneta. Thank you. Well, coming up, David Energy CEO and co-founder James McGuinness will be joining us to discuss surging energy prices. That conversation coming up next. This is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
This is Bloomberg Markets. I'm Lizzie Burden in London. Hope you're keeping cool wherever you are. If you're stateside, hope you're having a good holiday. Now, the UK-based National Grid is looking into the cash into the AI boom. It's investing nearly $2 billion in Julant, which is developing a natural gas-fired plant to power AI. And we sat down with the CEO, Zoe Yunovich, earlier on this week.
National Grid has long been invested in delivering energy through long-term infrastructure to our customers. And so in some respects, you could say this is exactly what this acquisition that we've invested in today is all about. But to your point, we are now facing that sector of the market that is growing so rapidly. I mean, the increase in power demand coming from data centers and just more generally from the AI evolving economy, it's an exciting place for us to find ourselves.
It feels like it's really rewriting things really quickly, Zoe, and I wonder how far away you think we are from being able to keep up with the demand from it.
Well, that's why I think this investment is so important for us. What we've done in investing in Juland, which is a technology-enabled energy company, is find ways to actually bring the very best that we can across
Yeah, so for us, we actually don't charge the customer up front for the battery at all. We install it for free, and there's no ongoing payments that they actually have to pay us. We're actually the power supplier for these customers, so we're selling them the energy as well. And what that means is that we can install the batteries for free, and our promise to them is that they'll start saving money on day one. So the first bill they get, the first month, they will see that they're paying less than the local utility. And so there's really no CapEx or, the ROI starts for them on day one.
I mean, you mentioned you work with laundromats, you work with all sizes of business from, small restaurants to the likes of McDonald's. How are the energy problems different for businesses of different sizes?
Well, I think there's certainly different problems for customers that own many locations. Some of our customers own 40, 50 locations across New York City. So they'll have much higher spend on power than others. And then some of them are just, single location, small business, restaurant owners. I think what's consistent across all of them, though, is that they feel like they have no control on their power bills. They're seeing AI in the headlines and the power demand there. Their bills are going up. They're not super happy about it. And so we come in and help alleviate that pressure from them. And I think it's particularly acute in times like these when, the heat wave is ongoing and things are in the headline. Like you saw the European Commission, there's a lot of controversy that they turned the AC off on some of their lower floors and not the higher floors where the executives work. And then here in New York City, you have Mayor Mamdani saying to turn your thermostat up to 78 degrees. And while we can obviously appreciate trying to alleviate the pressure on the grid during these times, it makes our customers feel like not only are they paying more and they don't have control, but they also don't get to enjoy the benefits of the power grid and get AC when they need it. And so the thing that we focus on across all of these businesses is that we're going to help them save money. We're going to let our batteries during these times, and they can keep their AC cranking.
But do you think that the conversation is turning away from climate to economics as clean energy becomes more and more politicized?
Yeah, and I don't think that's necessarily a bad thing. I mean, from day one, we've actually believed that clean electrons are the cheapest electrons. So our mission as a business is run the grid 24/7 on clean energy. And we think that the more solar and batteries we get out there on the grid, the cheaper our customers' rates are going to become. And not only that, just like in times like these, the grid is also going to get more reliable. And so these are incredible new technologies coming to market. We think there's a performance benefit. And so while some of our customers care about clean energy, and we're happy to talk about that with them, a lot of them do not. They're focused on their pocketbook. And so we sort of believe in a future where there isn't a trade-off, where you can have clean energy, it's cheaper, it makes the grid more reliable, and that's really what we're after. That's our mission here at David Energy.
So 5 years from now, what looks completely outdated that we have now that won't exist then?
I think especially with these new types of plug-in batteries and solar coming to market, I mean, I think in Europe, they call it balcony solar. That's a big trend coming to the US that we're at the forefront of, and really one of the few companies installing these types of assets. And what it's really doing is democratizing access to these technologies. So if you're a small business, if you're a renter, you can buy solar, you can buy batteries, you can even self-install it or get a company like us to help you connect it and then connect it to energy markets. But I think what that means is we're just going to see this. We're going to see solar and batteries everywhere. I mean, I think solar and batteries should be on every home and building in the U.S. And that's going to do a lot to lower prices and fight the climate crisis at the same time.
Makes sense. It's hot and sunny, isn't it? James, thank you for making time for us. That's James McGuinness, CEO and co-founder at David Energy. Well, still ahead, the ECB striking a dovish tone after hiking rates in June. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's true that we've been hurt by supply shock, which increased price of energy, and the point for us is that it doesn't go through, all the prices in Europe. But I think we had good news about oil and the reduction in the price of the Brent. So it makes our job maybe a little bit easier. We'll see when we meet next time in July.
What are you expecting for July? Will it be a more difficult decision than June was?
No, I mean, we are not into forward guidance, so we'll decide when we'll be there. But what we see is that at this moment and at this juncture, we are in a good position, and the balance of risk is in the right place.
I know you worry about services inflation. What can you tell us about services inflation?
Well, service inflation has been, energy is feeding into services, obviously, because they are transport, airfares, logistics, which are heavily impacted by the price of oil. But the fact that the oil price decreases will I think soften the inflation on services. But it's still, what we see is that we are above our target. And so I think the decision we made in June was the right one, because we had inflation above our target on our horizon. But the good thing also is that, we do scenarios. So we look at different scenarios and forecasts. We had a severe scenario, base scenario, and a milder scenario. And the fact that we have this scenario makes us much more comfortable on our decisions.
So where are we in the scenario factor?
Well, we will have new forecast in September. But I think, we are comfortable in our base scenario. And the news on what's happening in the Strait of Hormuz is globally good news.
I mean, overall, we were in Sintra together, Portugal, for the ECB forum. A lot of the governors were worried that there'd be second-round effects. Do you expect the decision-making of July, but also September, just to be more difficult?
I don't think so. I think that we made sure in our communication that we were not entering into a new cycle of hikes. So we took this decision in June, which was perfectly legitimate, and now we will decide meeting by meetings and data dependent. So we'll see where we are in July and in December, but we've made no commitment for these two.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
This is Bloomberg Markets. I'm Lizzie Burden in London. It's just coming up to 3:30 p.m. here. Of course, it's a holiday stateside, but let's get a check on these markets. Thin as volumes are given that holiday. And if we focus on Europe, the Stock 600, the benchmark European index, powering towards its best week since May, led by tech and utilities, following the gains that we saw on South Korea's Kospi earlier, and with Nasdaq futures pointing higher as well. Turning over to the cross-asset picture, the dollar is a little weaker, unsurprising after payrolls yesterday. Gold up for a third day as that jobs data weighs on Fed hike bets. Brent pretty steady, $71 a barrel as we monitor the talks between the US and Iran. Citi actually saying that oil could slump to $60 a barrel a day by the end of the year as the war shock fades. And given that treasuries aren't trading in cash, we're looking at the 10-year Bund yield at 2.93. So, as I say, it is a holiday stateside. Americans gearing up for one of the largest shopping days of the year. Lucky them. Let's discuss consumer trends now with Jill Kress, Chief Marketing and Experience Officer over at Babylist, who I'm pleased to say joins us now. Jill, really good to have you with us. I'm 5 months pregnant, so this is a conversation that's of particular interest to me. Babylist, of course, expanding its remit. You're known for baby registries, but you've moved into family finance. Why do that now?
Well, first of all, thanks so much for having me, and congratulations. It's certainly one of the most exciting and overwhelming moments for a parent to think about welcoming a new baby. I'm excited to talk about Babylist and our new early investor product. Most people know Babylist for its registry. We see the registry as an entry point into a long-term relationship with Babylist. 40% of new parents in the US use Babylist, and through that list and registry, over 10 million people gift on Babylist. That's an incredible testament to the social graph and how powerful that is. Babylist is having incredible growth. Last year, we posted $750 million in revenue, and we're on track to do $1 billion this year. I think those numbers are important to understand the scale and context of Babylist. There's really no other brand that understands the purchasing power, the behavior, and the shopping intent of new parents. And with that, we know that becoming a parent is overwhelming in many ways. And one of the biggest concerns that parents have is, how am I going to pay for my child's education? And on the eve of the launch of the new 538 Trump account, the American government is giving $1,000 in seed money to babies who were born during this administration. And this is an amazing opportunity for parents to start to invest. An early investor is the product that we've built to be the conduit to make it just as easy to gift a contribution into a child's education as it is to give another gift to a baby.
So are we seeing a broader shift from buying gifts for babies to investing into their future then?
One of the things that we're seeing is this normalization of people asking for cash contributions. We have seen an increase in cash as part of the baby registry, and we're excited about the opportunity through our early investor account for parents to have a tool to ask for the thing that they, in many cases, want as much as a gift, which is a contribution into their child's financial future. And Early Investor makes it really easy and seamless to do that. I worked at Venmo for a long time, and one of the things that Venmo did really well was it took the ick and the awkwardness out of asking someone to pay you back. And we think Early Investor is an opportunity for that same thing to play out, which is for parents to, yes, lean into that trend of asking for the thing that they really want, which is more contributions to their baby's financial future.
Well, yeah, your customer base includes nearly 40% of first-time American parents. What are they telling you about the financial pressures of being a parent in 2026?
Yes, we know that there are many financial pressures. It costs a lot of money to bring a baby home. And one of the things that is top of mind is, how am I going to pay for my baby's education? And we hope that with Early Investor, we can take some of that stress off of their plates. The other encouraging thing is that we know the community that surrounds the baby, grandparents, friends, and family, are very interested in making these kinds of contributions. The challenge is it hasn't been easy. And so with the Early Investor product, it's really simple for a parent to register and create a link that can do a one-time contribution or an ongoing contribution into their child's either 529 college savings account or the new 538 Trump account. The exciting thing about that is when people make the gift of a contribution, it will really compound and grow with the baby. The compounding interest piece of it is something that's really, really powerful for parents as they think about setting their baby up for long-term financial success.
And Jill, you talked about the rapid rate of growth of your business, approaching $1 billion of revenue. What's been the main driver of that growth?
Yeah, so our core product is the baby registry, and we see incredible growth in that product, and we continue to add more features, including things like cash contributions to support things like meals when the baby arrives. So we continue to make that registry more and more functional. We've added new verticals. We expanded a few years ago into a health vertical. That is a way for us to help new parents get the things that they need to support their baby's health, like a breast pump and other supplies. And now we're expanding into our third vertical, Baby List Money, and excited to be launching the Early Investor product. So again, I think with this audience that we have, 40% of new parents, we've really already established this incredibly trusted relationship with new parents at this very overwhelming and exciting moment for them. And so through that relationship, we listen to them, we understand what's top of mind, and then we work on building a product roadmap that will deliver the solutions that they need, whether it's making the registry work harder. The registry will now start to create wish lists so that they can use that same functionality for other milestones like birthdays and holidays. The advent of health, and now in what we're doing with money, just allows us to continue to do the work of ensuring that the registry is just an entry point into a relationship with Baby List, and that we can continue to do more jobs for parents through the life of their child.
Well, speaking of milestones, what milestones do you need to hit before you IPO? Are you still on track to do it next year?
There's a lot of energy around babyless growth. I can't make any comment about a potential IPO. We continue to strive to do those jobs for the parents that are so important and trust us, and make sure that we continue to be the most trusted brand when it comes to preparing for every stage of a family's journey.
All right, Jill, good luck on that journey for the company. Jill Kress of Babylist there. Great to have you on. Well, coming up on the programme, tech stocks hitting a bit of turbulence, with investors concerned about just how much further this rally can go. We'll talk about that next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, it's been a roller coaster year for Qualcomm already as the chipmaker looks to keep up with the ever-evolving world of AI. Qualcomm's CEO spoke to Bloomberg's Romain Bostick and Ed Ludlow last week to discuss the company's sky-high expectations for the future of data centers.
$5 billion in fiscal 27. It's a high confidence number that we have based on customer engagements we have right now. Most of their revenue is from custom ASIC engagement that expanded since the acquisition of AlphaWave. And you started to see in their revenue some of this innovative technology we came up for accelerators that doesn't require HBM memory is our high bandwidth compute. And as we keep executing on those customers, we're excited to see that revenue going to about $15 billion in fiscal 29.
I am curious, Cristiano, when it comes to those longer-term targets and the bridge between the short term, so what you have put out there for 2027, is there any sense, I know you haven't named the customers that get you over that bridge here, but is that going to fill the hole of that $5 billion based on the $1 billion that we already know is out there?
Look, the $5 billion, as I said, it's, I'll give you the composition. I think what I can say right now, I think, as you'd expect, a lot of those contracts are governed by non-disclosure. We have one large hyperscaler customer in the United States, one large hyperscaler customer in China, and then we have some other engagements that we had on a data center. That is all into the $5 billion. So the $5 billion it's a very high confidence forecast to which we have the customers, the capacity, the memory allocation, and everything. As we think about the engagement we have today, and also we talk about a contract that we have with Meta, also for 2 generations of the CPU, especially as we position ourselves for the agentic CPU opportunities, that those engagements are into the $15 billion number. For Qualcomm, as a new entrant, those are great numbers, but really, when you look at the scale of what's happened in the data center, you would imagine as we execute and we show our differentiation, there could be upside, but we're just, being focused on the engagements we have today.
I do have to ask, though, and investors seem pretty pleased with what they heard yesterday about you articulating this longer-term data center strategy. But I'm curious, I mean, you famously exited the data center business back in 2017, 2018, and I know there were a lot of reasons for that went beyond your operational control. But there was a lot of competition then. There's probably even more competition today. Why do you think you can get it right now compared to what it was 8 years ago?
Yeah, look, the circumstances, I think, when we started on the CPU, actually, I know people talk about data centers as a general term, but we started a long time with an ARM-compatible ISA CPU very early. There was a big software barrier. This was before AI. And, at the time, I did not, the market wasn't ready for it, only until later. So it was kind of probably the right decision for Qualcomm at the time. This is a different conversation. It's a different data center right now. This is about AI. But it's a valid question, right? So I will give you the same answer that I gave when we entered the automotive business, when we entered the industrial business, and everything that we have been doing to diversify the company. Those are fast-moving markets now, changing with technology. So where we really focus is not what the data center is doing today, but what the data center is going to be doing tomorrow. The data center is now moving to agentic. That's why you see CPU companies on the rise. You see demand on the rise. The data center is being disaggregated. It's not one single GPU that does everything. You have different hardware. And we're coming out with a comprehensive portfolio. We have a CPU. We have a new memory solution that is not a memory from the memory provider. It's actually been designed by Qualcomm that doesn't require HBM. We have a different accelerator for the disaggregated compute. And we have our semiconductor scale, which is good for custom ASICs. So that's what we're doing. And, if technology matters and you have fast innovation cycles, there's room for Qualcomm.
So that was the Qualcomm CEO speaking to Bloomberg's Romain Bostick and Ed Ludlow. And sticking with tech, chip stocks kicked off 2026 by posting their best quarter ever. But after recent jitters sent the stocks tumbling, we've got investors wondering how much further that rally really can go. Matt Bloxham of Bloomberg Intelligence joins us now with all the answers. So, Matt, before we talk about the sustainability, just tell us what's driven the rally so far.
Yeah, I mean, we had a little bit just there from the Qualcomm CEO. We had this kind of massive surge in investment in data center capacity, and we're starting to see kind of real new demands put on the chips and the processors, and this is where the kind of memory is coming in, because the NVIDIA chips in particular, real big consumers of high bandwidth memory, and so that kind of whole ecosystem is kind of really benefiting. And if you look at the capex projections, 2026, the kind of big 5 US hyperscalers are going to spend maybe $650 to $700 billion on technology, mainly towards data centers. That's almost double year on year. And the market thinks that number is going to go above $900 billion next year. And so a lot of that money is going into chip technology. And that's kind of where we've seen this kind of surge in share price come. I think it's kind of caught the market a little bit by surprise. quite how important memory is to the AI technology revolution.
So you had semi-suppliers kind of caught off guard, but when it comes to the sustainability question, is it just going to be inevitably, eventually, a repeat of the boom-bust cycle?
Yeah, I mean, I think the market's a bit split. I mean, if you look at the multiples for the big ones, so SK Hynix, Micron, they're trading on kind of single-digit PEs. That tells you the market thinks that we are going to ultimately go through some kind of boom and bust. This isn't a sustainably higher level. Yes, they're benefiting from short-term, massive short-term boost of profits. That's probably not going to fade next year. Probably 2028 might be the year where, if there was some kind of slowing in the pace of AI demand or there's a bit of a pause, that's where you would start to see it. And that's what the market's pricing in. So, if that's wrong and actually we continue to see this kind of tsunami of AI demand come through the corporate system, then, there could be upside to those valuations from here.
You mentioned NVIDIA as a buyer of the chips.
Yeah.
Why is their share price lagged so far this year?
Yeah, I think you probably almost have to classify NVIDIA as one of the kind of the first movers, the first wave of the AI bubble. If you look on a 5-year view, NVIDIA is up massively. And so I think it's kind of paused for breath a bit over the last 12 months because the market's already got to a point where it's pricing in significant forward growth for that company. And then you've had this second wave, this new bottleneck, which is memory supply. And that's where the investor community has shifted, taking some profits perhaps out of NVIDIA and putting it into the second wave.
OK, Matt, thank you so much for that. Matt Bloxham of Bloomberg Intelligence, thank you very much. Well, we are looking actually at tech as one of the best performing sectors in Europe today. It is currently in 4th out of 20 place and it's up 1.5%. We already saw gains in the Kospi in South Korea earlier on today, so reversing the picture that we saw yesterday. We're looking at NASDAQ futures higher as well today, up 1.2%. Of course, the US is on holiday. This is for Monday, but we're seeing a generally positive story for tech on this Friday. And we're going to continue the story about tech next and ask the question, can AI replace experience? The Ford CEO, Jim Farley, says not quite yet, and we'll bring you that interview next. Stay with us. This is Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg. This is Bloomberg Markets. I'm Lizzie Burden in London.
Well, Ford's quality comeback wasn't driven by AI alone. The automaker brought back hundreds of veteran engineers to help train its AI systems, a move that helped propel Ford to the top of J.D. Power's latest initial quality study. Bloomberg's Matt Miller spoke to the Ford CEO, Jim Farley.
It took us 4 years of hard work to be an overnight success story. You know, it's been just an amazing culture change at Ford. Literally, Matt, every one of our engineers has been in the plant. Every one of our supply chain teams are in our suppliers. We are paying attention to every detail. It has taken a few years to get there, but I think it's really about the culture of putting quality before profits, before anything else. And that really is what's exciting about this, because now what I'm seeing is the team really focusing on long-term durability.
So what was it, your team, was it an employee, a labor issue? Was it, technology? Did you use AI? Was it factory processes? Like, can you get into specifics of how you did it?
Yeah, if you were to visit today the Rouge plant where we make the F-150, Matt, what you would see is a whole control center around data and quality data. So we measure the torque of every one of our fasteners. We have AI tools for vision systems. But most of all, it's just old-fashioned hard work of our team members all working together to pay attention to the very small details that will make a difference between a perfectly built Ford and an okay built Toyota. It's just an incredible attention to every single detail.
So, I mean, it's interesting now that we're in the age of AI and we're talking about this technology killing jobs, but it seems like in your case, it's really experienced human workers that made the big difference.
It did. I have to say, the process coaches, the area coaches, you know, they get up every morning. They look at the last shift's quality data. We look at how many vehicles are repaired, and we work that process every moment of every day. Every employee walks into any one of our plants. They know exactly, are we winning or are we losing yesterday and today? Everyone is fully aware of where we stand. We know exactly where Toyota is. We knew exactly how to, where we needed to get to beat Tundra and Super Duty better than any of the other domestic competitors. And so everyone is aware exactly the quality that's coming out of our plant in any particular shift every 50 seconds. And that human motivation to pay attention to everything is amazing. Look, we make 85% of our vehicles in the U.S., Matt. That means these are U.S. factory workers versus even our domestic competitors. They're some of the biggest importers in the U.S. We're not building these vehicles in South Korea or Japan. These are American workers beating Toyota and Hyundai and our domestics who import their vehicles. We beat them all with American workers with the attention to detail.
Well, that was the Ford CEO, Jim Farley, speaking to Bloomberg's Matt Miller. Well, on a quiet day in markets, thin volumes given the US holiday. I just want to bring you some breaking news. Focus on a single stock, and that is Continental. We had a hot headline crossing the terminal that Conti has nearly finalised the sale of its Conti Tech industrial unit to Lone Star Funds. That would complete the manufacturer's shift to focus on its tyres business. And so this story confirms a Bloomberg scoop from last month. Of course, it comes against a backdrop of private equity funds increasingly targeting industrial assets that they see as more likely to benefit from AI than to be rendered obsolete by it. And we're seeing Conti shares, as you can see there on the screen, higher 1.8% as a result. Now, looking across the sectoral basket here in Europe, industrial goods and services are in fourth place, up 1.6%. They're behind tech, construction and utilities. About 3/4 of sectors in positive territory, but green across the screen for European equities this Friday. Coming up, Air Chief Marshal Sir John Stringer, Deputy Supreme Allied Commander of Europe, joins us ahead of the NATO summit. That conversation.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it, you know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise Ahead or Gattaca?
Maybe somewhere in the middle.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Lizzie Burden in London, where we're just coming up to 4 p.m. US markets, of course, are closed for a holiday ahead of the 4th of July tomorrow. But here's what you need to know. Stocks rebound after 2 days of a tech-led sell-off as traders trim bets on Fed rate hikes after a weak US jobs report. Meanwhile, President Trump and his allies are renewing a push to reshape the Federal Reserve, with the Governor Lisa Cook still a target. And a heat dome has settled over the US East Coast, pushing New York City to its hottest day since 2012. Well, let's get a check on these markets. It is quiet, thin volumes across the world given the US is closed. European stocks, though, headed for back-to-back record highs on the Stoxx 600, powering towards their best week since May. The DAX in Frankfurt leading the gains, the FTSE in London bringing up the rear. And if we flip to the cross-asset picture, the dollar a little weaker, as you would expect, given the payrolls print. Gold up for a third day as that data weighs on Fed hike bets, and Brent steady as the tanker traffic through the Strait of Hormuz picks up. Treasuries aren't trading in cash, but you've got the 10-year bund yield there at 2.93, currently up 3 basis points. Now, that's what's happening in your markets. Let's turn to the geopolitics, because NATO members are set to gather next week in Turkey, where Europeans are hoping to ease tensions with US President Donald Trump. Air Chief Marshal Sir John Stringer, the Deputy Supreme Allied Commander of Europe, I'm pleased to say, joins me now from Brussels. Thank you so much for making time for us ahead of the summit, sir. Really good to have you on the programme. We've had the NATO Secretary General presenting President Trump with big spending figures in the Oval Office. I wonder how that has actually translated into war-fighting capabilities so far, and what you expect to hear from this on this regard at the NATO summit.
Yeah, I think it's one of the 3 big things that you're going to see coming out of the summit. So it's progress towards what was agreed at the Hague summit last year, historic rise in defence spending for the defensive alliance up to 5%, to check progress on it. And also, to your point, really to make sure that the money and the increased spending is a tangible and, importantly, credible military capability to keep the 1 billion people across the 32 nations of the alliance safe and secure.
I mean, how vulnerable do the cuts that the US has announced to the support that it would give to Europe in case of war make us?
Yeah, I think there's 2 points, if I might, on that. The first is the reality is, sadly, we are not living in happy times at the moment, and that's zooming out from Europe and looking globally. And therefore, the need for the US to rebalance its commitments is not something of the last few weeks or months. It's been a factor for years. The second point I would make is, and I am responsible for sourcing forces for SACEUR, is that European allies have definitely stepped up in terms of backfilling the adjustments in the US forces in Europe. And I think, importantly, you are seeing this as a real demonstration, not just of stronger Europe in a stronger NATO, but this is absolutely NATO nations building the NATO 3.0 that you may have heard a number of people talking about over the last few months.
Well, do you know when the 5,000 troops that Trump said will be withdrawn from Europe will go? And do you expect even more to be withdrawn on top of that?
So I won't get drawn into to numbers across domains. You'll understand that I can't. What I can say, though, is if you look across whether it's maritime or air or land, in terms of the capabilities that we need to deter and defend, those are steadily building now, as they have been over time. And I think you'll find that the injection of spend, around 130 billion extra this year, 20% increase over planned figures from a few years ago, is being turned into deliveries of equipment, material, and of course the important spend on things like training and exercises for all of our forces.
OK, you won't go into numbers, but can you be confident that the cuts will be driven by military logic and not by politics?
So, yes to military logic. And that's absolutely where we have gone to find the forces to backfill against the American force adjustments and the capabilities that they need for the alliance.
I mean, the US is fundamentally asking for the balance, the burden to shift within the NATO alliance. Does that mean that there'll be more power for Europeans within NATO?
Well, NATO, quite rightly, has been an alliance since its inception. 12 members, first off, remember, in 1949, 32 members now. That it is an organisation that is driven by consensus on all the really big issues, on getting the 32 nations to agree. And as a European, I look at European and Canadian forces stepping up over just, the 3 or 4 years that in 2 NATO appointments I've been in, as a very clear demonstration of them stepping up, of acquiring additional capability. And so that burden sharing or burden shifting, which, as I said, was going to be a thing anyway, is now being done in a sensible, proportionate way, absolutely driven by military logic.
OK. Well, I mean, what's new is you've got the US Defence Secretary Pete Hegseth talking about NATO with benefits. If you pay more, you get more out of the alliance. What do you think those benefits and penalties on the flip side are going to look like?
Well, you'll understand I won't speak for Secretary Hegseth, but what all of the alliance members agreed to in The Hague was the lift in spending to 5% by 2035. Some nations are already there. And that equivalence of spend, all of the nations stepping up, means that actually, the really important questions are answered in terms of nations stepping up to the requirement, developing the additional forces and procuring the additional forces that they need and turning it into capability. But the other thing I would offer is what you're also seeing is, again, frankly, overdue investments in our industrial base, and most obviously the defence industrial base, to make sure that we can actually develop, produce the systems, the weapons, and wider capabilities that the nations need to buy.
Let me also ask you, sir, as a Brit, we know that Keir Starmer lost his Defence Secretary John Healey because Healey perceived defence spending as inadequate here in the UK. Does the UK need to spend 3% on defence by 2030?
So let me answer it as a NATO officer. Let me answer it as DSACR, which is all of the nations, all 32, agreed that they would get to 3.5% by 2035 and have a credible path to get there. So nobody gets an opt-out on that one. That's what we agreed. And that obviously includes here the UK. The thing I would reflect on, both as a Brit and as a NATO officer, is the areas of investment which I see the UK having announced in the last week or so are absolutely aligned with where NATO sees our forces needing to go to be able to be credible in deterring and defending, as I said, the billion people under the NATO umbrella, but absolutely recognising where technology, let alone the lessons, sadly, from current conflicts, are indicating the direction of travel for us.
And from the NATO perspective, you're confident that defence will be a priority under a Prime Minister Andy Burnham?
So again, I can't put words in a Prime Minister's mouth. I wouldn't do it for any of the nations in NATO. But the UK has made the statements that it has done this week, and NATO will expect all nations, including the UK, to live by their commitments.
Would Keir Starmer be a good NATO chief?
Well, not for me to judge at all. It's going to be some way off in the future, and I'm sure there'll be a bunch of highly capable and credible candidates.
There's also comments from Mark Rutte that NATO could play a role in Hormuz if asked and if useful. What would that look like?
Well, I think NATO nations would accept and state two things. The first is clearly the Straits being open benefits everyone, not just, by the way, the 32 nations globally. That is a truism. Second is that Iran cannot be allowed to have a nuclear weapon. So if NATO nations are in the position to assist with the Strait of Hormuz mission, and you will clearly know the Anglo-French initiative, not, by the way, a NATO initiative, an Anglo-French initiative. So there are many discussions going on about what that might look like. But I think people are clear on the need to make it happen.
Just finally, what should we make of the replacement of Army General Chris Donahue with a lower-ranking general as the top commander from the US for Africa and Europe? Is it obvious to you that politics were at play?
Well, I'm not going to comment on that. Again, it's an American thing. But let me, an American national thing. But let me just say one thing, if I may. Chris Donahue is a great American, a great leader, a great man, and he's been a superb commanding officer in NATO. And he's a very good friend.
OK. Air Chief Marshal Sir John Stringer, we really appreciate your time ahead of the NATO summit next week. Thank you so much for joining us on Bloomberg. Well, coming up, strategist Rob Hayworth of US Bank says that the bull market still has room to run despite Fed and inflation risk. He'll join us next. This is Bloomberg.
At what point do you say, we made a mistake and we're getting out? How long do you give it before you say, this isn't working?
That's one of the most critical differentiators between great investors and just mediocre investors. Because on one hand, you have to have confidence and conviction in all the work you've done, the decision you've made, that if you have a little stumble here and there, if you immediately are selling out, you're never really going to fully realize that the depth of potential long-term success. And yet, on the other hand, if you're stubborn and you refuse to admit I'm wrong, you continue to think the market's wrong and I'm always right, then you'll get caught in some very, very difficult positions over time. So that ability to have a fresh perspective, take in the new information, even when things aren't going the way that you'd expect or to hope, and to really understand from this price point today, is this still going to be one of the most compelling investments or not?
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
We think that the previous version of the Fed had made a bunch of moves that looked to us to be partisan. And a lot of the people who decided to cut rates right ahead of the last election, to raise rates the minute that Donald Trump was inaugurated, a lot of those people are still around.
National Economic Council Director Kevin Hassett there on sharing his take on the Fed. The jobs report leading more investors to bet that the Fed will hold rates this year. Well, let's discuss the labour market now. We can bring in Rob Hayworth. He's Senior Investment Strategy Director over at US Bank Asset Management. Good to see you, Rob. Thanks for joining us. Wonder how much weight you put on this jobs report. Does 57K for payrolls change the Fed story for you?
Yeah, no, we don't think it's great to be here. We don't think that 57,000 jobs changes the story very much because it's still a very constructive labor market. Jobless claims remain quite low. 57,000 still puts us in that realm of meeting population growth, meeting what we need to do from a growth perspective for the economy. So, yes, we're averaging slightly below 100,000 new jobs a month in this year, but that compares so favorably compared to last year when we just averaged 10,000 new jobs a month. So we're still seeing this as very constructive from a labor market perspective. I think the Fed's attention is very much on inflation, and that story is starting to change.
And if the Fed stays on hold, is that actually the best outcome for equities, to both be cautious and perhaps seem more credible?
I think it is a solid outcome for equities. I mean, certainly the market would cheer some rate cuts if it wasn't a softer economy, right? Lower borrowing costs are always somewhat better for businesses. But the Fed is fairly close to what they're thinking of as a neutral interest rate between 3.5%, right? They're at 3.5 to 3.75 right now. So we're in a good spot where the market can still press ahead, especially given all the investment demand that is going on coming out of artificial intelligence spending.
Yeah, but what about the oil market and the fragility of it if the Strait of Hormuz stays disrupted? We're trying to see what happens in this 60-day negotiating period. We're also getting the news today that some leading European powers reckon it's just inevitable that Oman and Iran are going to be charging transit fees in the Strait. Surely that would add to inflation risks, not just for going through the Strait, but setting precedents around the world.
I think tolls in the Strait of Hormuz would be very much a challenge. It is one of the factors that opening of the Strait of Hormuz that we continue to keep an eye on. With oil prices moving below pre-crisis levels, right, I think the market is getting a bit of a reprieve. But one of the things we are concerned about is you've seen a significant drawdown in U.S. inventories, especially the Strategic Petroleum Reserve, and that has happened in countries around the world, which does mean that we may not be as resilient in the event of a new crisis, meaning oil prices could spike much higher. I think the good news is we're not in that crisis yet, and hopefully negotiations take hold and we end up in a good place. Certainly the president has some incentive to get these negotiations done as we head into midterm elections, because it has been challenging for the U.S. consumer to deal with these much higher energy costs in the economy. Hasn't been a bad thing yet, hasn't hurt economic activity, but I think the longer this goes on, right, the more that will weigh on the voter as we get into midterm elections.
Well, yeah, you still like US large caps into year end. What's the biggest risk before the end of the second half?
Yeah, I think before the end of the second half, I mean, you've highlighted one, oil prices are one of the things we're keeping our eye on. Two, we want to make sure that the labor market stays solid. And that seems like it's the case, but that's the second thing we'd pay attention to. And the third thing would be the consumer. Consumer resilience has been such a hallmark of this first half of the year. And we've kind of eroded some of that resilience as we think about higher energy costs, taking away some of the stimulus we got from tax rebates here in the U.S. or tax refunds here in the U.S. So we have to watch that consumer resilience as we move into the back half of the year. For now, that all looks good, but we're closely watching weekly jobless claims to make sure layoffs don't tick higher. We're going to watch the oil market. That's an important price every day. And hope for the best that second quarter earnings season ends up fairly solid here as we head into that season starting July 14th.
Yeah, do you think that there's been a bubble with earnings where expectations are just getting really out of control every quarter after every quarter?
It doesn't seem like out of control yet, because we can tie this back to the investment spending that's happening for artificial intelligence. So I think from our perspective, we're doing okay. We're not yet in a bubble. I think we're a long ways away. We're still in such early innings when it comes to the artificial intelligence build out and usage, right? And that's kind of the next key thing that we have to see, is not just getting this built, getting this funded, but then use cases, and we're starting to see some of that already in healthcare. We're seeing it in other businesses, right? But that productivity growth has to be kind of that next phase that we see as we get into 2027.
Okay, Rob, thank you very much for your insights this afternoon. Rob Hayworth with US Bank Asset Management. Well, coming up on Bloomberg Markets, President Trump saying that the US is still negotiating with Iran, but, quote, thinks they've agreed to just about everything we need. We'll dive into the geopolitics next. This is Bloomberg.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
This is Bloomberg Markets. I'm Lizzie Burden in London. Well, peace talks between the US and Iran on pause as Tehran begins a week of mourning for its former supreme leader. President Trump telling reporters on Wednesday that there was progress between the two countries in negotiations. Let's see if we believe him. Bloomberg opinion columnist Mark Champion joins me now for more. Mark, you've got President Trump saying that Iran's agreed to just about everything we need. And yet we report that European nations, some of them are convinced that fees are going to have to be paid to Iran and Oman to transit the Strait of Hormuz. Surely the White House wouldn't agree to that.
Yeah, so I think we're a long way away from a deal. This is something President Trump has been doing for some time. He's actually been very good at it, managing expectations, managing the market, keeping things smooth, in order to, keep the markets happy. Just sort of lower the tensions around, the risk which still exists that this gets out of control again and that we're back at war. But yeah, it's going to be a while.
So he's saying what he has to ahead of the midterms, essentially.
I think so. And, long weekend, what's the upside to, getting people